anything. And essentially, they're trying to get these really small stop losses rather than just let the market breathe, let the market do what it needs to do, trust your ability analysis, understand that it might take a day for your trade to play out, and you might get a 1-to-1, 1-to-2 trade out of it. It might come into profit and it might be slow, and that might look like £100 to your account first, but once you scale, whether it's prop firm or live capital, that £100 turns into £5,000, and then it turns into £10,000, and then that's how you scale. You learn to start small, and then you build up as you go, and then once you've got a year, 2 years, 3 years experience, then you're not going to be thinking about you're going to be thinking about, I know where I'm going, I know where my stop loss is going to be, I know the market's going to breathe, because a lot of people will say, and I'm sure you've had your experience as well, if my stop loss is too short, it will hit my stop loss and then it will move in my direction. If you have enough capital on a trade, your broker might not even allow your stop loss to be that, unless you trade futures and things, but your broker might not allow your stop loss to be that
for the
tight
risk of
as well.
slippage. Yeah. Let's take a moment to talk about a partner of the show, a leading prop firm that is Funded Next. And it's important for me to listen to our community to see who are you working with and how can we make your experience better. And the main feedback I heard is trusted payouts, quick payouts, ability to scale, and affordable prices. And Funded Next has ticked all of those boxes, not only being a top 3 prop firm in the industry, but also having on-demand payouts, and every 10% you gain on your account, you will double your capital for free. And because in this industry, trust and reliability is the most important factor, an important guarantee that they have is that if you do not receive your payout within 24 hours, they will gift you an additional $1,000 to your payouts just for being late. So to unlock all of these benefits and work with a leading prop firm in the industry, Funded Next, check out the link in the description or use the code TOT. So just building off this and also being a bit of a devil's advocate, when you're looking at lower time frame entries, the people that are in the M1, M5, they're looking to time the market, where the direction I think can be learned quickly. It's just POIs and trend. But the hard part to master is that entry, and the reason for that, as you're saying, is for better risk reward profiles. The reason I can see people saying I wouldn't put it at the bottom of the demand area and giving it that breathing room, even though it diminishes the risk reward, is because the reason I got into that trade is because that lower time frame gave me a confirmation or a rejection, and therefore it has that rejections related invalidation. Hence my stop loss placement is going to be the invalidation of that rejection, because it's still going down deeper into the POI. Do you think the struggle therefore becomes or should we even consider how we can time the market, or is it just really playing that supply and demand zone and giving you might be in that trade for a few days before it starts going into profit?
Yeah, I think what you say about so everyone knows where their confirmation is. On the smaller time frame especially, I think I notice a lot more manipulation. For example, a wick will come lower, a candle will come lower and then go higher, and then you'll see the wick form, but that's your stop loss has gone, and then it will continue to go in your direction. Maybe their confirmation is to wait until that's happened or after it's happened or something like that, I don't know. But a lot of the time it might decide to wick lower again, and then it will go up, and then you've lost the second trade, and then it might wick down again, and then it could just be a little bit of a seesaw or choppy price action, as where if you've entered on a 1 hour chart with your stop loss under the 1 hour low or high, depending on where you are, you're in the trade already. You're just you're in your drawdown, and all this stuff that's going on the smaller time frame is happening whilst you're out doing whatever you're doing, and you're not looking at it, because most people lose their trades and can't manage their trades when they're at the charts looking at them. I'm in a trade right now, I have no idea if I'm out or in or whatever at the moment, and I love that because it stops me managing it. It allows the trade to just do its thing. I think people that mess with their own trades go break even too early. It ruins their risk reward. It ruins their ability to scale and make capital. And then when they lose, they're losing more because they're not winning as much. Because the only way you make more money is by paying yourself and allowing the trade to hit the take. Probably got to have also real targets for like realistic target. If you're looking for a 1 to 10 risk reward, I don't think they happen a lot. I like a 1 to 2 risk reward because I know it's a realistic target of a trading range high or low. And I know that realistically price should get there. If it doesn't, it doesn't.
This idea, the reason I asked the question of is it harder to get direction or is it harder to get the entry, is for this exact reason that you said of just price getting flushed, or we can go on a stop loss hunt or a manipulation, whatever the term is, but it's definitely more apparent or more often on the lower time frame. Do you think people should embrace that and say, okay, this is an entry type and I can use it to my advantage, or better, as you're kind of alluding to now in your career, of just take the larger zone and avoid yourself of trying to figure that out?
Yeah, the issue people have is that they they lack the confidence to believe in themselves when it comes to trading, and they lack the confidence to take entries, and they're too focused on the loss, and they're too focused on what happens if I lose, because they're overextending themselves financially or with the time restraint they might have put on themselves. So for example, if someone's trading a funded account and they're not ready for a funded account because they haven't got the experience, or they're quite frankly not good enough for it yet, they're in a trade and they're watching it because they're so desperate for it to not hit the stop loss. As soon as the stop loss is even in the wrong place, or they've forced the trade or whatever, they can't manage it because they've got too many emotions going on in their head. You've got to be emotionless when it comes to trading. You've got to be able to not celebrate a win and also not cry about a loss, because nobody out there can predict an outcome of whether your trade is going to win or lose. No one can tell you the direction it's going to go. You can have the idea and the probabilities. It's a bullish market, so we want to go higher. It's a bearish, we want to go lower. But nothing's stopping the market from just dropping or pushing higher and taking your stop loss. You could have the highest quality setup with the highest, all of the confluences, all the bells, whistles, absolutely everything, and that trade could lose, and a complete beginner could come in and press sell and it could win. But we use these confirmations that we have as an edge in the market, which allows us to look at the probabilities rather than the facts, because the market doesn't give facts.
A sentence that I like to use as a North Star, especially for newer traders, is this idea that just what you said is anyone can take a winning trade, and the guy that's doing all the hard work could take a loss, and a beginner just randomly presses buy and it went up. So the winning trades are a given, and the hard part becomes is eliminating the losses in between. And that could be from psychology, that could be from overtraining, that could be from stop loss placement. There's many reasons for that. But with this idea in mind, I want to hear your thoughts on, if the wins are a given and we can all take a winning trade, we just need to eliminate as many losses as we can, or as many invalid losses as we can. What would be your step-by-step process for trying to achieve less losses in a system?
Risk reward is the most important thing for me to rely on when it comes, because I don't think we should be doing what we can to prevent losses in a term of we have to accept them that they come, because like I said, we have our confirmations that we know play out, whether it's let's say 3 confirmations that you have simplistic. It could be a market structure level that you want price to hit. In that level, you could find a trading range that's going to go hard to give you that move, and then the entry is going to be at a Fibonacci level. That's how I would trade it.
Okay.
If you see it, you enter it with your stop loss below the low if you're buying, and take profit in a level which is going to give you a 1 to 2 risk reward, which is a Fibonacci OTE level, basically. In that position.
Oh, sorry, are we talking here like a fib extension as your target, or is just back to the complete new high?
Just the high of the trading range, this imaginary trading range that has been formed. So if I'm taking this trade, that's met my confirmations. I need the trade to be a 1 to 2 risk reward, because if the trade loses, then I've lost the trade. I can't take that back. But if the trade wins, so if I've risked £100, I get £200 back. So I've made more money through the win. If I take 10 trades, that allows me to have a 50% win rate, which means I'm still making money based off the risk reward. And what that means is it allows you to actually lose trades, and it takes the pressure off having to win more trades, because this whole thing of 90% win rate is not real, in my opinion. I understand people have that right now if they think they do, but I don't think over a year, 2 years, 3 years, 4 years, it's a real thing. I think that you're more likely to get around. I mean, I know traders that can make a lot of money on a 30, 40% win rate, and they rely on the thing of risk reward. And it's being emotionless to just saying, right, I could lose this, and it's fine if I lose it, because I know that mathematically I can't not make money with the strategy, because I know over time the strategy does play out. It's almost like if you flip a coin 10 times, heads is a winner, tails is a loser. It's impossible that it's going to hit heads or tails 10 times in a row, because it's a flip of a coin. It's a 50-50 chance. Well, if we've got a trade which is a 50-50 chance, but instead of, we're now adding 3 confirmations, which actually makes the coin a little bit more weighted towards heads, which is a win. So we know that actually it wins more than it loses, but it does still lose. You have to accept that it does still lose. So it's not about avoiding losses. It's actually, I say it's about embracing them as well. For me, it's about understanding, look, I don't need every trade to win, because I know every trade can't win. There's nothing we can do to prevent it. We can minimize it by making sure that we look for those confirmations and we look for the trade to be what we're happy with. but we have to follow the system. And I think another issue people have is when there is a trade that isn't there, they lose more trades because they feel like they come to the charts to trade. They have to find a trade. They think they need to find something, and if they don't, they'll force something. That's where most losses also come from as well, forcing things that just physically don't exist.
Let's walk through some trading KPIs, key performance indicators, where you have the win rate that we're alluding to here, and a high win rate, extremely high win rate, probably not possible long term, and a low win rate probably has a burden on psychology. So would we prioritize that, or should we prioritize risk reward? Anything above a 1 to 2, or I guess below 1 to 1 doesn't make sense. But then also trade frequency. How many trades per week do you take? Because that influences your rate of return. But then also how much time you have to spend on the screen. And let's say risk per trade. If we were to weigh these 4 things, what order would you have them in terms of prioritizing?
Well, risk would be the most important.
Risk per trade.
How much you're risking. Because, again, the reason people are losing and they're getting upset by the losses is because they're risking more than they actually want to lose. Risk is everything. To make money involves risk. To go and get another job, you've got to leave your job, take a risk and take a leap of faith to go and do it. And that risk pays off. When you invest in something, to make money, to become a millionaire, you've got to take risk. To do anything in life, you've got to take risk. And people don't like taking risk in trading because they're risking more than they're actually willing to lose. So, and I always say there's a bridging gap, in my opinion. When people go towards funded accounts and demo accounts, you can do really well on a demo account because you're risking money that isn't real. But when people go to funded accounts, even though they've done well there, they've proven they can do it, they go to the funded account and they can't do it because the pressure of, oh, I'm risking too much, or I don't like this, or I'm not happy with this, because they don't want to lose. I think that to learn and practice risk, there should be a bridging gap of a live account, like £200, £300, whatever your broker would allow as a minimum. And with that, it's if you invest £500 or £400 and it's not money you care about losing, it's money that if you blow the account, it's fine, and you're risking maybe £5 a trade. If you lose that, it's just it doesn't matter, it's £5. But it's teaching you to understand risk. So when you get to risking £1,000 a trade, are you happy to lose £1,000? Because when you enter this trade, there's no guarantee you're going to win this trade, whether you like it or not. So are you happy to buy this position, whether it's a buy or a sell? It's the same as running a business. If you are buying something for your business before it gets a return, you need to accept that there's a risk it might not work. Your business might not be good. And it's the same with trading. The trade might be bad. And I take bad trades. We all take bad trades. We're human. AI will take bad trades when it eventually comes in, does whatever. Like, it makes mistakes. And the reason I say risk is the most important is because you need to be happy with what you're risking. If you can't risk £1,000, risk 500. If you can't risk 500, risk 200. If you can't risk 200, then you're probably not fit for trading. You probably need to accept that you're somebody that doesn't like risking things, which means trading is not for you, because you got to risk more to make more.
I like that, because a lot of people think trading is for everyone, and I've come to realize that certain personality types or risk tolerances are more catered for trading.
Yeah.
What do you think is an ideal framework for a trader in terms of they've got that temperament to make it in this game?
To be a trader, you've got to be completely acceptance. We got to be obviously ambitious. Everyone's ambitious. Everyone, whether they realise that they are ambitious, and then you've got to be acceptance of risk. You've got to be sensible in terms of have a bit of common sense about you. Understand that. Because again, the reason a lot of people lose is because they get sucked into a lot of these adverts about copy trading and things like that. Very, basic stuff to avoid. But doing it the right way is the most important thing, to make sure you don't. Because so someone that doesn't trade, who is an entrepreneur and someone else that doesn't want to promote trading, will say, no, trading's too risky, 99% are losing. But let's dive into why 99% of people actually are losing. It's because they're investing money they don't have or have without any prior education or understanding as to why they're in it. It's the same as Bitcoin. Everyone buys Bitcoin when it's trendy. It hits the news. Oh, Bitcoin's up. Oh, so what happens? Everyone buys. And people that are making money are buying Bitcoin because they have a logical reason as to why they're buying Bitcoin. They have reason to believe that it's going to enter a bull market or something like that. And trading, if you do it properly, requires no risk, because you can do it for free. You don't have to buy somebody's mentorship if you don't want to. You can go on YouTube. You can look at the stuff. You can look at information. You can go on babypips.com and you can learn for free, and you can trade on a demo account. You can download TradingView completely free of charge, and you can learn all this stuff for free. You can buy a funded challenge, which can have all these deals and all that kind of stuff. So when people lose everything, it's because they've leveraged everything, probably because they're desperate or something's happening in life to make them think, I have no choice but to do this. But they're not traders, they're gamblers, and they have a problem with gambling, which means no, trading is probably not for them.
That sentence of 95% of traders lose, it's true, but it also feels like it keeps people in a hole, when the reality of it is quite liberating. That if you compare apples to apples, if you look at doctors, I'm sure if you allowed anyone off the streets without a degree or anything to start doing a surgery, 95% of surgeries would go horribly wrong. Same for the NBA. Like, how many high school kids want to play in the NBA in the US? Well, probably a lot of them. How many make it to the NBA? I think anything in life worth having has this same 95%. We're just comparing, because the barrier to entry is so low with props and all these discounts, etc., is that anyone can do it. But if you filter it out now and say people that have, given that 10,000 hours, I'm sure the stats are a lot more favorable, which is something to hold on to for the younger trader who is struggling. I want to move on to this idea that you were saying, the trend is something to follow, and zooming out a bit makes it a little bit easier. A narrative I'm seeing online at the moment is everyone should go towards futures, and apart from the spread benefits and the props are cheaper and how much you can scale, there's all these plays. But I think a big reason that people do it is because Forex, a healthy, efficient Forex market, shouldn't be trending in one direction forever. It should be kind of consolidating, because this shows two economies are stable in comparison to each other. Whereas you look at an index, or you look at the strong stocks, they have a baked-in trend. So therefore it becomes easier to follow that trend, and therefore easier to trade. As you are someone who is now recently dabbling into futures or migrating towards, would you say that is the reason you're doing it?
No, I think it depends how you look at volatility as well. Futures has obviously the benefits. I don't see too many disadvantages with trading Forex or CFD brokers, because I've done it. I'm used to it. I understand spread, I understand slippage, I understand all that stuff. I understand the benefits of why futures is obviously there. I don't agree when people say if you don't trade futures, you're not profitable. I've done just fine trading on that. I love Forex. I think for me, I still trade. I trade the Euro futures chart or the Nasdaq. But I think the bigger move, people love the bigger moves, the more volatility, because they get that sort of dopamine hit of the bigger move. But I think you also need to look at the safer move, which I think more is actually on Euro USD, as it can be easier to sell and look for a sell or a buy or whatever in Euro if you know what you're looking at. You've been doing it for a certain amount of years. In the stock market, it could fall 20% with a moment's notice. A tweet from the US president, something to do with the US-China war, some sort of tension, something goes on, and suddenly the stock market's gone, and no one understands why. Not gone, but drops, and no one understands why. That doesn't happen as much on Euro USD or Pound USD, so that's why I call it a little bit of a safer thing to trade. But I don't think it actually matters too much. I have seen the noise. I've seen a lot of people talk about futures, and I get it. I have got a futures account just to see what it's like. I personally, I still prefer trading on MetaTrader. I think I'm just a man of routine.
Same here. There are probably superior platforms, but
MetaTrader's awful. But at the same time, I just know it. I've got this. It can help me with calculating the lot size, and this Forex calculator it's called, and it's really good, and it just shift and T and it trade and it works out the risk. It's perfect. But yeah, I get it, and I don't think there's a right or wrong. I think the people that have a massive issue with Forex, it's like, well, just let them get on with it.
For the last 2 years, a proud sponsor of the show is a top-ranked leading prop firm, Alpha Capital. And for the years that I've been working with them, and the thousands and thousands of viewers, you guys, that have been working with them through the discount codes of Titans of Tomorrow, it's clear for me to see why they are a top-ranked prop firm in the industry. They have also reached a monumental milestone of $100 million in payouts. And with the multiple step plans and the multiple package types they have, there's going to be an option catered specifically for what you're looking for. So you can buy an evaluation account catered to your needs at the most competitive prices, and with our discount code TOT for Titans of Tomorrow, you're able to get the most unbeatable, unmatched prices in the industry with a leading trusted prop firm. And with that being said, let's get back to the episode. What I feel like it is I notice these patterns, and you probably have in the last 10 years, of there's always a new buzz thing. And it's really easy to say, hey, I'm struggling in my way of trading right now. And instead of addressing the issues, there's this new shiny thing that everyone's talking about, let me jump to that. And then you just enter that cycle of uninformed optimism, informed pessimism, and valley of despair, and then jump. And I think this is maybe another one of them, where it was I mean, we could talk about the switch where everyone went towards these strategies, towards ICT, and then towards prop firms, and there's always a new thing to do. Have you kind of stayed in your same lane for the last 10 years?
Yeah, I find it, for me, it's simplicity is key. Once you find something that works, why would you ever need to leave it again? Like the new trend I've seen online, and I actually find it really funny because I notice a lot of quote unquote ICT smart money traders who were peddling their strategy a year ago. They're now combining it with the orb strategy, because the orb strategy is the new trend.
What is the orb strategy? I don't think
I mean, I don't trade it, but I believe it's just a breakout of the first 15-minute candle.
Oh yeah,
and
I see
a retest of it. Big Daddy Max trades it, and he's kind of made that really trendy, and it's brilliant, and he's doing really well with it. But a lot of people are jumping onto this new strategy, and that's fine. They can do that, and I'm not saying this strategy looks like a really good strategy, but I would never sit there and think, right, that looks like it's working really well. That's an opportunity for me. But the thing over there was working anyway, so why do I need to leave what I'm doing there to go and do something new? I actually had a comment. I did a live call to a couple hundred people about a month ago, about 6 months ago now, actually, and a guy literally criticised me, saying, you just teach the same stuff every week. When are you going to start teaching something new so I can learn something new? And I said, because this is what I do. This is what I know and understand. There's nothing else to do. If you're bored, move on. But I'm going to teach you the same stuff I see, and if I come back the next day and it's different, or if I come back the next day and nothing's changed, I've got nothing to talk about. I'm waiting for what I want to be there. I've never ever claimed to know all these different strategies, how the market moves, and I equally don't judge people that make money trading in a completely different way. You've got the girl across the pond trading trend lines, crushing it over there. I don't trade trend lines. And I don't have an issue with anyone that does trade trend lines, because I know that they can work, but that doesn't mean I have to go over and do it. And equally with the whole ICT thing, there's many, I know traders who have made a lot of money trading the way he trades, and I trade the OTE range, which he taught really, really well. And there's so many different ways people could do it. And I think people that say, oh, he's a scam, it's all this doesn't work, I'm going over to this strategy now, it's just because they haven't found their own direction, their own route. I think once you find something, the best thing you can do to scale is stay in your lane, do something, and then do it 100,000 times over, and then do it another 100,000 times over, and really crack that.
You know, even just looking back at the last 4 or 5 episodes that I've done, it's exactly this sentiment where Bobby had on the show, he said he doesn't believe in buy low, sell high. I was like, that's trading 101.
I saw that, yeah.
Another guy is saying that it was Tom Basso. He just makes a market structure range and then just puts a buy limit if he wants to go bullish at the top of the range, and it's just a breakout of a range. No test, no Fibonacci. It's just as simple as that. Even statements from even Brando, one of the recent ones, he just doesn't use a stop loss. It's like all of these things people would say that's a cardinal sin in trading, yet these guys are making it work. And I've just come to accept there's a million ways to make $1 million in this game.
Yeah, that's it. And I think good for them. That's and for me, I think there is. The thing is, everyone's trading a different way. You've got trend lines, you've got supply demand, you've got volume trading, you've got all these different things to just determine whether the market's going to go up or down. It's only going to go up or down. It can't go anywhere else. It can go sideways for a little bit, but it still goes sideways in a direction. All we're doing is trying to find a simple way, a very simple way, to make money. That's all. The game here is to make money. The game is not for the ego. It's not to my strategy's better. I know more than you. I don't care about that. I just want to come in, make my money, and then go elsewhere and make my money doing that. That's what everyone should be looking at. And I think there's plenty of strategies I've tried that hasn't worked for me, but because that hasn't worked for me, that doesn't mean that strategy doesn't work. It just means I didn't get it. And I don't feel the need now to go on to another strategy, because what I do now is working really well, and I enjoy it, and it's simplistic for me. I don't consider myself book smart. I left school with 2 GCSEs, and I have the very strong mentality of, if I can do this, I know anyone can do this. The only difference separates me to a lot of people, a lot of my friends that are trying to do it, is I'm happy to go in and just press those buttons when I see what's working.
Let's talk about longevity. You've crossed now the 10-year mark, and I'm sure there's a lot of moments that were hard, a lot of triumphant moments. But what do you think it gives or takes to have surviving a decade in the market? Because a lot of people want to thrive but don't even survive, let's say. So what does it look like to survive 10 years here?
I think it's accepting that you're always going to be an apprentice in the markets. I still very much think I've got more to learn, and I'm very accepting of the fact that I will learn more. I cringe when I look at my old content from 2 years ago, and it wasn't that it was bad in terms of what I was trying to say, but I've just learned so much more since then, and I'm continuing to learn more every day. I think being a sponge to all the knowledge, surrounding yourself with people that want to see you win, and just accepting that you're never going to be perfect. You are going to make mistakes, the same as anyone in any business, any profession makes mistakes, and realizing that you do have to kind of drop your ego a little bit as well. The market isn't there to get you personally. People think it is, and inevitably most people quit when it gets to the point where they can't afford to go and they've lost too much, and it affects people's mental health, and we've got to look after that. We've got to understand and look after that. And again, the key to surviving in here is to stick to the lane you find works for you. Don't believe everything online, but equally be accepting of the fact that there's a lot online to choose from, because there absolutely is. There's two revenues or ways, you can look at it. Yes, there's a lot of people that don't know what they're talking about, but also, hang on, there's a lot of people that do know what they're talking about. A lot of good people online as well, who could actually provide you with life-changing information. So instead of just criticizing everyone, let's look at, actually, there's a lot of people there that are also giving good value as well, because it's.
What would you say are things to look out for when you, because I think a lot of people are like this, they're a sponge, and because there is no university for trading, let's say, you always look towards online, and there's a million resources now. How do you know, or would you advise someone to say, okay, this is the filter process I need to have to make sure I'm investing my time in learning the right things and not wasting it with let's say a guru?
I think when I talk to traders, the most important thing they can do before they've done a course, before they've followed an influencer, anyone, is to read a book called Trading in the Zone. And once you've read that book, read it again. And then once you've read that book again, read it for a third time, because that is more valuable than any trading strategy out there, in my opinion. Because if you come into the markets with a view of, after reading that book, because you'll look at the markets already differently, of accepting that this is 90% what's going on inside your head is going to be the determining factor to whether you make it in this industry or not. That is going to give you the bigger head start than even learning what a pip is, than learning a strategy, than learning anything. So reading that book from Mark Douglas, Trading in the Zone, it's the most powerful trading resource out there, and you can buy it for £15 on Amazon. And I think that book's got to be your best friend. And I also think in 6 months' time, when it's getting on top of you, read it again. And in a year, read it again. I've got it in my I've read it on the plane. Like, I read it. It's like a Bible to me. And because people cannot understand, it's an emotional sport, and that's the reason they lose. You can pick up the skill pretty quick, and you can sit there and think, yeah, I get this. High, buy, high, sell, high, whatever. Anyone's strategy, cool. Like, this makes sense. But your emotions will completely take over your brain, because people they don't learn how to deal with finances. They don't learn how to manage positions. They don't learn all the stuff that's actually vital towards them becoming a trader, in my opinion.
I want to talk about trading psychology, but before that, I want to get into the layers that create psychology. And something that I interestingly read was people that are born in a certain time where their financial formative years are around a property crash, they are a lot more hesitant to invest in property. Others who were in the financial formative years in a stock market crash, equivalent sentiment. Meaning to say, how you viewed your parents' struggle or your own financial struggle in those formative years really shapes your psychology throughout your career and create these phobias or biases. Have you found that with the traders that you've spoken to, or maybe even in yourself, that you had some deep-rooted beliefs that you didn't really question, but you should have questioned?
Yeah, I mean, it's very natural to follow someone's lead, isn't it? It's very natural to, whether they're close to you, whether it's just someone online, people want to just copy what people are doing as well. And I think with trading as well, when you're doing it for a while, if you learn someone's strategy, whatever it is, you'll find your own pattern eventually. But if you're too fixated on, no, I must do what they're saying because what they're saying must be right, but they're not always going to be right. And I see a lot of people will question, well, they won't question whoever's taking a trade, and they'll copy that trade, for example. But then their own original idea would have worked and theirs didn't, but they took that one because they have no belief that actually they can pick it up as well, and their entry might be different and it might work.
Hey Titans, let's take a quick break to talk about a sponsor of the show. In fact, many people have been talking about it. A lot of noise in the industry about this firm. It is Ola Prime. And before I even consider who to partner up with as a sponsor of the show, I go through a massive due diligence process because I hugely value the platform that we've built and the direction that we're going. Therefore, the most important thing for me is trust and transparency. And a few things that are unique and that I love about Ola Prime is, first of all, they do a 95% profit split, basically unheard of. So whatever profit you make, you keep 95% of it. And most importantly, 1 hour payouts. Your payouts are practically instantly, practically on demand, so that you can really trade, make profit, withdraw it, and continue to trade. And the best thing that I love is that they've given me a exclusive, massive discount to make them one of the cheapest prop firms to work with on the market. So with prices starting as little as $38, I encourage you to check out everything Ola Prime has to offer. And if you use the link in the description or the code TOT, that'll get you the best prices available with a massive discount. And with that being said, let's get right back into the episode. Where would you say belief or confidence in the market comes from versus overzealous, using your ego, trading, with just a YOLO mentality or a casino mentality? What is the correct way to derive this belief and confidence?
Time. There's only one way to get more confident when it comes to trading, and that's by spending time doing it. It's the same as driving. For example, if you drive a car, subconsciously you know how to drive a car after 10 years of doing it. You didn't when you first learned how to drive a car. And it's the same with anything. And I spoke to this woman at my event in Munich, and she asked pretty much the exact same question that you just asked there. And I said to her, and this is a woman that can speak 5 languages, one of them being Mandarin.
Well,
and I've said, you've learned something which is a million times harder than learning how to trade. And how did you get so good at learning Mandarin and all these other languages? She said, well, I just learnt it, time being there. I was like, yeah, exactly.
Yeah.
Because people compare their trading careers to the fact that they've been there 3 months, 6 months, a year. When you're 5 years in, the knowledge you're going to have compared to what you had when you first started, and in another 10 years, you're going to be unstoppable. But they're too fixated on the fact that they don't know it and understand it now. And the only thing you can do is keep spending the time doing it. And once you grab that experience, that's nothing that can be substituted. Nothing in the world can substitute experience. Every failure that you've had, you should be grateful for, because you've learned from that to push yourself further to the next goal, in my opinion. Because there are going to be things now that you do wrong all the time, but you learn from them and you make them right, and you go and crush it again. Yeah. And that's how trading's the same. You got to push it.
I would agree. We recently did an episode and we were trying to define confidence, and then we came up with a way to describe it, and it was to the effect of having a stack of evidence to affirm what you believe will happen. And that can only be done when you've built that stack of evidence, which will naturally take time. And when I look at my own trading psychology as a topic, I've spoken to a lot of people that have various beliefs and various approaches, but in my anecdotal experience, I never sat down and addressed it. I never had a routine or a psychology hack. It was just time absorbed all issues, and I also modified my strategy towards my nature. So I'm quite impatient, so I would be more in the intraday timeframes. I like being right more often than I'm wrong, so then I modified it to have a fast break even. So I've always modified things to me, and psychology with time took care of itself. But with that being said, I've also spoke to a lot of traders that are very successful, and even to this day will meditate 1 hour per day, every day. That's a lot of time to be doing something that I don't do at all. Is there certain tips and tricks or techniques you use to enhance your psychology, or is it just time covers all?
Yeah, I used to. You read it. The thing is, you read a lot of these people saying, "Oh, you need to get in the ice bath at 4 a.m. You need to really gravitate towards focus, and you need to eat your 200 grams of protein every day." I think being focused and if you're too stressed is one thing, but again, you're going to be better. You're going to be so much better at what you're doing in 6 months if you just persist every day and just do a little bit every single day and keep going, rather than if you've had an ice bath at 4 a.m. I don't care if you got up at 4 a.m. That doesn't pay you anything. What pays you is pushing the buy or the sell button. You do an ice bath, do it in your own time. But for me, being online, pressing the button. There's only one way to make money in the market. It's by pressing a button to enter the market. And once you enter it, it's going up or down, and that's going to determine whether you win or lose. You put a stop loss, you put a take profit, you risk what you're happy with. You make sure your take profit's in a safe spot to the point where you get good risk reward. Once you get good at that, you just keep doing that, and your entries will look bad at the start and sloppy. And once you've taken your 1,000th trade, your trades are going to look better naturally because you know exactly what you're doing.
Now, I want to speak to the version of you now, which is, you spent a decade and you've built your wealth and you've built a portfolio. And would you say now things are easier, even though you're traveling a lot and you have the pressure of maintaining a brand and also your reputation, also helping others? There's a lot on your shoulders, but your trading has now potentially been assisted because you have investments in the stock market, investment with funds that can generate you a yield even when you don't trade. And I wonder, does this, because in theory it's like, okay, well, if I don't trade, I still made money, so I don't have to chase the markets. Or is it segmented in your head and the market is the market and you still feel the emotions that you always felt?
No, I'm very emotionless to the market now. I'm for me, it's just generating revenues of income in different ways. The market is one of them, investments another, cash flow another. But I'm emotionless if I lose or win a trade. I don't sit there and celebrate a win. I don't sit there and get upset about a loss. For me, it's just looking at a vision, a plan of, right, this is what my goal for 2026 is. This is what I want to do. And being passionate about that goal and understanding that it's just a process which needs to be happening to create more wealth or to help more people or to do the generational thing and help family. And everything I'm doing has got a plan behind it. Everything I do is doing it for a calculated reason. My opportunity to look at the markets is a very blessed skill because I know I don't need a sales pitch to be able to trade. I don't need to employ people. I don't need a boss. I don't need customers. I don't need inventory. I don't need a website. I don't need anything like that. And if all my businesses went completely bust tomorrow, I'd have the skill in my head of being able to trade. And that's where trading is one of the most important because it's you against you. And once you've conquered that, you're able to go and do anything with the markets because it's in your head. Once you see it, you can't unsee it.
Yeah. Let's speak about prop firms because I think the sentiment of this from earlier was let the capital do the heavy lifting, but the hard part is getting the capital and then emotionally adjusting to it. Would you say prop firms now in this era is the best route towards that?
Yeah. Do you know, the thing is with prop firms, they're brilliant. They're evil to some and to a lot, but they're also brilliant because there has never been an easier way for someone who doesn't have the money to come in and make money for a prop firm, as long as you understand the rules they set in place. I was with some students today and we were talking about this, and there was this news factor of you can't trade 2 minutes either side of news, and what happens if my trade has been taken within 2 minutes without me knowing. And I said, well, if there's a news event at 8:30 Eastern and you're not allowed to trade 2 minutes either side of it, that means that you stop trading, you're out your positions by 8 a.m, so you can't get in the way of that. And then you don't trade again till 9 a.m. Eastern. It's a very simple thing to do, just to not trade in that specific event that's told you you're not allowed to, and you've already found the loophole around that rule. Don't worry about it. Again, over leveraging, a lot of people are doing. A lot of people can make so much money off a prop firm, and there are so many proof concepts of that, to the point where all they've done is follow the rules. You look at JCap on Apex, unbelievable what he did. He just followed his rules. He just followed his rules. His strategy, his concept, everything he's doing, everyone understands it. You talk to what he does. He's just got a tunnel vision. I know what I'm doing. I'm going to follow the rules. I accept the risk I'm doing, and he can scale and scale and scale. And when he breaks down all of his setups, you think, oh, I could do that. Well, go and do it then. Because he's proven you can do it. And it's utilizing prop firms. And the reason people lose on the prop firms because they don't follow the very simple rules that are there. I understand some prop firms are quote unquote dodgy and they look for the cheaper ones, and I know there's been a lot of controversy, but all you need to do is learn the skill, then do your due diligence on a good prop firm, whether it's Apex or FTMO or whoever, and then you go down that route of saying, right, all it is now, this is a business, my head is I'm regimented towards whatever this rule-based thing is with the prop firm. I know where the violation is. I understand. I just need to get paid And then I think with a prop firm, it's a starting point. I don't think it's necessarily there to take you for the next 10 years. I think it's there as your starting point. So that's what happened with me. And I don't really feel the need to go back to a prop firm now, because I think compounding, cash flow compounding into a trading account is the better way forward to do it. But that's not a starting point. This is just where I am now. So yeah, prop firms are great if you know how to use them.
What would you say is the right time to walk away from a prop firm, or just prop firm trading in general? The reason I say this is because the prop firm enhances a gamification approach, and that can also instill bad habits for when you do pivot to a personal account. But also this idea of the guy who wins in the casino is the one that makes a bit of money and knows when to walk away, and the other guy might win a lot of money and then slowly bleed out and get addicted to it. And I think prop firms can end up like that for a lot of people. I think that's why you said it's evil for some.
Yeah.
When is the right time to walk away? Is it a dollar amount, or is it time, or is it just when the rules stop getting favorable for the trader?
I think it's subjective. Well, I don't think, for example, Jacob, I don't think he's allowed to go back into prop firms again.
Yeah.
So I think when you make a certain amount of money, I think they're not going to let you in. It's the same with the casino. If you make too much money, they don't let you in. If you make a little bit at the start, they turn around and say, yeah, come back, have some dinner, have a sweet.
Yeah.
You make too much, they say, no, get out. And it's very subjective to the individual as whether they think enough is enough, how many prop firms they want to go and scale, how much, if they're comfortable with, actually, I don't ever want to risk my own capital, I would rather just leverage prop firms. There's also an argument to say you could leverage prop firms as a cash flow business when it comes to trading, and your investment is your live account that you're compounding over time. Because if you keep paying, if you're using trading to pay yourself all the time, then you're going to grow your account slower at the end of the day. If you let it compound over time and let it build, then you're going to have the time to build that wealth. And prop firms, obviously, you can't do that because you need to pay yourself. Otherwise, it's only a matter of time before a violation does come and get you. But it's subjective to the person.
If you can, Tom, walk me back to a time where you had a real struggle in the market, or a period in your trading career, could even be recent, where you thought, okay, my luck is run out and maybe I have to do other things.
For the first 5 years was really, really a struggle. I think it was bad to the point where I didn't tell anyone how bad it was. It was, you do the normal stuff, the strategy hopping. There was one particular person I put a lot of trust into who was trying to help me learn how to trade, and said, I will trade your capital for you. And I lost £50,000 just on the spot. It wasn't even £50,000 I had. I had to find that £50,000 in another business I was trying to do at the same time. And it was just all gone, and there was nothing I could do. And essentially it was as rock bottom as you can physically get. And it was just my own negligence which got me there. And I'm not saying everyone should go through it, but I think everyone will go through something like that. I'm not saying financially, but emotionally, where you just put your trust in the wrong person. It's equally how I looked at it for the first few years of trading. Is I was looking for someone to trade for me. I was looking for signals, copy trading,
the easy way,
all that stuff, because I thought, oh, I can't do it, I'm just going to pay someone else to do it. And I think following too many people online who were perceiving to teach it the easy way, or trying to chop and change around, the only time it really started clicking was when I just stayed in the lane and started to focus on the one thing in there. And then where I neglected my mindset, I used to avoid the mindset videos like no tomorrow. I thought, oh, I'm not interested, I just want to know the entry. And I would avoid all of the videos about mindset. So like, for example, if you look at some YouTubers, their most viewed videos will be when they talk about the entries. It won't be all the stuff before. If you look at ICT on YouTube, his most viewed video is his 2022 mentorship, where he talks about the specific entry. People are ignoring the month 1, 2, 3, and 4, which is actually his most valuable stuff, because they're not sexy and cool. And I followed a lot of that because it's normal to, and everyone does. And it was, the issue I then had was losing a lot of money at the start. I became reliant on a time, like for example, it was either go into liquidation with the business I had, go bankrupt, no one knows this, no one is aware of this, not even my family are aware of this, or suddenly it just sort of starts to click, suddenly it just starts to happen. And there's only one thing you can do, and it's just keep going. Or you can quit, or you can keep going. And I just didn't quit. And I've never quit anything I've ever done. And I never will quit. I've made a lot of mistakes, and I will continue to make mistakes as well. And now the difference is I embrace those mistakes.
Did you ever have an environment around you, especially in these 5 years where things are not working out, of a crabs in a bucket mentality, where it might not even be on purpose, but like when things are not working out and you're making the sacrifice for time and you're skipping on socializing and whatever, that friends, old friends, maybe are like you wanting you to retreat back to the comfort zone that would not end you in the position that you are now?
Yeah, all the time. Like, there's no such thing as a perfect time to do anything other than yesterday. And if it wasn't yesterday, it's right now. It's the industry that we're in. I mean, you probably know at the start as well. It's not an industry anyone can get on board with. So you don't get the natural backing of, I'm going to go and get a job and do this, and this is the progression I'm going to do, whatever. It's, I'm going to learn how to trade. They're like, what are you talking about? What even is that? Why would you do that? And when you don't have any support, it can be a very lonely space. And when you're just in front of a laptop and it's all going one way down the pan, everyone just thinks it's only a matter of time before it implodes. And then when you don't have people around you that love you, support you, and want to see you win in that space, you sit there and you think, I'm at the bottom of a well and I don't know how to get out of it. And there's only one, even if I try and climb, I just can't. And you just think, where do I go from here? But you find a way. You find a way.
Do you think trading should be taken as this lone wolf, like warrior, figure it out yourself? Or do you think people around you, whether it's friends or family or even just online trading buddies, a community of sense, is conducive to a positive outcome?
No, I think you need people around you, whether it's trading, even if it's not trading, it's someone that understands what you're trying to do. I think if you don't surround yourself with people that want to see you win, you're at a huge disadvantage. A lot of people don't tell people, like someone's training, I think a high percentage of people wouldn't tell somebody or their friends, their closest friends, that I'm learning, I'm trying to do this, because they fear what they would say about it. Like I had 25 people come today from my mentorship who said they're so thankful that they're now in a room with people that they can talk to and learn from. And that's what I wanted to do. That's what I wanted to build, because for me, it's the loneliest industry in the world, because it's just you. But now, and to meet a room of traders, to meet a room of people that have the same ambition as you can't replace it. And even if you meet someone that doesn't trade the way you trade, or doesn't trade the same time frame, or even doesn't trade, but it's just an entrepreneur, if you put yourself in a room with someone that just gets your vision, gets your ambition, gets your line of thinking, what you want to actually do, then you're going to be able to get, in return, confidence. And if you get confidence, you're going to be able to start believing in yourself a little bit more, because when you're lonely, you've got nowhere to go, no one really wants you to do it, no one knows you do it, and you are low on confidence. Who are you going to turn to help get you out of that rut? It's hard.
To conclude the episode, I think you've had your hand in helping thousands, maybe even hundreds of thousands of traders. If you can give some lasting advice in your experience of helping many and your own experience, what would be some North Stars to focus on to make it in this game?
I think if someone wants to be a trader, and if someone wants to really, really stick at it, they have to understand it's about doing it 100,000 times over and over again, and understanding repetitive nature is key. Because the only way that trading doesn't work out for you is if you stop doing it. And the only way this whole thing turns worthless is if you stop trying. But naturally, over time, the way your body will evolve, the way your memory and brain will evolve, it will allow you to become stronger every single day. And it will allow you to pick up skills every single day. And don't look at it from I need to get better next week. Look at it from in 6 months' time, I'm going to be good. In fact, in a month's time, I'm going to have so much more knowledge than I have right now. In 6 months' time, I'm going to have an incredible amount of knowledge. In a year, I'm going to be really where I want to be. And then in 10 years, I'm going to be unstoppable. And then I'm going to really never look back. But at that time as well, you're always going to be realizing that you are 10 years away from where you want to be all the time. Never be satisfied with where you are. Like, I don't sit here and think I've done well. I sit here and think there's more to do. There's more work to do. And I'll always think like that. And I'll always be 10 years away from the version I want to be. So when I get another 10 years down the line, I know the knowledge I've picked up is going to help me scale even further. But now I need to keep going because it's nowhere near over. And
that's why we call it Titans of Tomorrow, because there's always another mountain to climb, no matter where someone is. But yeah, Tom, thank you for the time and opportunity. And
thank you.
A lot of wonderful advice.
Thank you for having me.
Thank you, man. There we go. Boom. Brilliant stuff. A trader with 15 years of institutional trading and an additional decade managing institutional teams.
Losses loom larger than gains. When people are faced with big holes to climb out of, there is a need within them to try and recover as quick as possible. That's not the right behavior for trading. You're not trading well to get to this point. So why is it right to start fighting to get back when you should be reducing your size?
James Thorpe, a professional, seasoned veteran within the futures markets. And in this episode, we explore his experience managing teams of hundreds of professional traders, going over their strategy, risk, psychology.
I try and steer away from the belief that you need to eliminate all your emotions in trading. I feel like that's an unfair ask. One of the big things that gets people into trouble is having the wrong. You can't predict the future. What you're trying to do is trying to think 1 or 2 steps ahead of what the market is doing. Is it price long? Is it price short? Is it panicking? I always found it very useful to play through these what-if scenarios. Doesn't mean I got it right, but it meant that I was prepared. It just backtracked on tariffs. Instead of like, what does that mean? I've got a game plan in my head. I'm going to go for it. Rather than having to think through the scenario. Now I want to put that position on, but it's too late because now the market's moved. In 2010, I moved to Shanghai to manage a professional trading group. It was just about breaking even. I was kind of bought in to help knock it into shape.
What was the needle mover that you took it from a break even to profitable? As you mentioned, there's technical, there's fundamental, there's risk. What was the things that you found beneficial in application to profitability?
That's a good question. I think
you have professional experience with real prop firms and large capital and multiple continents, and now kind of delving into the retail space also. With the experience that you've had working with many traders from both sides, what is the big difference you see between the behaviors or the resources or the access to information that a professional trader and a retail trader would have?
that's a very big question. One specific part that you asked there, what's the difference? The access to information. And I think this is interesting because as a professional trader, I traded for 15 years. And when I was struggling or found it difficult in the market, I always felt like somebody, like maybe a hedge fund or a trader in a bank, would have more information than me. And then having worked with banks and hedge funds, I've also found out that those traders feel like someone has more information than them. And of course, the retail trader always feels like everybody has more information than them. And I think this is a bit of a myth to that when you sit on a bank desk and prior to the change in proprietary trading rules in the UK and Europe, I think around sort of 2010 to 2012, bank traders will obviously have customer flow, so that would help them give the edge. But generally speaking, everybody's looking at the same prices on a screen, right? Everyone's looking at the same charts. And so I think there's a belief that people are always in the dark, and it's not necessarily the case. It seems to me that every trader, no matter what level they're at, retail, professional trader, bank trader, hedge fund trader, always feels like they're missing out some information. Yeah,
definitely a misconception on my part then.
Yeah.
In which case, what advantages in general does a floor trader have? Because if it's not necessarily information, I'm sure then it's the environment, whether it's less responsibility of risk or access to teams of information, so individual responsibility is diminished.
Yeah.
Are there certain advantages you experienced in the professional side that a retail trader doesn't have?
Yes. So I would call that the difference between that, and this is the challenge for a company like mine, Trade Day, that services retail traders at home. And the difference I feel is like active management versus, if you like, passive management. So if you're working in a trading room, if I just take a step back and paint a picture for you, in 2010, I moved to Shanghai with my family to manage a professional trading group. There was about 50 traders in there. It'd been operating about sort of 2.5 years. It was just about breaking even. It wasn't really making any money. And I was kind of bought in to help sort of knock it into shape, right?
Okay.
introduced the training programs, a more rigorous risk management structure, help with recruiting, operations, everything from the top down. And what I found, what we would do is we would have a desk of new traders, and on that desk of new traders, we'd break that down into 6 guys, and we'd have a more senior experienced trader sitting with them. And then we would have meetings every day with the whole team. We'd have, meetings every day with the whole group, and then meetings every day with the team. And then probably once a week, I'd have a meeting with the senior trader that was sitting with the 6 juniors to go through each individual's trading, what's their strengths, what their weaknesses. Are they ready to take on more risk? Should they be taking less risk? Should we move from live markets to sim markets to live markets? This very active way of managing traders. From what I do now, which is I run an online prop trading firm, or as we like to call them in the United States, an evaluation service provider, you can't do that. You're providing a service. So what we do is we create a lot of coursework to help traders with what I call the 4 pillars of becoming a successful trader: risk management, psychology, technical analysis, and fundamental analysis. And we create coursework around that, but we can't necessarily mandate the trader take that coursework. Right. So what we try and do is we try and nudge them along, particularly when they've made it through to our live trading team, and we're really trying to nurture them at that point. We would, be a bit more proactive there. But again, you're very much hands off, and it's very much passive. And for the trader at home, it's very much a lonely world, right? You are your own risk manager. You are your own educator there, and you don't know where that information or where you go to get that information. You don't necessarily know if it's legitimate or not.
It's also interesting because I imagine in the professional space, you have kind of cutoffs where at a certain risk tolerance or at a certain lot size, let's say, or contract size, if you want to act more, you can't. So these behaviors of fear-based trading, revenge trading, or greed, you can't express them even if the trader maybe feels it. Whereas in an at-home environment, it's free reign, which is probably to the detriment of many. When you were relocating from the UK, I guess, to Shanghai, and you were brought in, it was a break-even, firm, what should we call it? What was the needle mover that you took it from a break-even to profitable? Because as you mentioned, there's technical, there's fundamental, there's risk. What was the things that you found beneficial in application to profitability?
Okay, so I would say there's probably 3 elements to that. The first one was probably luck and timing. Really? These guys have been at it 2 years. I don't want to take all the credit. The second one probably was what I found. There was a very strong focus on technical analysis. And I see that today in retail traders. And when I do mentoring with retail traders, there's a very strong focus on technical analysis to the detriment of other more important aspects of trading. And I've seen many career wasted by traders looking for answers in charts. And, you'll have this conversation. I mean, I went through this journey myself. I traded for 15 years. So, everybody goes through this journey. But it's like, if I can just change that time frame, perhaps if I just, change that calculation, this will, increase the probability of me being right. And it's just this continued focus on technical analysis at the expense of things like psychology. Right. So like one of the main things, the 2 main things I brought in, I would say risk management and psychology. And we spent a lot of time, I spent a lot of time talking about how I handled my losing days, how I handled scaling up, how I handled my emotions with the traders. And I think that started to have a real impact. And then the other thing I found was even in a managed environment, the traders were over leveraging, even the new traders.
Wow.
And it doesn't sound like much, but a trader had been with us sort of 3-4 months and was struggling to make money, and they're sort of trading 5 and 6 and 7 lots. And it's like, why are you trading 5 and 6 and 7 lots? You're not making any money. And what you're doing is you're digging a deeper hole, a bigger hole for you to get yourself out of. Let's step back. I mean, I used to draw a picture of a swimming pool, like a profile of a swimming pool with a shallow end and a deep end. Okay. And you guys are all flailing around in the deep end. Let's move you back to the shallow end so you can touch the floor. Just trade 1 and 2 lots. Take the pressure off yourself, right? Make the education curve or the length of time that it's going to take you to sort of get to a break-even trader and then become a successful trader. Let's make that cost of that lesson, that length of time, as little as possible, so you're not facing big losses to recover from. And that's the way I was taught back in '94.
Off the back of this swimming pool analogy, whether you're in the shallow end or the deep end, the best move, all you have to focus on is just treading water, staying afloat. And in a trading environment, whether you're in a huge drawdown or a huge winning period, you just gotta, what's the next chess move? What is my next play? And that's just an individual decision and then a cumulative effect. Why do you think the environment of I'm losing or I'm on a hot streak can influence that individual behavior when everybody knows I just need to follow the plan? Why does it become so difficult to follow the plan based on the environment of the situation?
Yeah, it's a good question. I think it's human nature. And there was a paper, and I'm going to butcher these names now, but it's by Trersky, and I can't even remember the second gentleman who wrote this paper together, but it essentially, I believe it was called something like Losses Loom Larger Than Gains. And it's the pain of losing is twice as painful as the pleasure of gain. And I think what happens is that when people are faced with big holes to climb out of, the only way they think they can recover, or there is a need within them to try and recover as quick as possible. And that's not the right behavior for trading. That's a toxic behavior. That's over leveraging. I mean, if really, when you look at it logically, you're not trading well to get to this point. So why is it right for you to start scaling up and get, fighting to get back when you should be reducing your size? And so I think that's kind of like it's something inherent in our nature that causes most people fall victim to that. Even successful traders fall victim to it as well. A successful trader, I feel over time perhaps falls victim to it less often, is more self-aware and knows when it's happening, and eventually can control themselves and take the right behaviors to overcome it. But we're all human, we're all subject to our emotions.
I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry, and in the last year they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there is going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital. I think this whole idea of just loss aversion is maybe a survival mechanism that we perceive the threat of losing money as a detriment to our existence, let's say, because finance, obviously, especially livelihood and so forth. Do you think as time goes on, or as a professional trader develops in his career, it's more a immersion therapy, you get desensitized to that feeling, or is there a protocol to follow to kind of manually override that and be in a stoic place, especially when you were guiding traders on the trading floor?
Yeah, that's a good question. I do try and steer away from the belief that's commonly held that you need to eliminate all your emotions in trading, because I feel like that's an unfair ask of people.
Because we're human in the end.
Because we are human, right? And we're driven by our emotions. I think it's about emotional state management and how to cope with that. And one of the big things that I think gets people into trouble is having the wrong expectations about trading, about their own performance, about their own P&L, and this need or drive for perfection that simply doesn't exist in trading. So I think kind of like, those are the sort of like the key markers that a successful long-term trader is aware of. Again, still subject to their emotions. I was we used to have a thing in England called a schoolboy error, meaning, you were making a mistake that you should have learned in school. And I'm 15 years into my trading career and I'm still making it. I think the difference is you're making them less frequently. And when you do make those mistakes, you have the tools in your toolbox to be able to recover.
When you were working in the capital management, what kind of assets under management were you responsible for?
So it wasn't capital management. It was proprietary trading. So what happened was I was a broker for about 4 years, and then I traded for 15 years. Part of that was on the floor from 94 to 99. And then in London, the floor closed. And from 99 to 2009, it was in different institutions, and it was day trading. It was proprietary trading. I was backed by someone's capital for the most part of that time. And it was, some swing trading, some position trading, but probably about 80% sort of day trading. And as I said, trading in professional institutions, so not retail from home, in trading rooms. And then from there, I worked for an exchange for a couple of years. And then after that, I went back to trading, but it was managing professional traders in trading groups. And these were proprietary trading groups. So the group was trading its own capital. It wasn't assets under management and things like that.
I'm very curious to know the archetype of a candidate that either you were looking to hire or within the team that you had, of who you'd identify as a key player or someone that you might give more allocation towards. Was it personality driven, or was it more, I guess, as responsible for risk, you were also identifying he's a great trader but he's on a hot streak, he's getting a bit overzealous now, or this guy's a great trader but he's just a bit too fearful, and kind of orchestrating it from the top. What kind of thoughts would you have, or personality traits would you see, or assessment of risk?
Yeah, it's interesting. The leading driver, I would say, would be performance. Certainly not personality driven. And in fact, that was one of the things we would drive home in our recruitment drives. Would be, one of the great things about being a trader is, you don't have to suck up to your boss. As long as you're turning in the performance within the risk parameters that are set for you. You can be an introvert, you can be an extrovert. You can have any sort of personality type. What personality types would we look for is a very good question. We would hire around 250 graduates from China, Eastern Europe, India, and for a short time in Africa, just from top universities there. And we would put them through our training program. And over time, after about sort of 5-6 months, you might lose half of them. After about a year and a half, you lose a half again. And our success rate was around sort of 20% of the people that came through our door would go on to have successful careers as traders. And out of that 20%, we were desperate to try and identify what were the common threads going through those 20. And I think for any trading institution, it's like the holy grail. If you can identify at the interview stage who's going to make a great trader, you're going to have a great company on your hand. And unfortunately, you just can't do that. We spent hundreds of thousands of dollars trying to do it in developing isometric tests, taking a look at our top 10 trading performers, what's the common thread that runs through them, and trying to sort of design recruitment programs around that. And, it just didn't work.
Was there some commonalities?
There are definitely some commonalities, but I don't really think, when I think about them, that they are any different to what it needs to succeed in any form, in any job. So, we would look for people who worked, who demonstrated a very high level of focus and were willing to work hard. I think, there was kind of a sort of a loosely held belief that people who excelled at solo sports, like marathon runners and swimmers, because the theory was they were self-starters and self-driven and self-improving, and all, this is trading's, you might be working on a desk in a team, but it is really a lonely pursuit. So that kind of made sense. But, trying to sort of identify specific characteristics around someone's personality was
it does make sense, because trading in the end is very almost entrepreneurial, and you do need to have high stress tolerance, a bit of resilience, intrinsic motivation, and these are just common traits for success. So I can see where you're coming from.
If I may jump in, because there were a couple of things in personalities that we didn't particularly hire, or in people that we didn't particularly hire. One of them was we steered clear of PhDs. Now we were hiring, graduates and masters, but we found that when we hired PhDs, there was a tendency to try and over-intellectualize the market and try to over-analyze it and trying to make the markets rational, and they're not, So they were we found that generally, not everyone, but generally, they were difficult to train, and people who were arrogant or came in and had a lot of experience in trading and felt that they knew it all, they were very difficult to train. And I think what that speaks to on that second part is that it's important to have a level of introspection as an individual when you trade, because there is a lot of work you have to do on yourself, and you have to identify your weaknesses. What are you doing wrong on a day-to-day basis? How are you going to try and fix that? Can you try and fix that? Those types of things.
It's an interesting idea, because the more academic someone is, or the higher the IQ someone may have, it's maybe a presumption that they would excel in this environment. But I was in university for 6 years, so the academic life I was very familiar with, and in that sphere, you're kind of rewarded for passing an exam, let's say. So your feedback loop is, if I fail an exam, let me just go study more.
Yeah.
So you kind of try and intellectualize towards passing.
Yeah.
In the markets, if you do that same loop of let me just study more, let me just figure it out more, it's not conducive towards more profit, let's say. So it's interesting to hear that. It's not necessarily a correlation. What about
just one other thing on that, because there might be some people in the comments going, well, what about, I know PhDs that do very well and stuff. What I'm specifically talking about is discretionary trading. And, particularly individual discretionary trading, proprietary trading. You take a look at a company, probably one of the most, if not the most successful trading groups in the world, Renaissance Technologies, that's made up of only PhDs.
Yes.
That's a different type of trading. So
I think they were more developing systems. It was not discretionary trading.
It's much more quantitative, automated, high frequency, that type of.
It's a nice parlay towards what was your experience with the algorithmic trading side and developing those systems?
Yeah, so we spent quite a bit of time at Mercury, which, depending on where we were in the recruitment cycle and hiring and firing cycle, was usually around sort of 750 traders. And most of those are trading discretionary. But we wanted to sort of leverage off the intellectual capital we were bringing into the company. So we were hiring mathematicians and engineers and see if we could build automated trading systems. I was with them from 2010 to 2014, which is really when this type of trading was starting to gain momentum throughout, certainly futures trading, and throughout the US and Europe. And we managed to successfully build I say we, well, it wasn't on my shoulders. There was a successful team out of Israel that had about sort of 3 or 4 core guys with about sort of 7 or 8 support guys around them that developed an algorithm that traded interest rate markets, so yield curves across interest rate markets. And in the end, it was doing about 30% of our volume. So, I'd say a team of sort of 6 to 10 people were doing 30% of the volume that we were doing of 700 traders.
Wow.
So, I witnessed the growth and the success of that. Fast forward some years later, I was in Chicago and hired by a smaller proprietary trading group that was doing some automated trading, some discretionary trading, what I would call sort of black box, grey box, and discretion. And I was brought in to help them develop their automated trading. And I kind of really didn't appreciate, one, how fast the space was moving beneath us, and 2, the sort of financial runway we would need in order to compete. And this is sort of around sort of 2016, 2017, moving into 2018, when a lot of the high frequency, low latency strategies were moving into the single digit microseconds for execution.
Wow.
And then, believe it or not, There were, some very well capitalized firms, and these are the ones that survive today, like Jump Trading and DRW and places like that, who were looking to try and shave nanoseconds off order execution. So, I kind of had a bit of a front row seat to that. We never managed to make a success of that at the smaller firm that I was with. I still believe that the firm out of Israel is still operating today and doing okay. I'm sure they're have found it increasingly difficult over the years with the level of competition and things.
So interestingly enough, yesterday I attended an event here in New York, and it was a quants event.
Yeah.
And we're talking the smartest minds in the city, and it's just people that are deep in AI, large language models, quants, physicists, and they're all in the finance sphere, hedge fund managers. It was an insane environment. Yeah. And I could see all of them very passionate just about AI and algorithmic trading. And it seems like discretionary trading was not even a thought. It was this was the future. I caught one of them at the end of the event, and I was asking him about what is his views on the future of it. And he said, well, the ability to make profits in the market is because there is an information gap, and you're exploiting that information gap, because I think I'm going to buy it today knowing that someone else will buy it at a higher price. Right. So algorithmic trading, in the short term, you have an edge, but then as more AI gets involved, this gets squeezed, and then it kind of cancels out. So he was theorizing that it's almost like a pendulum, where there might be periods where algorithmics are doing very great because there's a gap there, and then they slowly get squeezed out, and then it's back to just flat markets and kind of cyclical. Is that something you experienced, or any comments on that thought?
Yeah, I think he's wrong. I think there's room for every type of trader in the market, and there always will be. And I'll just explain why I think that based on my experience. So when I started on the floor, we were very much market making, bid and offer, trying to sort of like take a tick out the market and scratch. And that carried on to my off-floor trading on the screens, legging in out of spreads, trying to take, I was manually, basically high frequency trading, but manually with a mouse initially in the early 2000s. And eventually that edge went away. Why? Because algorithmic trading, quantitative algorithmic, high frequency, or let's just bucket it into automated trading, came in and was able to do what I was doing manually faster. The calculations, the execution, and without emotion. And for me, that was like, oh, this is it. This is the end of day trading for discretionary traders. And then, I actually, around that time, I left and joined the exchange. And that role took me into business development around the world, talking to different funds, different trading groups, different banks around the world, trying to drive more interest in the exchange's products. And in that role, I started working with proprietary trading groups out of China, India, Eastern Europe, and Israel, and places. And there were people making money, discretionary trading. And, I just came to realize that my edge had been eroded, but there was still edge in there for discretionary traders, And, today we have someone in our live trading account who's discretionary trading, and, he's up 150,000, and he's been consistent in his approach, and he's grown that account well. And, and he's still managing to do it today. So I feel like there is always opportunity. And somebody used this analogy, and I quite liked it. I don't know how good it is, but I quite liked it. And that the market is almost like an ocean. And at different levels of the ocean, on the surface all the way down to the bottom, you have different ecosystems. And within those ecosystems, if we're looking at trading, different types of trading exist. So at the top, you might have long-term asset management or discretionary global hedge fund, global macro hedge fund trading. And at the bottom, you might have low latency, algorithmic, AI-driven quantitative trading that's market making in fractions of a second, trying to take, well, it's not even a tick. Some of these strategies are like quarter or an eighth of a tick out the market, because they do multi-leg strategies, scratch, and the cost of that reduces the value of the tick all the way down to a quarter or an eighth. Wow. And if you're a discretionary retail trader and you try and swim up and exist in the top part of the ocean, you don't have the deep pockets to run a position offside for 2-3 months like a hedge fund might be able to. If you swim lower, you can't exist in that ecosystem because you don't have the infrastructure, the speed, the strategy maybe, or even the cost of trading. These high frequency firms have memberships at the exchanges that reduce the cost of trading. that high frequency firm might be doing favors to that exchange, making liquidity in illiquid products that they're trying to promote in return for fee credits. So they're trading at very, very low cost, and you can't compete with that. And this is like kind of one of the things that I try and drive home to our traders, is that I see a lot of retail traders really trying to scalp. And what they end up doing is, it's a little crude, but they end up like feeding like a chicken but shitting like an elephant. And they'll pick up, or some people used to say, picking up nickels in front of a steamroller.
Yes.
So you're scalping, you're taking a tick, 2 ticks, 3 ticks, and then all of a sudden,
losses.
huge losses. Or that strategy is nowhere near as profitable and can't be run as profitable as somebody in a professional trading group, because your round trip fees, your commissions in futures are much higher to the retail trader, and the professional trader is trading at a fraction. So if you can't compete with them. But there is part of that ocean you can compete with other retail traders, swing traders, whatever it might be. So there is room for all types of trading, and I believe it will remain that way.
I finally have a special offer to share with all of you from the US, or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader8 and Ninja Trader that are compliant with CME regulations. With the largest end of day balance drawdown in the industry, a 90% profit split and same day payout. And with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry, to make this a home run offer if you are a futures trader. There's two things I may infer from here. I just want to see if it's correct. Number one, you said you had an edge and over time it decayed.
Yes.
And that maybe is because you were at a certain level in this ocean.
Yeah.
Or it might be just a law of the market. Do you think at certain points your strategy has to change? It has to pivot? Or
all the time. Yeah.
It's not something like, I've got a strategy today and I can rely on it forever?
Yeah, no, absolutely, 100%. Again, I'm just drawing from all these analogies that, people have shared with me over the years. One of them, somebody said to me, trading's like a flu virus. You think you found a vaccine for it, and all of a sudden it will mutate into something else.
I like that.
Right? Mm-hmm. And that is trading. And as a trader, it's your job to continually evolve your trading, and it is a very, very hard thing to do, because when you found something, an edge that works for you, you want to exploit it as much as possible and do nothing else. And when you're struggling, now it's really hard to change your strategy and evolve it, right? Because is it just the market condition that's changed? Is it going to come back? Have I changed? Has my edge eroded? You're asking all these questions. So it's very difficult. And I think, for me, I look back, I traded for 15 years. And in my last year of trading, I was still making money, but my peak had been 3 years before, so I was making progressively less.
I see.
And there's a funny anecdote behind it. I am married, Tara. She was trading at the time, and she was she was pregnant, so she was quitting trading, and she was like, we're about to have a baby. One of us should get a proper job, like a regular steady income, and so that's kind of like why I quit. But 15 years is a long time, and I was kind of getting burnt out of like having to reinvent myself and try new things. And I think that when people talk about burnout in trading, I think that might be part of it too. But you're absolutely right. Trading evolves, markets evolve, you change, your risk profile changes. What would have been tolerable and acceptable to you in your 20s might not be the same to you when you're in your 30s about to have your first baby.
I want to understand, this comment makes total sense, but I want to see how someone can actually apply the logic, because I can see both ends of the spectrum where someone might be micromanaging and starting to micro change their strategy on a weekly basis because of some bad losing period that was acceptable losses, versus someone might prolong it and drag it out. How do you assess my edge is decaying versus this is just a low period that is factored into my edge?
Yeah, I don't know the answer to that, I'm afraid. That is a really good question, and that is part of the challenge of a trader. I think a good story. A friend of mine, she was trading successfully for about 15 years, and she said, she would have 3 or 4 losing days in a row, and go, why do I feel I can't do this? I've got a 15-year track record, 4 losing days in a row, and I feel like I can't do it. And I completely related to that. And, and I know that I've vocalized that myself, a number of times.
Would you attribute that more to then psychology, just life changing?
Yeah, well, that's the psychology of trading. And that's like kind of, down to the uncertainty but having, I think, lived through also, as you say, a number of cycles of having to reinvent yourself. And is this the start of one of those, or is this just a quiet period in the market and my strategy my strategy works better in certain conditions?
Yes.
And I think one of the things you can do is, when you have a strategy, is ask yourself continually, why does this strategy work? What does it rely on?
Okay.
Is it something as simple as it works best in bull markets? And then if it stops working in a bull market, then perhaps that strategy's edge is going. But if you're suddenly in a bear market and it's not working, then, maybe it's not time to change your strategy. Maybe it's time to stop trading that strategy or trade smaller, back off a little bit, but the market conditions aren't right for you. Conversely, it could be volatility. You might have a strategy that's very good in high volatile markets or works better in low volatile markets. I feel like prior to the Trump administration, we had a bunch of traders on our platform who had strategies that were doing pretty well. And with the huge explosion in volatility, they found it very, very difficult.
It makes sense. So this ocean analogy, I really like it. And I can kind of see there's components of this ocean that is not favorable for a retail trader, because we have an information gap or a facilitation of a trade gap.
Yeah.
So there is, let's say, a Goldilocks period. There's a sweet zone for a retail trader.
Yeah.
Number one, if you could help us understand or define what those areas would be for a retail trader to focus on. But number two, do you think off the back of this, of things decaying or changing in the market condition, leading to certain strategies not working as effective as another one, bull market versus bear market, let's say, that as a trader you should be holistic and say, I should be swing and scalping, and I should be developing systems, and then just my job as a trader is knowing when to deploy each trade type or each model?
Yeah.
Or is that then just too complicated?
I feel like my experience tells me that that approach doesn't work for a lot of people. Most successful traders that I know are good at one thing or one style of trading. That's what they focus on, and typically one product as well. So they're not trading a big basket of products. Now, there are, of course, types of trading, for example, like asset managers and things like that, that will have strategies that will rely on diversification across different products and asset classes. But they are strategies that are taking automated trading signals. If you're an independent discretionary trader, you're much better off focusing on one product and learning the nuances and the characteristics of that product than trying to be, a master of one trade, not a jack of all trades, so to speak.
Would an undertone of this be that if it's a technical based system, not necessarily fundamentals, or including fundamental traders? The reason I ask is because I imagine there's more nuance to understand in technicals on a single asset class, whereas fundamentals or just understanding the environment, it doesn't have so much nuance on a day-to-day basis, let's say.
Yeah, I think, I think I stand by that, particularly for new traders and intermediate traders. The way forward is to find a market that suits you, find product that suits you, and focus. Try and become profitable in that product. Don't do too much. I don't really know if this answers your question, but at the top of the interview, we talked about how it's a mistake to focus purely on technicals. And one of the things I do see heavily ignored is fundamentals. Now, retail day trading, there's an argument. How important are the fundamentals? How important is data? Of course, it was the Fed today. That's crucially important to know when that releases. But generally speaking, is it important to know what's happening in the news and headlines? And I think that gets ignored a lot. I think it's very important for a trader to understand what's driving their price. Your technicals could be pointing down, and your gut could be telling you it's going down. But if a data release comes out indicating there is going to be, high demand or a short supply, price is going up. So, I know that it's ignored, but what weighting should you give it in your strategy as a retail day trader or swing trader? I think fundamentals are a lot less weighting than if you're a global macro hedge fund that's trying to pick up big trends that develop over weeks, months, and sometimes years.
I feel like a lot of traders, just looking at prop firm statistics, is more so day traders and maybe even leaning towards scalp traders. So I think this comment of technicals will definitely hit home, because in pursuit of being a day trader, let's say, fundamentals do get ignored, because the logic is, well, if interest rates are this or inflation is this, well, that might take months to play out. How's that going to affect my London session today, where I'm in and out in that session? Where I do see that wisdom coming in. And if you are someone that is a lower time frame or more a day trader, let's say, what fundamentals should you pay attention to not be overly weighted on just technicals?
Well, first of all, the data is crucially important every day. I am continually amazed that people don't know when non-farm payroll is. First Friday of every month. Depending on where you are in the world, a different time. It hits a different time of day for you. Wherever you are in the world. In London, it was 1:30. In Chicago, it's 7:30. So those are the most important. Like the big, what we call them at trade day, we call them tier one data, and we actually do not allow traders to trade them. A lot of your audience will be familiar with the online prop trading setup, and there was a time when trade day used to fail traders for having open positions going into non-farm payroll, CPI, and the Fed. We no longer do that now, but what we do is we shut off the trading, because it's a complete and utter gamble. And I wrote a whole blog post on why it's a terrible strategy to try and trade data. But as a trader growing up as a professional day trader, these were key events for you. Like everybody knew when they were happening. Now, the advantage of working on a trading floor is you're standing in a trading pit with 100 people all looking up at the news wire, waiting for it to break and the market to kick off, so you can start trading. At home, you might forget about it. And I've done that, even in an office. If it's a quiet office, I've forgotten it was data release. I had a position, all of a sudden I'm 3, 4, 5 ticks offside. Like, what the hell's going on? So it's really important, I think, to understand data releases. I think it's really important to understand the general sentiment in the news, and kind of like, for example, what's the impact of tariffs on price? Now, you don't have to understand what a tariff is, and you don't have to understand how it's going to affect the price of a car, for example. But if Trump comes out and says, I'm increasing tariffs on XYZ, you have to really have in your mind a sense of which direction the product you're trading is going to go. And it's hard to judge how far it's going to go, but certainly as a trader, in a trading room, one of the advantages were that you would sit and play out what if games during quiet market times with the people on the desk. What if this is said? What if he says this? What if he says that? What if he retracts that? What am I going to buy? What am I going to sell? Where am I going to jump in?
So the crypto bull market is well upon us, and with opportunities left, right, and center, why not utilize other people's money instead of your hard-earned money? So introducing to you the world's first crypto prop firm, Bitfunded. And they've partnered up with an exchange to bring not only the world's first crypto prop firm, but actually a prop firm that has an exchange-like environment. Imagine as if you're trading on Binance. With all the benefits that prop firms bring, with the leverage you can have, or hundreds of thousands of dollars in buying power, utilizing other people's money, so your total risk is just a couple $100 max, or as cheap as $79. And with the special offer that they have going on right now for you as a Titans of Tomorrow viewer, if you buy 2 prop firm accounts, you'll get a 3rd one for free. So click the link below this video to head over to the Bitfunded website and start to utilize other people's money to benefit from the crypto markets whilst minimizing your downside. It's also interesting because you may have certain predictions, these what ifs, and the what if may play out, but then the market doesn't react as you would expect. Non-intuitive, because maybe there was another overriding factor that wasn't considered. My view, let's say, is this is also going into, let's say, recently with Trump, where he has his buddies in the White House saying this guy made 900 million, this guy made $1 billion, and kind of laughing on the situation, which really throws to me the idea of insider information, or the elites at the top, they're all friends and they all share these informations. The derivative of that is buy the rumor, sell the news, where you might have all your ideas, but in the end, the market will do what it will do.
Yes.
But you may get a sense of the buy the rumor, which is the large players positioning their orders in, and maybe getting a sense of price action to predict through technicals what the news release may be. Do you think that's a futile approach, or is there some logic in there?
No, I think that speaks to the very key of it. I think one thing that what you're trying to do as a trader is you can't predict the future. What you're trying to do, it's almost like a game of poker, is trying to think 1 or 2 steps ahead of what the market is doing. Is it price long? Is it price short? Is it panicking? Where is everybody, and how is the market, or how are they going to react if this changes? And I always found it very useful to play through these what if scenarios. Doesn't mean I got it right, but it meant that I was prepared rather than scrambling when that event happened. He just backtracked on tariffs. What does that mean? Instead of like, what does that mean? I've got a game plan in my head. I'm going to go for it, and and I'm going to put my position on. And if I'm wrong, it's going to be risk managed and locked out. But if I'm right, I'm going to be able to capitalize on it, rather than having to think through the scenario. Go, okay, now I want to put that position on, but it's too late because now the market's moved. So I think. You've kind of like sparked a memory, inside of me of, it was constantly, the way I traded, I constantly looked at price and what was happening, with the order flow, and trying to figure out, is the market short here? Is the market long? How do they feel? Why have they put that position on? And then I could start to formulate my trade plan around that. But it was more, rather than just, I don't quite know how to articulate this, but it was.
I sense it's like poker. You're seeing the hands being dealt, and you're kind of getting a sense of, okay, buyers are in. Are they absorbing the orders? Is there exhaustion? You're not just seeing the price alone. It's the order flow.
Absolutely, yeah, absolutely. And it was kind of like almost trying to play 2 steps ahead, not 1 step ahead, if you see what I mean. So
there's a book, I forgot what it was, but he made a funny comment, which is, it was to the effect of, trading is a very arrogant endeavor, because you have to take a position and assume that no one else knows what you know, and that you have some arbitrage in the market that no one else can see. The comment being like someone buying an AI stock because, well, AI is the future. Well, the rest of the world knows that's priced in. So for you to actually capitalize in the market, you got to do something that someone else doesn't know, which brings me on to the question where, when I do see swing trading, unless you have an extreme fundamental edge, or you're looking at institutional intent, which is kind of like a self-fulfilling prophecy. If the institutions do X, then Y will happen, because they move the market. Aside from that, I as an individual, I have a decaying degree of certainty as time goes on. So I might be very confident on where something might be in 5 minutes. It's in a box this big. But if I say, where is it going to be in a year? Well, it's a big box, because there's so much things that can happen in the meantime, or an information gap. Do you think these things then, this trader's arrogance, or just being able to execute on an idea, is more leaning towards, with our level of resources as a retail trader, towards a day trading as opposed to a swing trading approach?
Yeah, I mean, it depends how you define swing trading. I've been doing a bit of swing trading. It's hard for me because my philosophy is trading should be a full-time endeavor. You really got to give it your 100% concentration, and it's very hard to do that in my current role. Nevertheless, I can't stay away. So, I will swing trade, because obviously I can't scalp, I just don't have the time for that, using options usually in a Robinhood brokerage account at the moment, because I wanted to get used to the app and have a look at it and see what, I know it's very popular amongst retail. I'm just trying to get play around with different applications and things and get some ideas. Inevitably that view takes on sort of 2 or 3 days. So if we're kind of in that sort of same definition of swing trading, that's kind of how I work. And how I make those decisions are usually based on fundamentals, maybe a touch of technical, but it's more like, okay, what just changed in the fundamental picture? oh, is flip-flopping on tariffs. Well, that might drive price back up for the next 2 or 3 days. That kind of that sort of approach is the way I do it. But I think you're absolutely right. I think there is obviously, the longer the trade time horizon, the more uncertainty there is in that trade. Does that mean that the person putting on that trade has more knowledge than you? Maybe they're doing more research, big research department behind them and things. They certainly have more capital to hold out that view and see, potentially go offside for a few weeks before it goes back onside. And that's very difficult for a retail trader. My career was day trading, more or less. As I said, about maybe 20% of my trading held no longer than a week, some spreads on overnight for a few days. So that's my comfort zone, and I don't really, I wouldn't put me in charge of a hedge fund's money, because I just haven't traded at those sort of time horizons. So I can't really speak to them, but I think you're absolutely right. From a day trading point of view, from what we have as tools in the market, with our technical analysis, our data releases, and a lot of watching the order flow. I mean, certainly that's how I traded. That fits a day trading time horizon better than a swing trading time horizon.
On the flip side, just throwing a devil's advocate here, a swing trader, which we can kind of define in these parameters as a bit more uncertain.
Yeah.
But uncertainty doesn't necessarily mean negative, or we shouldn't necessarily say that's a problem, because at the same time, law of large numbers, where you might have individual trades that are uncertain, but as a collective, you can find pockets of certainty or increased probability in random outcomes, which is the market. Giving the analogy of a casino, where you might get a gambler that loses life savings, and you might get a gambler that makes 100,000% in just on a a roulette or something. But the casino is not concerned with each individual moment, because they know they have a baked-in edge, and they just allow time to play out, because they know with large numbers they get uncertain outcomes each day, leading to certain P&L at the end of the year. Do you think that is the frame a trader should have in the market?
Are you saying that a trader should trade with certainty that over time it will play out?
And maybe even bouncing off your views on technicals, which is instead of trying to understand the market and read price and whatever, it's just a case of find a pocket of a pattern that you see repeating and look to exploit it. And you don't know why it's there, but over time, it will play out. So don't worry about finding certainty in the market, or don't try and be too intellectual with the market. It's just find a pocket of an edge, like a casino, and allow large numbers to be in your favor.
Yeah, I think that speaks to a more systematic approach than I certainly traded. Mine was a more discretionary. Now, there are definitely successful systematic traders. The return tends to be lower and not necessarily conducive with trying to make a living as a day trader. Trading is very personal, right? And everybody trades differently. And that's why it's very difficult to actually sit somebody down next to you and teach them how to trade, because they will have a different psychological makeup, different biases, all sorts of things going into the mix, which means that once you leave them alone, their decision-making will be different to yours. And what you're talking about, I feel like, is like systematic trading is like, okay, I've found an edge, I'm just going to exploit an edge, it's going to win some of the time, it's going to lose some of the time, but over time it's going to pay off. And I think that is, I know it happens. I know, like in commodity futures trading funds, that they are systematic in their approach. But as I said, the return tends to be quite low and tends to work better in certain market conditions. I don't really see that happening a lot with traders, discretionary traders. They will tell you they have a playbook, they like certain setups, but that person can't write that playbook down and sell it for $19.99 or $99 on Instagram, like some people would like to lead you to believe. They're taking that playbook and overlaying that with a very strong risk management approach and psychological approach. And
would you add intuition into this?
I would definitely add intuition. And intuition's, we call it gut feel, or we used to call it gut feel. And it's a very interesting concept because it's a hard thing to teach. But, you know, just to give you like a small anecdote, I remember standing in the pit and it wasn't much happening. And I was standing next to a guy and he just turned around one day, almost seemingly out of nowhere, and he had a short position and he covered it, and he bought some. We were trading Eurolira at the time, and I was like, "Oh, why'd you do that?" You know, and then the market sort of rallied. Sorry, a few seconds later, the market started to rally, and I was like, "Why'd you do that?" He goes, "I don't know. I just had a really bad feeling. Just had a feeling." You know, and I'll never forget that. And then when I found myself in China, and I was working with my mentor there as well, who owned the company. He was my trading mentor throughout my trading career, and he'd gone on to build this trading group in these emerging markets. And he would talk about gut feel to traders, and that you should learn to listen to your gut.
Oh, really?
Yeah,
Okay.
you should learn to listen to your gut in trading. Now, what is gut feel? Well, really, it's a manifestation of your experience, right?
You basically got subconscious competence, and you're on a subconscious level analyzing or noticing patterns.
Yeah.
And okay.
Through experience.
This
So
is
that
going to be my caveat of like,
yeah.
who has the right to deploy their intuition?
So this is interesting. So we would like talk to people about gut feel as part of the training, and then literally I'd have a 2-week in trader do something and I'll say, why did you do that? Oh, my gut told me to. And I'll be like, you know, okay, that's not quite what we were on about. Okay, back to the drawing board. How do we articulate gut feel? And I think what's happening there is trading can make you uncomfortable. And Steve Ward talks about being comfortable with being uncomfortable. And, you know, particularly when you're scaling up as well and you're putting on position sizes that you're not used to, that's going to have an effect on how you physically feel as well as how you're thinking. And it's kind of like separating out, I think, that nervousness around having a position on versus getting an instinct that something's about to happen in the market, or, you know, and it's hard, obviously, you can't really articulate gut feel, but here's an example. If I think the market's going to sell off and I take a short position and it does nothing, I'm like, oh, it hasn't done what I expected it to do. And that might start manifesting itself in like, I'm getting a bit nervous about this. And you can actually feel that those nerves, you know, and you would act instinctively and cover that position. And I traded a lot on my gut throughout my career.
As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come. I think intuition is something we speak about for hours. Here, there is also, like we spoke about earlier, of just the animal portion of us, survival instinct, or instinct is the word actually, instinct versus intuition, where right now we're having a conversation and I'm sitting here focusing on what's being said and thinking, you know, what to ask or what to say next. But I'm not thinking about moving my hands. I'm not thinking about breathing. I'm not thinking about the dilation of my pupils. There's a lot of things that go on unnoticed to us. So I think as humans, we are designed to be focused on certain things, our analytical portion of our brain. Then we have a huge portion of our brain that is just the subconscious, that is analyzing the environment or automatically running and so forth. And I think this does display in the markets where you notice certain tendencies. But the key here was what you touched upon, is like, who has the right to actually act upon it? Because you might do an incorrect decision, but it led to a favorable outcome. So you kind of over leveraged on a trade, and it was a winning trade. So now you've reinforced the behavior of, if I over leverage, it leads to a positive outcome. That's a false narrative. But on the flip side, you might do the right behavior and it's a correct intuition, and you enforce the right thing. So it's also analyzing, or should we analyze, how we assess what is intuition and try and bring it to the surface, or is a gut feeling with experience just something you feel like and you should act upon it?
Yeah, I don't really know the answer to that, I'm afraid, because it is, it's almost like so Harry Potter, talking about gut feel, like an instinct, like, use the force, Luke. And, as I said, I can see it's hard to teach people when they've got no experience. And as I said, I would have traders like 2 weeks in say, oh yeah, my gut told me, after we told them to listen to their guts. And I think it comes with experience, comes with time. And of course, you're not always right either, and trading's, you're not operating in absolutes. And so it's not necessarily always right to you have that gut feeling, I'm long, it hasn't gone up, something seems to be brewing, I just need to get out. I get out, it goes up. Oh, I was wrong to get out, But I'd rather live with that than not get out, the market go down, and then be angry at myself, right? Because now I'm going on tilt, right? So that's changing the way I'm going to start to approach the market, because I'm like, you knew it was going down. Why didn't you listen to yourself? You're banging the desk, and now you're in the wrong frame of mind to trade.
So with this idea of just discretion versus manual trading, sorry, not manual, systematic trading. Yeah, I can completely see why systematic trading would lead to less returns, because the parameters are defined and the market is not perfect. So you'll be left waiting because you might have 9 of your 10 boxes ticked and you're like, I can't take this trade. So it's also the manual side is the discretionary side is understanding it's not fitting my plan entirely, but it's still good enough. And in my own experience, it's a case of I'll have certain parameters for my day trading. And time windows is something I look at. So there's certain portions in the day I believe are more volatile or more worthwhile, and I'll be entering on those time windows.
100%.
But if I have all of my boxes ticked and it's just like an hour or 30 minutes out of my window, it didn't meet the rule, but a bit of intuition tells me certain setups are worth going outside my time window. Other setups, let's say a counter trend trade or a hedge trade, it's not in my time window. It's a good setup, but it's not good enough. So I'm not going to deviate from my time windows. Do you think then discretion now becomes upon confluences, not a trade as a whole?
Well, I really like the way that you described like time windows and operating within and in and outside of them. And I think that, that you're demonstrating remarkable discipline. I know certainly I used to like trading the market open. I know a lot of my traders that trade, they like trade the market open. It's the most volatile. It feels like that's when some of the bigger market moving traders, whether that's a fund or an asset manager, are coming in, deploying their trade. And then as the morning goes on, the volatility tends to be sucked out. Obviously, it depends on the day, of course. It's not always the same, but it becomes less. When I was trading full time, it became less conducive to my style of trading. And what I would find is I would end up churning a lot more, making a little bit, lose a bit, spend money on commission, make a little bit, lose a bit, spend money on commission. But I found it very difficult to stop trading. And that was also part of the challenge. Okay. So I'm encouraged to hear that you have the ability to,
So it also depends because let's say the time window example. I'm trading a euro dollar and it's on the forex side. But a London Open and a New York key window I have. The London Open, I will actually allow a nice buffer because I know I have the rest of the day's volume to play out. Whereas if I now go out of my window, even 30 minutes on the New York window, I know within 3 hours, the London session is closed. The volatility dries up. It's not really going to my take profit that day. Kick over to the next day. Asia range might chop or reverse. So I don't know if that's intuition or that's just now me understanding probability, let's say.
Yeah, I think it's experience, right? And I think that something like that is less intuitive. I think that's just comes through experience and knowing exactly that's likely to be the scenario you're going to face. I'm going to be stuck in this trade now, and what's worse, in the Asian session, it might even drift against me, So I think that's just come through your experience. Some people like these quieter sessions. We have plenty of people trading throughout the night, and they like the low volatility and the slow drift of the market. I'm more like you, I like the sort of the more active parts of the trading day.
In your system, did you have non-negotiables that no matter what your intuition feels like, there are certain things that you just must act upon?
Um, no, I don't think. No, I can't. Not when I was. No, I can't remember ever thinking. I mean, I probably. I mean, there was a time I was pretty much acted on everything, you know.
We've all been there. Yes.
and you know, and for a while it pays off, you know. But there wasn't. I find it very difficult. My experience tells me that there are no certainties in trading. So if you start trying to tie certainties to things, that's when you're going to get yourself into trouble. So if X, Y, Z happens, I have to do this. Well, X, Y, Z will happen. You have to do that, but the result is not necessarily what you hoped. But you'll continue to do that because that's what you believe is the right thing to do. And I think you just have to be a bit more flexible in your approach.
Are you a believer in, it's a buzzword, but market manipulation and kind of stop loss hunts, or these kind of price action patterns that we see that maybe are explained as manipulation, but it might be something else going on?
Yeah, it's a good question because I think there's less market manipulation today than there was. And I'll tell you why. When exchanges first went electronic, and in the UK that was around 2000, 99, 2000, and you first saw a price ladder or depth of market for the first time, right? TT, Trading Technologies, were the first people to, I believe they were the first, they were certainly the first to patent the way you display a market depth on a ladder, or depth of market, sometimes it's called. We used to call it ladder back in London in the early 2000s. And it was kind of like, oh, wow, I can see where all the orders are stacked. You know, I can see where everyone's working limit orders. That's really useful. That's very handy. And you could use that as edge. And so you would spend a lot of time studying not just what's trading at the bid and offer, but what's resting in the order book. And over time, markets evolve, you know,
Spoofing came around.
Yeah, and people started to understand, well, banks and brokers who were charged with executing large orders began to realize, well, perhaps we should, instead of putting 1,000 in or 500 in at the offer, we'll put in 5 clips of 100, or we'll get more sophisticated, put 10 clips of random sizes
to mask their order,
their order, to hide their order. Then iceberg orders came in, which are orders that you can't actually see in the order book, but when it trades there, they're automatically entered. And then, you know, with that became market manipulation as well. And that's when a lot of spoofing started to happen. And it was really around sort of 2004 to about 2000 and say 10, 12, maybe even into 2014 a little bit. And what happened was the exchanges started to clamp down on that because it became a form of price manipulation, and people started to get prosecuted for it. And what we saw is plenty of prosecution at the exchange level, and then we started to see prosecution at the regulator level that carried bigger fines and sometimes custodial sentences. You know, the famous one being the Wolf of Hounslow, the guy that had manipulated the flash or was blamed on the flash crash. I think it was around 2010. And you know, yeah, for your viewers, Google it. It's a very interesting story. Guy sitting at home in Hounslow in London trading on TT, spoofing the market that caused a flash crash or allegedly caused a flash crash, and ended up being, I think he served time for it. Certainly was prosecuted over in the United States by the CFTC. So I feel like the exchanges and the regulator did a good job of cleaning a lot of that up. Now, that doesn't say it doesn't go on. You know, that you have a situation where you do have regulatory arbitrage. There's a lot of people around the world accessing the US markets. And I'm specifically talking about US markets, but it happens in all markets, I'm sure. But my experience is in the US market. So they're operating around the world, and their trading does fall under the jurisdiction of the exchange and the regulator. And they have the power to ban that person and fine that person. Whether somebody sitting in China is going to end up in court in the United States. It's enforceable, but you know, whether it actually happens, I don't know. So I'm convinced that a certain level goes on, but it's not as bad as it used to be by a long shot. Now, the question is, every time I put my stop in, it seems to get triggered. is that a stop hunter? That's potentially could be happening. That's not a form of manipulation. That's a guy with an edge, like trading, knowing that, retail traders are putting their stop behind.
Retail psychology, yes.
Yeah, retail psychology and market psychology. So that definitely happens. You as a trader, you live with market paranoia, and you live with, they know what I'm doing. Every time I go long, it goes down. And to the extent where we used to sit in trading rooms and sort of shout out, yeah, it's definitely going down now, definitely going down, as we'd put a long in, to try and counter this thought that somebody was listening to us or watching what we were doing. And, of course, it just doesn't work. I feel like what you, well, not you, but what a trader sees, what a retail trader sees a lot of in the markets is their own behavior, right? They're going in at the same places, they're entering at the same places, they're exiting at the same places. So the markets are naturally, coming down, the stops are being triggered, they're out, but so, hundreds of other retail traders, and then the market's just exhausted there and returns, or comes back, and you're like, damn, I got out at the low, or the low of that move. Why me type thing. And I think that's because, if that's happening to you a lot, then you just got to look at your strategy and think about, okay, I'm not going to put my stops where my strategy tells me to put my stops. And try and make some adjustments accordingly. But I think, what you're talking about a little bit is there's definitely manipulation. It's not as bad as it used to be. I don't think it's enough to lay the sole blame of your failure as a trader. And I think what you actually see more than anything is just your own behavior being replicated by people who have very similar views. You're all watching the same 5-minute chart or the same 1-minute chart, or you're all following the same system, whatever it is you've learned off YouTube. And that's, there's only so many people that could go into that trade. There's only so much liquidity.
I think it's also like the same price action. People can explain it in 1,000 different ways where one person might see a head and shoulder pattern, another might see a wick-off distribution pattern, another person sees God knows what. So, but it's the same price. It's just people's reflections, or they're imposing their beliefs on it. I want to speak about now profit-taking systems, because when it comes to an entry, I think there's a lot of components that we've spoken about: technicals, fundamentals, data, intuition. It's a mix of things. Do you think that level of intellect should be applied to also the exit? Or because this is something I used to do, where I put out key levels of okay, am I go for the Asia low? Am I go for a structural low? Am I go for this support level? Am I manipulate that? And then I would have 10 lines on my screen, and I didn't know which one to pick. So then it would be a mix of emotion or seeing how it reacts on the level. But then it's just greed coming in. It's like or fear, depending on where I am in my account. So then I deviated towards just fixed profit levels, and I went through a data and I went through a long process, but coming to find out, what I essentially did was I just took my average session volatility or average session range and average daily range, and that was my TP1 and TP2. Therefore, I don't have any discretion involved anymore. I don't have any intellect. It's just, what does London session average move? Okay, so this many ticks. That's going to be my TP1. What is the average day move? This much. Okay, that's my full TP. Do you think that's a more sensible approach, or do you think having a discretionary approach would be more fruitful?
Yeah, again, every trade is different. I'd like to ask you, how do you exit TP1, TP2? Do you work limit orders?
Yes.
So you got a limit order in the market, it gets there. Have you ever thought about
waiting for a reaction there?
No, when it gets there, instead of having a limit order, so say your limit order's at 35, you're along from 25, it's trading 34.5. Have you ever thought about just putting a 32 stop in and let the market take you out?
And just trailing it?
Yeah, like a trailing stop, or essentially it's a trailing stop.
I did actually try it. So initially I tried let me arrive to the zone and see if I see indecision or reversal. Then I know I should get out. But then I realized there's an inefficiency there, because I am lower time frame trading. A small reaction, it might eat up 20% of what I could have taken. So then over time, that me waiting to see, it felt like I was just eating up profits. That if I just had a hard level, the trailing stop is an interesting one. What I have found is my edge, I feel like its strength is I'll have a 1 to 3 risk reward partial, and it'll be around the session volatility. And I'll take 50%. So if I'm doing 1% risk, I'll get 1.5% on a kind of session reaction.
Yeah.
So I then found out that I don't really need to care about the trend. I don't really need to care about any concepts. As long as I can find a high probability reaction, the likelihood I get my 1 to 3 or stop loss is very high.
Yeah.
So I end up becoming a reaction trader as opposed to understand the fundamentals and so forth. So the reason I explain this is because my approach is get in, break even as fast as I can, and aim for my TP1. And if I trail it, it might also reverse on me. And I would rather just grab the level. But it's an interesting thought as well.
And this works for you?
Yes, and now an interesting reflection on this, because I've been doing this specific approach for about a year and a half. I found that my TP1 level was hit disproportionately more than my TP2.
Right.
So it made me think, okay, instead of me now actually going for the TP2, the average daily range, why not just full volume at the TP1? And then the trailing stop after the TP1 has been a consideration, or has been segmenting between these trade types. I should be doing full volume at 1 to 3. These trade types are more favorable for both TPs. So this is actually a current dilemma I'm facing right now, or a challenge that I'm trying to find an answer to. But yeah, I thought I'd throw it out there because this is something that's been on my mind a lot.
Good luck finding an answer.
Okay. Why do you say that?
Well, because every trader's different, you know, and I'm loath to coach or advise a trader who's having success, because I don't want to break that success, right? And everybody's different. One of the things that I traded interest rates and interest rate curves, and they're very tight. So you would trade them in large size, but for very small profits, maybe a tick or two, you know, but it wouldn't be uncommon for me at the height of my career to have like maybe 1,000 or 2,000 contracts on. So, you know, you're really just looking to take a very, very short profit, small profit, but the very, very stable markets. And then as I've moved over to the retail and started playing around trading indexes, you know, these are products that can move, like really, really move. And one of the things that having a set take profit level, you know, I've questioned and gone through is that, what are you actually saying there? It's almost like, for me, is it like, do I have the arrogance to say that's where the market's going and it's stopping? And I know that, so I'm going to put my take profit in there. And the other thing I found is like your natural inclination to have a level where you take your profit is usually something technical, right? So it's like an obvious level of resistance, for example, if you're long. If it breaks that, it tends to really go, stops the other side, accelerate the move. And I want to be in that if it breaks that level of resistance.
Hence your suggestion of just trailing it.
Right. So I like to think this way. I think it's going to my TP1. But who am I to say it's going to stop there, right? And so let the market take me out. But as a result, you end up giving, you know, because quite often it's meeting a little bit of action there. And it might flush you before it continues, most frustratingly.
That was going to be my point of like, okay, the trailing stop, it is a good idea. I haven't tested it, but I'd be interested because let's say if we just use Fibonacci, Fibonacci retracement, we know the average retracement or pullback, which might be your TP and then a pullback and then continuing in your direction. So then having your trailing below the 50% fib is probably not favorable because you'll more likely just get tapped out. But if you have it at the higher level fibs, then you're more protected. But then if it does reverse on you, you ate up a lot of your profit. So there is a pros and cons here. So how would you tackle even correctly implementing a trailing stop?
Yeah, so it's a good question. Again, a lot depends on the product you're trading, the volatility, you know, how much you're comfortable giving back, how far away from your break even to your profit target it was. You know, it's almost like, you know, for me, it's almost like a discretionary thing, but it's not. What I like is a hybrid approach. That's where I was getting to. Is like, what I found I've liked moving over to sort of more like markets that are moving, you know, at distance like NQ or ES, is that I think it's getting to my take profit, or I'd like to see it get into this zone. I'm going to take some off the table, and then I'm going to try and run the rest, because I think one of the most frustrating things for a trader, and I hear this a lot when I'm mentoring traders, and when they're showing me their trades throughout the day, and they're like, you know, I shorted it here, I bought it back here, and then the whole thing just went on to collapse. And I'm so mad. And only if I'd done this, and only if I'd done that. And I'm, and I'm like, you want to put yourself in a situation whereby if it does, I think you want to put yourself in a situation, if it does evolve like it evolved in this example, you're still in a position, not the whole position, right? Because, you've taken off half or 3/4 of it because your data and your trading and your experience tells you that you want to be out at TP1 in your example, right? You're getting more TP1s than you are TP2s. But at the same time, there's nothing more frustrating than being out of the market when it continues to move. And I think at that point, it's not necessarily about the P&L, although the additional P&L is nice. For me, it's almost avoiding
frustration,
the frustration
yes.
and the toxic mindset and emotion that will then knock on from that and have an impact on my further impact on my other trading.
Maybe it's down to an individual temperament, but that frustration you're describing, of course, exists. But the frustration that is more for me is the risk to reward of holding a trade. Or let's say if I leave a symbolic runner position and just let the market do its thing, it will also reach a point where the risk to reward for me to continue to hold that trade is getting worse and worse because I might now be up, I don't know, 2% on my small volume, and that I'm technically allowing that to come back to break even. In hopes of gaining a small increment, and therefore a negative RR to hold the trade. And for me to say, I was hoping it would go here, I'd gain a little bit more, but now I gave back a lot. I guess the trail is the solution to this.
Definitely. I wouldn't put yourself in a position to see a trade on side, take half of it off, and then let the rest scratch. I think you like you say, then where's the risk reward there type thing. It's more about, rather than being direct and saying I'm getting out here because I believe the market's not going any further from here, is like I'm just going to leave some on and just see if it runs. But if it starts to come back, I'm going to be out quickly. I'm not going to give it all back to my break even on this.
The last kind of topic I want to touch upon is risk, because it's a big debate almost that I've had on the show with many guests, where certain people are very on the intuition side of things, and they're like, when you feel it, when you notice your A+ setup, risk aggressive, and it's around the frame of 80% of my profit comes from 20% of my trades. So knowing when to size in. The other thing is, well, you can also mess that up and over leverage and gamble and turn into a lot of problems even. I've always been just static risk, and people have proposed it to me, well, how are you going to scale? If you're just always going to be this 1% trade risk, when you have this great trade that is A+ that you've seen time and time again, it's the data's there, why not put 3% or 5%? It's just not been my way. But I want to kind of hear your thoughts on dynamic risk.
I think dynamic risk is something I used. Of course, if you're using static risk, you can scale, and I would use
scaling through capital,
scaling through more capital. And I just want to touch on something that doesn't directly answer your question, but is very related to risk and day trading, because it's something that was taught to me very early on in my career, and I think is relevant today, 30 years later, and I think can really, really help a trader. And that is, try not to lose more in a day than you can make in a day. Right? And I'm going to just walk you through why that's important as a day trader. So let's say, and over time as a trader, you start to get a sense of what an average to good day is for you. Let's say that's $1,000, right? I can make $1,000. You have outlying days where you might make 3, but on average you make about 1,000. What you want to be in a position is not to try and lose more than 1,000 in a day. So because what will happen is this: on Monday you come in, let's say you lose $1,000. Well, on Tuesdays you come into trade, you're like, well, I know I'm capable of making that. So if I have a reasonable day, I'll be flat. And then, Wednesday might be a scratch day, and Thursday and Friday might be profits. And, I'll make money on the week and I'll feel good about my trading. Whereas if you're capable of making, on an average to good day, about $1,000, and you come in on Monday and lose 3, On Tuesday, your mindset's very different. Now you are like, I've got to work all week for nothing. I've got to have 3 of my reasonably good days out of the next 4 just to even be flat on the week. And that changes everything. And, you know, and as a manager of an online prop trading group that services retail traders, you know, the number one mistake is people over leveraging the accounts. Now,
On a single day, you mean?
Yeah, on a single day, or on a single trade, you know, on a single trade too. And I'm not naive. I know that there is a significant subset of our users who are here to play the online prop trading odds.
Just
right?
the casino idea.
Like the casino ideology. And that's fine. There are also a subset of our users who are really interested in learning to trade, wanting to become good traders, make a living out of trading, make a career out of trading. And, you know, those are the ones we sort of like work with and try and focus on, and we create the content for, and those are the ones that consume the content. But, you know, I really like this philosophy of trying not to losing more in a day than you can make in a day, because big losses can really, really cripple you. And in around sort of 1996, I had like one of my biggest losses throughout my whole career, actually. There were a couple that came close, and probably one or two that exceeded later on. But in terms of where I was in my career at the time, it was very significant. And I would say like a good day for me was around $2,000. I was in the UK, so it was pounds. It was actually in lira, but converted from lira to pounds, it was about £2,000. So bad days about $2,500, and I would probably make money 3 days a week, scratch one day and lose one day, maybe 3 losing days a month, 3 or 4 losing days a month, and there was a whole story behind it which I can go into, but I don't know if we have time now. But I was basically coming off a really good run and super overconfident. And I came in the next day knowing what the market was going to do, or at least I thought I knew what the market was going to do, because I was trading so well. And technically it had opened the previous day, it opened on the high, closed on the low, you know, a lot of volume. I was like, this thing's going to crash tomorrow. And I want to be in it. I want to ride it. I want to go short. And on the open, I just started selling. And the market didn't move. Stopped, you know, it stopped. And I was like, oh. And it started to tick up. And then the liquidity dried off. And I was like caught, and I was caught big time. And I was scrambling to try and cover it and hedge it. And, you know, by the time I'd unwrapped myself from this whole mess, and we were on the trading floor, so I was filling out trading cards with my prices and contracts. The market opened at 8. It's about 8:30 a.m. So I've been trading about 30 minutes. And I went round to the booth and gave them to the runners who normally collect the cards from you in the pit and type them in and match them through the system. I gave them the cards and they typed them in. And I said, I'm going home. You can call me, you know, when you've figured out first of all, that I'm flat, what my position is. It should be flat. And let me know what my loss is. And I walked home that day. I was living in London, but it was about an hour and a half walk from the exchange, you know, because I just felt sick. I just couldn't face getting on public transport. And I kind of got home and I got a phone call from one of the runners, and they said, yeah, you are flat, James. Everything's good there, but we think we have an out trade. We think we've typed something in wrong. So it's a very manual process. So you had the trading cards, and they would read your handwriting and they would type it in a machine. It would match with the other traders' back office typing it in. And sometimes you have what's called a mismatch or an out trade where something may have been typed in wrong. And they said, oh, we think we've added an O in somewhere because we're showing you down £27,000 and we assume it's £2,700.
Wow.
And I was like, no, it's £27,000. You know, it's right. You've got your cards right. So I knew it was bad.
You just got on tilt, okay.
Yeah, and I just like in that half an hour took this massive loss. And I would say it took me probably 2 months before I started to recover from it. And I'm not recovering too much, start to recover. For weeks, I couldn't even trade. I was afraid to trade. I would go to work, I would stand in the pit, and I would be afraid to take a position. Initially, I started taking like 50 lot positions and 20 lot positions, which was kind of the size I was trading before. And I couldn't hold on to them. I was too scared, you know, because I couldn't afford mentally or, financially to lose any more money. So I wouldn't let the trade play out. I was cutting it too early. It was too much size. It was just awful. And I was paralyzed through fear. And I would sit out of the pit and sit on the steps and just look at the trade in action. And I couldn't move. And it was like that for a number of weeks, more or less. And I would go in and try and, maybe make a couple of £100 and lose 500 quid. And, I was just getting nowhere. And one day I was sitting on the steps and one of the floor managers came over to me and said, I know you're really, really struggling mentally. And he said, he opened his wallet and he said something like this. He said, how would you like 50 quid? And I was like, oh yeah, that'd be, that's great. Thanks, Ricky. Why are you doing that? He goes, well, I'm not going to give it to you. He goes, but go and stand in that pit and trade a one lot and trade two or three times and see if you can make 50 quid, because I know you can. And I was like, okay. And I went in and I traded a one lot and I traded 2 or 3 times. And, I don't know if it was 50 quid, but it was close, right? It's like 40 quid. And I came out. And the point is that I came and finished the day profitable. I traded 2 or 3 times. They were winning trades. And I could feel things shifting inside me. And I immediately got the lesson, and the next day I went in and I traded 1 lot. And the day after that I traded 2 lots. And the day after that I traded like 5 and 10. And Ricky come and tapped, slow down, but 3 or 4, 4 or 5, just take your time and scale up that way and build your capital back that way. And it took a long, long, long time to recover. And then I went on to do better than ever. And that's a huge lesson as well. Lots to draw from that, but ultimately as a trader, what that did is it gave me the confidence and another tool in my toolbox to know that I can recover from a very difficult situation. And circling back to what I was saying at the top, which is about trying not to lose more in one day than you can make in a day, it kind of goes to that sort of like that philosophy is there are 2 P&Ls when you trade. There's your cash P&L and your confidence P&L. And the confidence P&L is more important than the cash P&L, And one of the other things I learned at the time was a trader that worked in our firm. I walked off the floor after a really violent move in the Euromarks, and the Euromark was the European interest rate curve, not the euro, not currency pair. It was an interest rate curve, and there was something in the German money supply that had caused a big shift in the curve. And it was a huge day, and I walked off the floor with a trader, and I said, "How's your day?" He's like, "Oh, it's really good." I was like, "Really? How'd you get on?" He goes, "I lost 800 ticks." And I was like, it's about 25 euros a tick, I think, at the time. So it's a significant amount of money. And I was like, did you say it was really good or really bad? And he goes, no, it's really good. He goes, because I traded incredibly well, and it could have been 10 times worse. And I'm so proud of the way I traded. And it was clear that trader was big enough to be able to handle those types of losses, that it didn't impact him mentally, and he could continue to trade well. He could save his P&L, could get out of his position for him, a risk managed loss. And he's feeling good about his trading, and he can come in the next day and work on getting it back. Whereas for me, when I lost that sort of money, I wasn't prepared for it, because it was much more than I could make in a day, and it was much more than I could sort of see any light to the end of the tunnel. So again, circling back, when you're sitting down and, an average day for you is $300-400, try not to lose more than $300-400 in a day, because if you do lose that, then you just go have a reasonable day the next day and you're back. Whereas if you use 3 times that, you're going to have to go through 5 or 6 trading sessions before you break even. And that is incredibly demotivating.
It's very interesting, because I think if I was faced with a similar situation, which I have been actually, my instinct is to fight. I'm like, I need to win this back ASAP. And sometimes I feel like it has to be today. And you just end up going on tilt, and then you get out of this mental state and you're like, what did I do? And it's interesting to see that you had your similar experience, but that almost paralyzed you to not take any movement. I want to end the show with a question that might be interesting in your position, being in the online prop space, which is, in the end, a goal of a trader is to make money. And now when we're speaking about risk and blowing up big numbers and the psychological impact it can have, that is obviously to the detriment. especially when it's large numbers, which is amplified in a prop firm scenario because is maybe demo or whatever the case may be, but you're seeing big numbers on the screen, bigger than you're used to. Otherwise, you wouldn't be on the online prop firm. But then the people that are here just to make money and they don't care about this perfect trader philosophy and a long-term track record. They just want to, kind of flip the coin and just payouts versus buy-ins, valuations versus payouts, let's say. And if they have a risk reward there, they might spend $5,000 on challenges. They might get 20K in payouts. They might blow a bunch of accounts in the meantime, but they made money. How would you respond to a trader who is trying to take that approach, especially because there is plenty of traders online that are doing that successfully?
If we step back, when we set up Trade Day, it was in 2020 before there was this huge wave of competition and people doing this in the space. Before, what I would call this phase of the maturing of the space happened. And for us, it was about crowdsourcing a successful trading group, trying to find the needles in the haystack. Fast forward 5 years later, and I know that that's only part of our business. The other part of our business is the entertainment business, the entertainment aspect, the online casino almost, and that there are a subset of our users who are here to take advantage of the prop firm structure and play the odds. And there are a subset of our users who really are interested in becoming successful long-term traders. And the problem is, I think, where those two intersect and social media. And I feel like there are a lot of influencers in the space who are portraying the toxic flow, playing the prop firm odds, portraying that as being a successful trader, and it's not. And if the prop firm space ever went away, or a trader was unable to operate within the prop firm space and had to do it with their own money, they wouldn't be able to do these types of trades.
And they're stuck with bad habits.
Bad habits, So, we create a lot of content on our site for people who are genuinely interested in becoming successful traders. We try and manage expectations. We try and provide tools that will help people find their edge. And that appeals to the group that are interested in becoming successful long-term traders. But what I would say to that group is, ignore a lot of the action that's happening on YouTube, the account flipping, like you say, the quick, fast payouts. I mean, the people that are in our live trading, our A-book, and the people that are doing well are the people that have built up their trading accounts. We have one trader who I'm in contact with in the last few days who got his account up to about $150,000 in the A-book in the live market. So, it's great. We're aligned. We're trying to help him. But every time he hits 150,000, he starts to fall back. And he's reached this kind of like psychological ceiling that he can't go beyond. But what I see in his trading behavior is excellent. So he falls back. And these what I call ceilings in your trading account are very common. Happened to me, happened to many traders I've managed over the years. You get to a point you just can't seem to get beyond. And your P&L seems to fall back. But what I like about this trader is he does the right thing. He immediately scales back his position size and recovers slowly, and then the problem is once he starts getting up towards 130, 140, he starts increasing his position size, looking for the big trades to break through, and he hits the ceiling again and falls back. And he's fallen back about 4 or 5 times. And I reached out to him to see if he wanted to have a chat about it. I'm still waiting to hear. Hopefully the end of this week, we're going to get together. But this is perfectly normal behavior, and this is stuff that we want to help these traders through. But the one thing that's common about this trader is, or the one thing about this trader versus the account flippers is that his approach has been, I'm not going to take quick payouts. I'm going to build my account. I'm going to take the appropriate amount of risk for my account balance. And that's what's led to his longevity and his growth. And what we see typically with people who are blowing accounts quickly, who are funded and get into a payout situation, is they'll make some money and they'll want to take 50% of what they've made. And I'm like, well, it took you 3 days to get there. So essentially what you're going to do is leave enough money for a 1-day loss. And, sure enough, you're going to hit that 1-day loss, 2-day loss, and you blow the account. And it starts, they're in this sort of cycle of flipping over. And, that is in itself a strategy for some people as well. But nothing makes me more angry is then to see this person, you know, blasting all over social media. I took at least 4 payouts, look how successful I am. And I'm like, well, I haven't seen anything in your trading that suggests to me that you're a good trader, you know, so don't buy his course, you know, you know, that kind of thing. But it is something we have to live with, running a trader evaluation service. It's the way, you know, the way that it's set up means that there are ways that you can exploit the industry to your own gain that you wouldn't be able to do if you were trading your own capital. So we just have to live with it.
Amazing episode, and I just want to say thank you. I'm sure everyone loved the episode, and thank you for giving us the opportunity to hear from your experiences and thoughts.
Thank you. Thanks very much.
Amazing. Boom. Excellent. I really enjoyed that one. That was a lot of fun.
Good. Excellent.
In this monumental episode, we have the all-time record holder for the World Cup Trading Championship, a record that has lasted 38 years, where the top 3 global traders achieved between 200 and 400%. This trader has achieved over 11,000% in a single year.
The main reason traders fail is because they don't have the correct knowledge. They fall for something on the internet they think is a winning strategy because the guy shows himself with a picture of a fancy car, a fancy girl or something. You have to have something that works. Then you have to bring that in and you have to work it.
Introducing the trading titan and industry legend, Larry Williams, a father figure in the industry with 60 years of trading experience, being an author of 11 trading books and mentoring and guiding generations of traders after him. In this episode, Larry reveals exactly the strategy that he used to take $10,000 to over $1.1 million, but also deeply exploring what it takes to make a profitable strategy that stands the test of time. And most importantly, Larry shares the trading secrets needed to break his world record performance.
People didn't believe. They thought that there was a bogus account, that I put the winning trades in one account, losing trades in another account. The government came in and audited everything at the brokerage firm, my records. Oh, he's cheating. No, I wasn't cheating. And the proof is, what's the favorite market? What market you like to trade? What's the best market to trade? Here's the best market to trade. The one that's set up the most right now, today. It might be gold now, it might be silver next week, it might be potato chips, who knows? I'm looking for a market that has cycles, seasonals, commitment to trade report, accumulation going on. I go through all the markets, I make a list every Saturday. These markets are set up to rally, these markets set up to decline. Then I go to the daily chart and say, okay, where are we trend-wise? Can I get a trend change here? Significant trend change, where would that be? Then I can place a trade.
I'm going to regret not asking you this question, so I'm going to ask it anyway. Whenever I scroll on X, everybody's mentioning your name constantly, always in reference to the World Cup and how people want to dethrone you. And there's a key figure that is ICT. There was a viral tweet that went around where he personally emailed you, letting you know kindly that he's going to dethrone you.
Everybody wants to beat Larry Williams. You know what?
I rarely get nervous for an episode, and this one was an absolute honor, because not only is he a dream guest of the show, he's actually one of those trading legends that I've been hearing about since I started trading over a decade ago. Because in the end, he is the all-time World Cup trading champion, and most impressively, he achieved his record in a market crash where everybody was losing money. He's taught millions, he's traded live for 6 decades where most traders have given up, and when I got to sit down with Larry, I was blown away by his generosity of what he was sharing, a trading blueprint from the ground up, with the foundations of how to understand market cycles all the way through to finding an entry, and then on top of that, money management and psychology. So this conversation is not just another episode. It's an absolute trading masterclass from a verified trading legend. And with that being said, let's get into this episode. Ladies and gents, we have the honor and privilege. Larry, I really want to express, first of all, gratitude. When we first started the show 2 years ago, I had a list of names that I thought would be dream guests, and I'm really honored to be here. When I scrolled Twitter in the beginning years of my trading career, your name would always come up. Obviously, through your success in your career, and you've left a legacy with the 11,000% achievement that you've had. You've probably spoken about it a million times, so we'll leave that towards the end. But getting into learning about you, your strategy, and everything that you believe in, something that stood out to me is you used to be a mechanical trader. Around technicals, and I guess that was your lawyer background, that if this then that, and as you've evolved in your career, you've moved away from technicals. So what is your stance on utilizing technicals as a whole?
Well, I think there's a place for technical analysis, but it's a well-defined place, and to me, technical analysis is best for identifying the trend and a change in trend, and there are certain patterns that repeat that are really consistent that can be used for shorter term trading. But to think that technical analysis will always predict what's going to happen, I think is false. I think charts show where the market has been, not necessarily where the market's going to go. They're like chicken scratches, is what price did, but what's price going to do tomorrow? That's what I need to know.
Do you use price action in a way of what is happening at the moment as an execution entry point, or do you use the historical price points to tell you a story of how we arrived here?
Well, that's a great differentiation. A lot of people don't see that. I think markets are driven by conditions, not charts. So these conditions exist, an oversupply, undersupply, or a panic, or whatever the condition is. That's what causes the markets to move. But action on the chart, technical stuff, is just the emotions of the day. So to read a chart, you need to look at the chart and say, what were the emotions today? Oh, everybody's really bullish. Well, if it doesn't continue that bullish tomorrow, that's hey, you just got the information you need to know. So I look at charts as the emotional picture of traders and looking for trend changes, of course.
So when you say emotions, are you utilizing price to then understand where is max pain, max greed, max fear? Is it related to these things?
Absolutely. If a market closes on its high, it's probably not going to continue going up tomorrow. I like to see markets, if you look at any major market low, stock or commodity, most always they close on the low. And at major market highs, they close on the high. But everybody's bullish, like, oh, great day, I'm long, everybody's happy. Then it collapsed the next day. Like, why? Well, there were too many buyers. So it's really interesting. There's a cycle, not a time cycle, but where that close is in the relationship to the range every day. The lower down you close, the more bullish the next day will be. The higher up you close, because you're extended, the more bearish or the opportunity for a decline tomorrow will be. So where the close is within the range, if you measure that over time periods, you'll see there's actually a cycle. Like, oh, we have a lot of low closes. Now we're going to have high close. The market goes from low closes to high closes. That's an internal cycle of the market.
Do you believe in the traditional schools of thought within technical, where there's Wyckoff theory, Elliott wave theory, the pattern traders? There's an abundance of strategies, and they're always evolving and new ones coming about. And you've probably in your time seen them all. Any of them that stood out to you as worthwhile?
Well, you're right. When I was lucky, when I started, there were only like 3 theories in the market. Now everybody's got a computer. Everybody's got a theory, right? So I don't know. The best way to prove a theory is with trading results. So show me trading results of Gann, Elliott wave, whatever the theory is. Show me some results. Somebody's actually doing it. I can't find it. So the other part is, I have friends that are Elliott wave people, and they swear by it, they love it, whatever. I don't get it. Now, that doesn't mean it doesn't work. It means it doesn't work for me. I couldn't play basketball. I played football in college. I could never play basketball. I didn't have the skills to do that. So some people's minds process information differently. But I look at Elliott wave and I go, all this stuff. My mind, I'm not that smart. I was so lucky that I didn't take business classes. I was always like not the smartest guy in the room, which means I never overthink things. I can't overthink things. All my intelligent friends that try to trade, they overthink everything and they make wrong errors. It's really good not to be too smart, because you don't overthink anything. It's like it's right in front of you. That's what it is. They're always overthinking everything.
There's kind of two sides of the spectrum here, where one side would be every strategy works, you just have to make it work. And then the other side that I see is every strategy works sometimes, and that's the key, where let's say you have a broken clock. At 6 o'clock is correct, 6 a.m., 6 p.m. The rest of the day is not correct. And people say that a lot of these strategies work sometimes to get people involved in the market and ever losing. Do you believe it's one side or the other?
No, I think you just have to respond to what's going on. The markets are imperfect, and people try to think it is perfect. That's the problem. I've had a lot of people with deep mathematical backgrounds come to the market and totally blow up. They're trying to use math, which is perfect, on an imperfect thing, and you can't make what's imperfect perfect. Another really good analogy, I played football in college, as I mentioned. Well, every play in American football is designed to score. If this guy blocks this guy blocks that guy, the guy with the ball will score. Well, but they don't score in every play, right? That's reality. somebody else changes the perfect play. And that's kind of like the market. Every trade I put on should be a big winner. It isn't. So, like Mike Tyson said it best. He said, everybody has a game plan until they get punched in the face. And it's like, the market's going to punch you in the face a lot more than Mike Tyson will.
Going off this sports analogy, you know, at the start of the game, you have a play in mind, and maybe it's going well, and then something happens that you couldn't forecast. And I see this with the markets, where today I make a decision based on all the information I have, technical and fundamental, and then as weeks go on, things change, and now what was once correct is no longer correct. Kind of linking here to time horizons, where the longer you hold a trade, the more things that can happen in between, and therefore the degree of certainty could go down compared to someone who's holding a trade for an hour or two. What is your beliefs? Because I know you are a swing trader or a long-term hold. With this degree of uncertainty, why not choose to be on the intraday timeframes?
The problem with intraday time trading is purely mathematical. You stop to think about all profits in the market are the basis of trend. If we don't have a trend, you're not going to make any money. It doesn't matter if it's real estate or stocks, what, it doesn't matter. You have to have trend. So, what's the function of trend? Time. So a day trader can be in a trade for 4 hours. He can't catch any big trend move. I can be in a trade for 10 days, 12 days, a month, 6 months. I can catch a huge trend move. So I have time is on my side. It's an ally. I can capture trend moves. The only way that when I did a lot of short-term trading, if I made a lot of money in a day, I had to risk a lot. If I want to make $10,000 in a trade today, I've got to have on, 5, 6, 7 contracts. So if you risk a lot, you can lose a lot. Whereas my trading, if I have a small position and catch a big move, I can have a lot of little losses and still catch out one big move. I'm way ahead of the game. So it's really, there's an interesting report I just saw over the weekend of all the successful strategies that are around. Though in real-time performance, the ones that made the most money have the lowest percent of accuracy. The ones that had the least gains had the highest percentage of accuracy. So they got what everybody wants, like, I won. But you didn't win very much, and when you lost a lot. So really a tremendous insight there into the markets.
Let's take a moment to talk about a partner of the show, a leading prop firm that is Funded Next. And it's important for me to listen to our community to see who are you working with and how can we make your experience better. And the main feedback I heard is trusted payouts, quick payouts, ability to scale, and affordable prices. And Funded Next has ticked all of those boxes, not only being a top 3 prop firm in the industry, but also having on-demand payouts, and every 10% you gain on your account, you will double your capital for free. And because in this industry, trust and reliability is the most important factor, an important guarantee that they have is that if you do not receive your payout within 24 hours, they will gift you an additional $1,000 to your payouts just for being late. So to unlock all of these benefits and work with a leading prop firm in the industry, Funded Next, check out the link in the description or use the code TOT. Would you therefore say your win rate or accuracy rate is not as important as your risk to reward per trade?
Well, clearly, I'll show you a system that wins 95% of the time and loses money. Because you had 95 winning trades, looks great, and then you have 5 trades that blow up and lose everything that you had. So, yeah, winning is important because we all like to be stroked and feel like I'm doing something good here. It's hard to be right 30% of the time, which a lot of the trend followers are. I want to be more correct than that for myself. But we're hardwired to be right. Dead right, unfortunately, usually.
I think that gets into ego and other things, which I want to touch on later. I want to bring this to the COT report, and probably you were one of the first people utilizing the COT report.
I was the first.
Actually.
The very first.
But before it was a digital thing that we could all access, it was probably shipped to your house and so forth, and a completely different process. Nonetheless, I've spoken to a lot of traders now that are utilizing the COT report as their primary source of information. And the general consensus that people use it with is understanding what the big players are doing to identify a trend and then become trend followers, and bringing in this belief of self-fulfilling, that if the big players are all buying with serious money, the market must go up. It seems your approach is more contrarian to this. So first of all, this premise that most people follow, would you agree with it?
Well, let's go back to the very beginning. Most people don't understand the COT report. It's a report that's issued every week through Tuesday, so we know through Tuesday's action, what three players in the market did. The small traders, little people, if you will, the institutionals, the fund managers, and finally the commercials. Well, what's a commercial? This is the critical point. A commercial is defined as a user or producer, a hedger. So the hedgers are not buying the commodity. They're hedging it for their business purposes. So you'll see a big decline in the market, and the commercials steadily increase their long position. But they're doing that because they're going to take this product in demand, take it and buy a lot of sugar. If they can buy sugar lower now than yesterday and lower next week than today, their candy bar, which will still sell for $5 a candy bar, their cost of production is a lot lower. So they will buy a lot of weakness because they're actually taking the sugar, cocoa, gold, whatever it is, their cost of production is lower. So they'll accumulate. So you need to think that they are accumulators. They're not trying to time the market. So COT is not a timing mechanism. It's a condition that says, oh, these guys are heavily long or these guys are heavily short. We're probably in the area of a rally or decline. Doesn't mean it's going to happen today. That's when technical analysis comes in. But it's a setup. And you need to really look at these three parties. And in some markets, as we mentioned, like in hogs and cattle, the small traders are really good. They're as good as the commercials. In fact, they almost parallel what the commercials are doing. So you need to understand the markets as well.
Is the appropriate use of the COT report to use it as almost a leading indicator to forecast what should happen?
I'd say a suggestive indicator that when, and it's not the only condition I use, but if I have 3 or 4 conditions, I like valuation, I like commitment traders, I'd like seasonality, I like cycles, I like accumulation. If I got a bunch of things, then markets, I got a lot better chances of market rallying. So I would never rely on say this one indicator is it. There's no one path to heaven, and so it's one of the tools that I use. It's a good tool, but it's not a be all end all tool.
So of course, a lot of people use the COT report, and I've spoken to a bunch of them, but I don't think anybody is utilizing open positions in alongside, whereas it seems like that was a cornerstone of what you did. Can you explain the relationships of the two and how you benefited by using both?
Well, we talked about the 3 elements of the market: short-term traders, fund managers, and commercials. There's another aspect, which is total open interest. That's all the contracts that are open today. So if there's a lot of contracts open, somebody's been doing a lot of buying or selling, what's been going on. So, and if you just look at any chart, you don't take my word for this stuff, let the charts teach you. Whenever open interest is really high, we're most always at a significant high point in the market because a lot of interest, everybody's in the market. And when everybody's in the market, there's nobody left to buy, right? So the markets come down. So I want to look and see who drove open interest up. If the big increase in open interest is caused by the commercials, well, that's bullish. But if the big increase in open interest is caused by the small speculators, who are usually wrong, well, that's very bearish. So open interest is really helpful. I kind of pull it apart and say, who's driving this market now? Who's causing the action? I love to see open interest going way up, public way up there buying, and commercials are getting out of the market. That's what's happening in gold right now. Gold's going to come in and start to come down. There's a condition here. The commercials ultimately are going to be the winners. It might take time, though, why you need to use technical analysis.
So here it seems that you're utilizing a few confluences together to then be not the trend is your friend and go with the big moves. It's rather wait for the big move to happen and then look for a catalyst to get the mean reversion.
Yeah, the way I sum that up the best, people, whenever I lecture, well, what's the favorite market? What market do you like to trade? What's the best market to trade? Like, man, if I got $1 for every time I heard that, I wouldn't have to trade. Here's the best market to trade. The one that's set up the most right now, today. It might be gold now. It might be silver next week. It might be potato chips. Who knows? But I don't have a love affair with any market. I'm looking for a market that has cycles, seasonals, commitment to trade report, accumulation going on, a little bit of trend change in it. That's the market I want to trade. There's no be-all one market. There's no be-all one indicator. So I'm shopping every weekend. Most of my trading time my research time is on Saturday morning. I go through all the markets. I make a list every Saturday. These markets are set up to rally. These markets set up to decline. Then, on a weekly chart, then I go to the daily chart and say, okay, where are we trend-wise? Can I get a trend change here, significant trend change? Where would that be? Then I can place a trade.
So building these things together, I just want to bounce off you, repeat what you said. We're looking for outsized opportunities, risk reward potential. So you will then use the COT and open positions to find a crowded market where everybody is on one side and you just need a catalyst to then go the other way. And then you bring in accumulation, which is you're sensing this behavior shifting. How do you read or define an accumulation?
Well, I would bring in accumulation. Commercials buy and sell stocks or commodities different than the public does.
Okay.
So years ago, maybe 35 years ago, after I said I was the first guy to use the trade report, I started to realize the buying pattern of these people. So by analyzing their 18 relationships between today's open, high, low, close and tomorrow's open, high, low, close, I can analyze those relationships and pick out what the commercials were most likely doing. So I have a synthetic index that will measure when they're accumulating in the market. But that's just one tool again. But I still would want to bring in valuation. My valuation model is just like, it's not a timing tool, but boy, markets get overvalued and undervalued, and that's when you really want to step in if the commercials are there and accumulation is there. I mean, it's kind of boring. You have to wait for all this stuff. Everyone's buy, sell, I want to sit back. I've had, I don't know how many millions of trades in my life. I don't need more trades. I want a good trade. I want a big trade, and that's patience.
So here we're not actually referring to accumulation through a technical perspective, let's say a Wyckoff perspective of a zone of consolidation before a market expansion. Are you referring it to more these?
Well, you could use that if you had a market that was conditionally set up. Let's say fundamentally set up.
Yes.
Then you can bring in Wyckoff or waves or astrology or, just throw a dart on a dartboard, whatever. Then you could do any of that stuff. But again, this is my core belief. Could be wrong. But my core belief is markets move for reasons. They go from here to here because of a reason. So I've got to have the reason here. Then you can bring in Ouija boards if you want to do your timing in the marketplace. But to me, the markets are so conditional that I want to start with a condition that I probably should rally her, then bring in all the mumbo jumbo of technical analysis.
Why do you think that, at least in my generation of traders, everybody looks towards technicals pretty much only and all the resources and spend all their time on technicals, whereas for you it seems like a bit of an afterthought? It's just for execution and anyone will do. It's more about the positioning in the market and the setup first and then execution later.
Oh, I remember when I was young once and had those same thoughts. It was all technical analysis. And that it was just like, well, think it through. Just think about it. Markets move because of charts. No, charts don't move markets. There's got to be a reason why these things move. So, and the other reason why, when I was young, I was really into charts, and young people are now, and young people 100 years from now will be as well. It's easy. I was like, oh, I can read a chart. Well, I can't read Hebrew. I can read English a little bit, but it's a whole new language. There is a way to read charts. My friend Tom DeMarco has done a great job of breaking that down into structure. And charts are readable, but they don't tell you the magnitude of the move that's going to come. They just say we're at a high or a low. So the magnitude, again, I think comes from conditions. Some of those fundamental conditions, some are technical conditions. But the market's got to be conditional for me to really want to get involved in a big way.
For the last 2 years, a proud sponsor of the show is a top-ranked leading prop firm, Alpha Capital. And for the years that I've been working with them and the thousands and thousands of viewers, you guys that have been working with them through the discount codes of Titans of Tomorrow, it's clear for me to see why they are a top-ranked prop firm in the industry. They have also reached a monumental milestone of $100 million in payouts. And with the multiple step plans and the multiple package types they have, there's going to be an option catered specifically for what you're looking for. So you can buy an evaluation account catered to your needs at the most competitive prices, and with our discount code TOT for Titans of Tomorrow, you're able to get the most unbeatable, unmatched prices in the industry with a leading trusted prop firm. And with that being said, let's get back to the episode. So naturally, when you are looking for these outsized returns and you're going against the majority consensus, it all makes sense in theory, but the first alarm bell that rings in my mind is, how do you stop getting bulldozed or catching a falling knife, because of that famous saying of the markets can remain irrational longer than you can remain solvent. Do you not fear that you're picking tops and bottoms here?
Oh, I don't try to pick tops and bottoms. I'll leave that for the younger people to do. I just want to try to get a chunk out of the markets. Maybe I'll be close to a low. I don't know how many trades I've had in my life, 10 million. I think I got the low markets twice. Just throwing darts, I should have done better than that. So it's an impossibility. I'm not going to try to catch the low. And people who say they do, they maybe got one, they'll brag about it, but there's no consistency in that. There's no truth in that. So I just want to try to get a move in the marketplace. And precise timing, I don't know how to do it. I'm just not smart enough to do that.
It seems your beliefs on risk are pretty different. I want to first speak about the World Cup performance and how you risked that, and then in general in your career, how you risked. But what is your relationship like to risk, and is it something that would be one of the more important factors, considering win rates is probably not that important?
Well, without risk, there's no reward. So the greater the reward, the greater the risk. And the problem with that is, if you're going to have that high exposure risk, you got to be really accurate. And if you're not really accurate, you're going to blow up in a hurry. So if you're going to maximize your risk, and there's Ralph Vince has written about the optimal F, there's an optimal risk that you should have, but you're so close to disaster that it probably isn't good for most people. And there's also the emotional aspect of it, is that, yeah, I can lose 30% of my account in one trade. Most people can't do that. They can't emotionally handle losing a third of their wealth in one trade. I'm not smart enough to worry about it, I guess. Being Norwegian helps a lot. Sometimes they're a little slow. But you have to find your risk point where you can risk that and still not go crazy. As I mentioned, I've had 6 friends commit suicide in this business. One of them, the last one, didn't risk all that much money, but to him it was. And he had a success of losing trades. He thought he just couldn't handle the losses. And the last one was in a soybean trade. He hadn't lost all that much money, but he found a shotgun. So while there's an optimal amount of money you should risk on a trade, irrelevant. What risk can you handle? At which point can you go to sleep, wake up once or twice during the night? Well, that's fine. But if you can't sleep at night, then you're risking too much.
Would you say this is a factor of nature or nurture, the tolerance to risk?
Well, I don't know. But some people can handle more risk. Some people are more emotional than other people. So that's where you have to kind of plumb the depth of your soul and find out at what point can I really handle this stuff.
Were you someone that was always head on towards risk and could stomach it, or is this a muscle you've trained?
Well, I don't know if it's like you can stomach it. It's like some of us have so much belief in that things will work out. Optimism, God will prevail, whatever. So I've been in a lot of problems in my life, but I've never worried about it. I'll get out of this. But some people worry about everything. It's going to rain today. Well, it's a beautiful day. Well, it could rain today. I can't go out today. They worry about everything. Well, they're not going to be very good traders. They're too emotional. So there's some balance point in there where you go, I always thought my life would work out. I grew up in Montana, and I learned to live off the land. I mean, I could walk out in Montana and live the rest of my life in a cave someplace. I know how to survive living off the land. So ultimately, I don't have any fear of life. There's no fear of, I die, whatever, okay. But I can survive. A country boy can survive. And so why not risk something? Let's see what happens here.
There's beauty in the irony that the more willing you are to go back to zero, the more likely it works out, because then you can actually stomach the risk and see and hold trades for long enough to see them to their potential.
Yeah, I think as I've gotten older now that I'm 83, I don't risk as much as I used to. I don't have to risk as much as I used to. And I don't have the energy. I saw Frank Sinatra's last concert. He wasn't that good. I saw Muhammad Ali's last fight. It wasn't that good. I saw Tom Brady's last football game. I saw Bob Dylan, a horrible concert now. So I know at some point just because of my age, I have to say, no, wait a minute. Think of Frank Sinatra. He was way off key. People loved him. He was great, but he didn't sing real well.
Are you alluding here to ending your trading career whilst you're on top?
Well, I don't know if I've ever been on top. I have friends that have been really on top, but you want to walk off the stage ahead. I'll still do some things publicly. If you can control the event at my age, that probably will work. But to just keep trying to just pedal to the metal all the time, I don't have the fire. I don't have the burn anymore. You got to have a real burn to do this stuff.
The reason I say this is because I watched an interview of yours about a year ago with Jason Shapiro, and you were mentioning that maybe this is the year that you will retire.
Yeah, I've been trying to retire for a long time. I first tried when I was 30. I made $1 million trading. Oh, great. Tried to retire. After about 4 weeks, I had a nice cabin in Montana. I went out fishing every day. Finally go out, the fish go, oh, you caught me yesterday, put me back. It was like, okay, catch a fish, put it back. I was like, I got bored. What else am I going to do? Mm-hmm. And kind of now I pulled way back. I was like, well, I don't garden, I don't build things. All I know is how to trade. So I still need some involvement in it, but the pressures, from 1962 forward, every day of my life has been about the markets, up, down. And there are pressures to that.
Is this a now intellectual thing or a challenge, or is it still the monetary side?
Well, money always matters. You never have enough money. I was flying back from London one time with a lady who was a housekeeper for the Rothschilds. And we were talking, we were first class, of course, and she said, Rothschild, and I said, oh, wow. Because I know they were all political conspiracies and everything. Mm-hmm. She said, oh, they hate politicians. And I said, what's it like? You're grateful. Oh, look, the refrigerator hardly ever has anything in it. Mm-hmm. People don't realize how they live. I was like, well, that was a wake-up call. I have a friend who's very incredibly wealthy, a multi-billionaire. He's still trying to make money. At some point, I said, you know what? I'm happy where I am. And I don't want to build anymore. That's for people that have more energy. My desires right now, figure out more about how the markets really work in terms of cycles and maybe some trend stuff I'm working on. So I still do a lot of research, and still trading, but hopefully somebody's going to crack this nut of the market. We all try to. Maybe I won't, but it's a heck of a challenge.
What do you mean by cycles? Are we talking just accumulation, expansion, or seasonality?
Well, there's a lot of cycles in the market. There's the cycle we mentioned, closing on lows, closing on highs. That's your natural cycle. Another natural cycle a lot of people don't see is that we go from large ranges to small ranges. And then we have large ranges, we have small ranges. So I like to see a lot of small ranges because then we'll have large ranges where the money's made. Mm-hmm. So that's a cycle of how prices trade. Then there's a time cycle, high here, low here, high 18 days, 33 days, whatever. So time cycles as well. And I think on a very long-term basis, there is some predetermined time cycles in the market that will have been here, we know, 100 years now. The 3.5-year cycle that Edgar Lawrence Smith wrote about almost 100 years ago still operates in the marketplace. Mm-hmm. So trying to crack that code that's a real challenge. And I have the time to do it now.
That side of things gets a little bit freaky. And also, like, we're entering a weird arena. Numerology and astrology in the markets. My initial reaction when I first came across these things was like, hell no, that can't be real. And then as I speak to more elder traders specifically, they are more into this belief. I remember sharing the story with you previously on a guy that I know in Dubai who's one of the wealthiest guys there. He has one of the most expensive houses in a private island in Dubai, and he made his money in textiles and then has been trading for like 8-9 years. And his strategy is he has his 8 gurus from his religion, and if they all give an alignment based on astrology, he will then take a trade. And I had 1,000,001 questions for him, and eventually he was like, son, I don't know why it works, but I've got an 8-year track record and I beat the market every year, and this is what I do, astrology. Numerology and kind of predetermined, as you said. Can you hazard a guess of what do you think is going on here?
Well, I have a similar experience. When I first went to India, somebody said, well, I got introduced to the largest private trader in India. I said, how's he doing? He said, well, I don't know, but he changed his ring because the rings had jewels on them. And if your luck is good, I guess you move your ring around. If it's not good, so he had moved his ring. The jewels were in a different position. And you have to find the shoe that fits you. Some people can use astrology. Some people can use Elliott wave. Some people can use point and figure. So some, I don't know. Some people use maybe the commission trader report. But you have to find what fits you. And that's the interesting point, because if you're looking for a good teacher, don't go to necessarily the best guy or girl. Go to the person who you understand. You go, immediately get his concept. That's your guru, if you will. If you say, I don't understand this stuff, well, don't let him teach you. You're not going to learn from him because you don't immediately grasp his message. Mm-hmm. So you need to find somebody whose work is, I see the sense of this. I see the logic in the way this person thinks. So that's significant. But I do think that there are emotional cycles of humanity, whether they're caused by the moon or Saturn. Or there's a paper by the University of Michigan, one by the Federal Reserve System, that shows there's clearly a lunar influence to stock prices. Mm. Now, it's not large enough to make any money trading it, but and throughout the world, all major stock markets in the world have a lunar influence, but it's very nominal. Okay. Now, maybe somebody that's a really great astrologer can take that to another level, or a lunar person or whatever, that I don't know. But, the way I look at this is like when I used to fight, when I used to box, you go in the ring and you're going to throw any punch you can. You're going to use any advantage you have. And that's in the markets. I mean, I'm in trades right now and I probably did some things that are irrational, but they're based on things in my mind that I may not even recognize. But this is a fight in there. You're going to protect yourself at all times. Like, what's going on here? So whatever works for you, works.
A lot of these strategies, they seem they're built on correlations. For example, let's say a basic Fibonacci, where you have if you were to measure 1,000 impulses and pullbacks, and you measure the depth of every pullback, some of them would be a 99% pullback, some of them would be a very shallow 1% pullback, but the majority would be around the midline, and you'll get a normal distribution. And therefore, it's not that the market is reversing because of the Fibonacci. Rather, the Fibonacci showcases a probabilistic zone. And you could do that with patterns, you could do that with a wave count, you could do that with pretty much every technical strategy. Is therefore looking for correlations an appropriate approach, or should we be looking for some truth and some causation in the market?
Well, first of all, I did the studies where we measured all the pullbacks in the Dow Jones Industrial Average for like 7-year time period to see which percentage was hit the most, 50%, 38%, 62%, and the highest number was none of the Fibonacci numbers. So I think you have a bell-shaped curve. You're going to have enough. There's going to be distribution of the data. So there's no magic number. 50% of retracement sometimes works, sometimes it doesn't work. It's just luck of the draw, really. It is a very random process of what markets do, and if you got to keep that in mind. There's a lot of randomness because news comes in. So, and the other point is that correlation or causation.
Yes.
And that's my point. I think conditions cause markets to move. I think there is causation. If there is a premium in wheat, there's only one reason that premium exists. That market is bullish. So that's causation, not correlation.
I want to move towards now the experience you had with the World Cup. How many times have you participated, first of all?
In the World Cup?
Yes.
One time.
Oh, you participated one time and you achieved a world record with 11,000%. Talk me through, looking back, what was the key takeaways of what contributed to such a large performance that no one has come close towards?
Well, my daughter came pretty close. She took 10,000 to 110,000. She's the second largest gain. Some of my students have done consistently 300, 400, 500% a year. Wow. So the fact that I had a great year in the market, it was an ugly year for people around me, I think. I was so focused in the market that I probably wasn't a very nice person to be around. I was just like in the market. And I had high risk in every trade, close to 30% on every trade I took. Mm-hmm. So, it was a good year and it was a bad year. People didn't believe. They thought that there was a bogus account, that I put the winning trades in one account, losing trades in another account. The government came in and audited everything at the brokerage firm, my records, because everybody said, he's cheating. No, I wasn't cheating. And the proof is, at one point, the account went to $2.2 million. And then in the crash of 1987, it came down to $750,000, and I traded back up to $1.1 million. So if you just look at the records and all the trades are someplace on the internet, they have all the trades. You see, I had big winners, I had big losers. This is trading. This is hand-to-hand fighting.
So it's funny to know that everyone remembers or knows about the 11,000%, which is the 1.5 that you ended on. But your peak was about 20,000% when you were at 2.5 million.
Yeah, my wife said I should have quit there. She said, that's the year I lost $1 million. So I went from 2.2 to 1.1.
So what happened in that period?
So it's all perspective. Well, we had the crash of 87, and we were short bonds or long, I can't remember which. We had a big position in the bond market. I was in Africa on a safari, and the markets gapped way up, and we had to get out of the bonds. And it was a huge loss, and I mean, it was a big loss. But you have losses in this business.
Did the monetary side hurt you, or were you more in competition mode to lose $1 million? Okay.
The money is like, no, we got to get back in trade. I mean, you can't let the market hurt you, because then you become emotional. I have trades, I have losses, but my losses don't have me. I mean, I see people carry around losses on their back like, oh, I lost all this money. Yeah, forget it. Move on. It's easier to make new money than try to reclaim old money. I see people suing one another over whatever. It's a waste of money. You go make more money. You made the money. That's an optimistic, positive thing to do. Trying to recover money, it's a lot easier to go make money.
There's that famous Ray Dalio saying, and actually it's a buddy of yours, which I came to learn, but this idea of that if you lose 50% of your accounts, you have to gain 100% just to get back to where you were. When you're doing a 30% risk per trade, 2 or 3 losses, and you're in such a deep hole that the recovery might be extremely challenging. What I want to focus on here is the idea that, let's say I have a 50% win rate. I would love if it was win, loss, win, loss, win, loss, in a nice way that I can absorb. The reality is there's going to be a random distribution where I take 10 trades, 5 will be losses, 5 in a row, and then 5 wins in a row. Still 50%. The distribution made it very difficult emotionally. When you're doing 30% risk, though, the chance of having 2 or 3 losses in a row is probably very high. And therefore, the risk of blowing up the account is very high. How did you protect yourself across a year and many trades to not encounter a complete blow-up period?
Don't be wrong.
Elaborate, please.
If you're trading at that speed, if you will, that much pressure, you can't be wrong. You got to be really certain. You have to have a great advantage in the market, which I had at that time. The advantage doesn't exist anymore. It was pit session markets, and we push it to the max. I don't know if I risked 30% on every trade, but it was you look at the contract size I had on it, was large risk. And you can't let the numbers bother you. And it was a competition. That the interesting, another side of that, during that same time I was managing money, and we took an account for a lady named Susan B. Kringle. I'll never forget her name. She had $60,000 in her account. She closed it out with about $500,000, vaguely, maybe a little bit more than that. And then she sued me for $53 million, saying that her account should have duplicated my trading championship account. Though her account was traded at a different brokerage firm, But that was where I said, you know what, I'm not a fund manager, and I don't want this exposure. I don't know about you, but you lose a couple of $53 million lawsuits, that can hurt. Eventually, the judge threw it out, said you can't sue for speculative damage. She made, how do I get in touch with Williams? She made a lot of money here. But I was like, I fortunately have known some of the great traders, money managers, and they put together great trading rooms and vehicles and raise money. All I ever wanted to do is beat the market. I didn't want to, not a business person. I don't know how to run a business. Those guys do. Paul Tudor Jones, great trader, but a great businessman. Thanks to Peter Borsch, he captured money management. And I think Peter's the major reason he's been so successful. The Campbell brothers, who started out with the same mentor I did, Bill Meehan, they're business people. I just, I started in school as an art major. I'm an artist. I just like to maximize this stuff. Running a business is never, and that's not my strength. My strength is looking at the markets. You
mentioned earlier that every trader, they kind of taught trading 101, risk 1% per trade. You mentioned off camera that the optimal place a trader should be doing is 4% risk per trade. Why is that?
Well, because of what you touched on earlier. If let's say I have a $100,000 account and I lose 3 trades in a row at 4%. I've lost 12% of my money. Most people can handle losing 12% of their money and still get ready for that 4th trade. And you still get a maximum return. At a 1% or 2%, well, you're going to have a lot of losing trades, but it's a long way coming back up. So if you get much over that 5-6%, you get 3-4 losing trades, you're blown out. Most people don't want that. So the optimal wealth producing number is about 20%.
Oh, okay.
But you know, at that bell-shaped curve, you're over here, and your risk of ruin is right in front of you. If you're on this side of the bell-shaped curve, your risk of ruin is way over here. So somewhere, I think 4% is the optimum for maximal losses in a row that you can live emotionally through.
I've spoken to a variety of guests on the show, and a unanimous common denominator between all of them is the emphasis they put on data and actually knowing the inner workings and the insights of your edge and your performance. That's why I'm proud to bring a partner of the show, TradeZeller, the #1 journaling, backtesting, and all-in-one insights experience created by traders for traders. What TradeZeller really gives you is deep insights about your trading that would ordinarily not be visible, whether it's through understanding your trade types and playbooks, or even insights powered by artificial intelligence through Zeller AI. Whether you trade Forex, futures, cryptos, the stock market, it all seamlessly connects to TradeZeller, so there is no additional work. You've seen me reference it dozens of times and all of the benefits I've had in my trading from the insights I found from my TradeZeller. So join myself and thousands of other viewers of the show. You'll get the best discount using the link in the description or code TOT for Titans of Tomorrow. A lot of traders that I've spoken to will do dynamic sizing, where you have a high conviction play, they'll size up, and during a drawdown period, they'll size down. This side makes sense to me, that you have a high conviction play, you want to get more out of it. It's not something I do myself, but I can see the wisdom in it. But the idea of sizing down on a losing period, for me, just screams, and the reason I don't do it, is let's say I'm 10% down and now I'm doing 0.5% risk per trade. Now I've got to get so many more wins just to get back to where I was, and prolonged drawdown is probably just as much of a psychological burden. What is your philosophy in drawdown or just modulating risk?
Well, so what does that tell me about you, what you just said?
Probably that I can stomach risk.
You have confidence that you'll come back. So I know mathematically you're supposed to cut back just like you increase as you go up. But if you cut back at that same rate, your point is well taken, it's going to take a long time to get back. So I don't cut back like you because I believe in the future. I believe in Larry Williams. I've been through a lot of you can't believe the number of drawdowns I've been through in my life, some huge ones. But I come back. So I go, well, I'll cut back, but not mathematically correct, because I have confidence in me as a trader. I'll come back. So I don't cut back as rapidly as a mathematician would.
Confidence can also be heavily tied to or trip over into ego. Is ego a serving force in the market?
Is ego what?
A serving force. Is it something that can assist you if harnessed, or is it something that is going to bring overzealous and a blow-up behavior?
Well, you have to have an ego to do what we do. You have to think you can do this stuff, but you don't think that you're the best, smartest, brightest guy around. You have to have something to drive you, whatever that is, to do this. But you have to be humble. You have to be cautious. The egotists that I know in the marketplace always get in trouble. They're always going to either regulatory trouble or financial trouble. They promise more than they can deliver, and they lose clients because they think they're the greatest that there is. The great traders, as I mentioned earlier, my son is a psychiatrist, trains at Johns Hopkins. He did an interview with successful traders. All the research before had been done with losing traders. Jason, I introduced him to major guys that are billionaires, and he did personality profiles of them. And what he found is one of the most interesting things, they all had a lack of self-confidence. They had confidence, but they were never overconfident. They were humble. And the traders that are buy in New York, sell Chicago, they're the guys that blow up. So balancing, you need drive, that's ego, but you also need to have some fear of yourself.
Would you therefore say that a lot of people do whatever they do in life from a place of motivation. I have a goal, I want to achieve it. Would you say that the highest achievers, rather, instead of motivation, it's running away from something, a sense of anxiety or sense of want to make my parents proud, an anxiety force?
Well, I think that we need to have what causes greatness in people is they're upset about something and they have to prove to the world that they're the fastest, the smartest, the richest, or whatever. And it's interesting because maybe you should raise your kids the wrong way. So they all have a lot of angst, so they'll go out and do stuff. That, oh, Johnny, come home, you're such a wonderful kid. Oh, that macrame piece you did is marvelous. Did it amazing. Shut up, Johnny, go to your room. That makes kids want to do stuff. Yeah. So, you know, and some people are just born with angst. They're just there. But you have to be driven to do anything, any greatness, whether it's politics or business or medicine or research. You've got to have some internal drive. You really want to do this. And where that comes from, sometimes from your environment.
It could be a breakup. It could be encountering a big loss.
Or just the way you're born. You know, so, but you need to have that. And then you need, of course, to have some control over it.
So you mentioned 5 points that your son studied in successful traders, one of them being this sense of willing to do more, and greatness is doing what others will not. So I can see that one. I also read a similar study where there was 3 reasons or common traits amongst top CEOs and top performers. So I'm going to mention them and see if they correlate to the other 4 that your son found. One of them was a crippling sense of insufficiency, that they're not good enough, that they'll never be good enough, and that drives them to keep going. Another one was a superiority complex, that they deserve more, that they are better, and I guess that pushes them to achieve. And then an extremely high stress tolerance that keeps them pushing. Are any of these 3 also common in the study you found?
I think the third one is the most important. As a trader, you have to be able to handle emotional swings of greatness. Because you're going to have days where you make a lot of money in a day for whatever a lot is. It's different for everybody. For some people, $1,000 is a huge amount. For some people, it's nothing. But whatever that is, a massive amount of money for you, that's your emotional quotient. And you need to be able to not get too happy when you make that or too sad when you lose that. So your emotions can't fluctuate wildly, which is that third point I think that the study was referencing. And that's just so critical that you have losing trades, get a lot of money. I lost a lot of money.
Do you remember anything else that stood out from your son's study of the 5 traits to focus on?
All the traders were really good with details, which is my weakness. I am just miserable. The worst detail guy in the world.
So you mentioned the main reason traders fail is because they don't have patience. And because you were risking high amounts and going for high risk reward positions, I guess the hardest part also for you would be amplified.
Well, let's back up. The main reason traders fail is because they don't have the correct knowledge.
Okay, lack of edge.
Yeah. Lack of a winning strategy. They fall for something on the internet they think is a winning strategy because the guy shows himself with a picture of a fancy car or fancy girl or something. That doesn't mean the strategy's going to work, guys. It means nothing. So you have to have something that works. Then you have to bring that in and you have to work it. Like you see these race car drivers, they all have great cars. They're all, winning cars, but the driver has to be able to drive it better than the other driver. So you have to have a strategy, a car that really runs well. Then you have to try to maximize that car.
How have you developed the skill of patience over time?
Well, I think my dad taught me patience. Growing up in Montana, we didn't have a lot of stuff, so we hunted. We'd get 4 or 5 deer every year, a couple of antelope, and we lived off the land. So if you want to shoot a deer, you've got to be patient. You have to wait for him to walk in front. Maybe we'll flush deer down here and one guy's there. You got to wait, a lot of waiting and just waiting and waiting. And I noticed early on I would rush into trades, and I think that's probably the number one failure of traders. They all think, oh, this is it. This is a big trade. They got to get in. So we get in too early. I still do that. Am I getting the trend hasn't changed yet, but on my trend, your mind creates the future instead of like, well, wait a minute, it has. Look at the chart, it's there. But because we want to be rewarded immediately, we try to create the future.
I want to speak about this idea of imposter syndrome. So on this US tour, I've spoken to a lot of traders that have 10, 20, 30, 40 years of experience. I think you have the most market experience. So I'm going to ask to you, because they've all said that the feeling of imposter syndrome, that this was all luck, this was all going to change at some point. They said it never goes away. Did it ever go away for you?
The ability to trade?
No, this idea of like an imposter syndrome, that everything that I've done, even if it's 10 years or 30 years or 50 years, that is going to come to an end. I've been on a hot streak. This is all luck.
No, it's not luck. If it was luck, there's no way that my students would have consistently won trading championships. The fact I won a trading championship is immaterial in my mind. It doesn't prove somebody got lucky. That's all it proves, at the most, maybe. But the fact that usually the trading championships are won by my students means this stuff is teachable, is learnable, that people can do it. And I know some people can do it better than others. People that have trouble with it are lawyers and doctors, because they think they're so damn smart they can override the system, and they want to argue. And you can't argue with the market. The market's going to win that argument. So some people are more adaptable to this. And there are some doctors and lawyers that trade well, but they have a different mindset. So the fact that there's consistency of these winning people have a similar background shows that it's not just luck. I mean, clearly, was my 63rd year or 64th year of doing this now. That's a long streak to call it luck.
Yes.
And I've had enough bad things happen in my life that's not luck. I've had some really unlucky things too. So it's like a business, like a guy with McDonald's. Is that just lucky that McDonald's have so many hamburger stands, or Starbucks has so many coffee shops? No, they put together something. Sometimes they do well, sometimes they don't do as well. But if there's a successful strategy, it persists. Well, 60-some years has persisted.
I'm going to regret not asking you this question, so I'm going to ask it anyway. There's a lot of... You've created a legacy, first of all, and with legacy comes a lot of naysayers and a lot of people that would use your name for their own benefit. And whenever I scroll on X, everybody's mentioning your name constantly. For years I've been seeing it, always in reference to the World Cup and how people want to dethrone you. And there's a key figure that is looking to dethrone you, and he has for many years, a gentleman named ICT. Are you familiar with the name, first of all?
ITT?
ICT.
Well, there was a company here in ITT, but that was a major company.
Fair enough. He's one of the largest trading influencers in the world, and he always speaks about how he's going to make 11,000% and then never does. And I think this year or last year, he entered a 90% drawdown. But there was a viral tweet that went around where he personally emailed you, letting you know kindly that he's going to dethrone you. I guess that never made it to your attention.
Well, I get a lot of emails. I'm going to beat your record. I said, I hope you do. Congratulations. I'll shake your hand. I'll be the first guy to welcome you, because records are made to be broken. So more power. Everybody wants to beat Larry Williams' record. You know what? What you should do is try to make some money in the market. Don't get fixed on Larry. It's a trading championship. Get fixed on doing a good job yourself. But when we live in Australia, there's a great phrase there, the tall poppy syndrome. The tallest poppy in the field gets cut off. So if you win trading championships, you get a lot of negative. Oh, he didn't do it. He's an old man. He's washed up. He's 83 now. He can't see, can't hear very well. There's always negative stuff out there. You can't let it bother you. It's because it's going to be there. The thing that does bother me is a number of people that say they're Larry Williams, and they're not. I've literally had a lady call and say, I want to check. I've got Larry Williams wants me to open up an account with him. And I just wanted to check. And I said, well, this is the real Larry Williams. And I don't know who you're talking to, but it's not me. There's a lot of people that use my name. And we try to stop it as much as we can, but you can't catch all the flies buzzing around the honey.
Looking back at your 60-plus year career, obviously the milestone that everyone sees and celebrates is the 11,000%. But I'm curious, looking back yourself on your own career, was that your most impressive feat or something you're most proud of?
Not the most proud of, no. I'm most proud of my children. That I'm most proud of the friends I have from the markets. My good friend Ralph Vince, Tom DeMark, Richard Joseph, a non-market friend. I'm much more, if I look at, what little have I done with my life? I've been able to see the world. I've been able to get some great, strong friendships. and that happened because I was decent at a skill. I have some skill level, but the markets are like a business, and I did okay with it. I could have done a lot better, frankly, but I guess of the market stuff, what I'm pleased with, not proud of, but pleased with, is I wrote books, which means I'll live forever. Mm-hmm. Those books will be around 100 years from now. What did Larry really do? Like Gann, what did he mean when he had a comma on that page? They're trying to decipher messages. There's no hidden messages in my work. Yes. But that's a nice thing about writing a book. You'll live forever in that sense. So that I contributed something, that I won the Charles Dow Award for the Market Technician Association Paper of the Year, the Futures Magazine honorary, a lot of things I've been given, the IFTA honorary achievement awards from most of all the major technical firms have acknowledged my career. Mm. And so I'm really pleased with that I have respect from people within the industry.
I finally have a special offer to share with all of you from the US or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader8 and NinjaTrader that are compliant with CME regulations. With the largest end-of-day balance drawdown in the industry, a 90% profit split and same-day payout. And with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry to make this a home run offer if you are a futures trader. So this episode, as I mentioned at the beginning, was something that I was looking forward to since I started the podcast. And I really wanted to create this environment of 60 years of experience, passing the torch down to someone that has 1 year of experience and going down the generations. And because you've mentioned now you've had students that have had success, even your daughter had great success, you clearly have understood not only the art itself, but also teaching the art. If you are to give some advice on where the first place to begin, or the biggest piece of advice, what would that look like?
For somebody starting out? Well, again, find somebody who your mind is in sync with. Maybe you understand astrology, maybe you understand Elliott Wave, maybe you understand fundamentals and Warren Buffett. Whatever you might say, yeah, I got that. You have that aha experience. Then that's the person you should follow. And then you better check your own emotions and see where your emotional point is, how you can handle losses and how you can handle rewards. Because I remember times I've made a lot of money and I didn't handle that very well. I was too much of a jerk about that. And some of that comes with age. When you're a kid, you're a jerk. I was a jerk. I was a great jerk. Even in my old age, I was a jerk. So you have to deal with yourself.
I want to now touch upon longevity. And I've spoken to a bunch of traders, but it's very rare to find someone who's had 30 years of experience, or 40, or even 50. Why do you think people don't last that long in this game?
Because they lose. Their strategy didn't work, or the emotions are so difficult. The stress. There's a lot of stress to this, but everybody has stress. I have a friend he's not married, doesn't have children, has a dog. He's under stress all the time. I go, you got no stress. You have no positions on, but he does. And so you have to be able to handle stress, because stress is a killer, a physical killer. And so that's a nice thing about not being able to overthink things, is the stress doesn't bother me. I get stressed out, but not to the point that it's like, oh, what am I going to do? It's like, you got to be able to handle stress.
Would you say longevity in your trading career was just linked to overall longevity in terms of health and wellness?
Well, I think that's been part of it. I've been able to maintain a healthy body. I've been really careful about that. Starting when I was just turning 30, I read Adele Davis. And I was out of shape. I'd been in great shape in football, and when I rode rodeo, I was a pretty good athlete. Well, marginally good athlete. And then I realized I was way out of shape. I got to do something. And so I started to pay more attention to my health, and because I've seen a lot of people that get so out of shape or physically or mentally, they can't pull it back. And I didn't want that to happen. So I still try to, as hard as you get older. Oh my gosh, I ran yesterday. It's tough to get
I have
out
to say
there
that as I've got to know you and
tough.
the things you tell me about yourself is just phenomenal. The amount of marathons you've done, even now running 5Ks or 3 miles, is stuff that I challenge myself to do and barely can. So
I used to run a marathon pace, 8-minute pace.
Oh.
If you put a gun to my head, I couldn't run an 8-minute mile now. I was like 16 minutes is pretty comfortable right now. Twice what I used to run full 26.2 miles at. As part of getting old and trying to handle this getting old, because my mind thinks I'm young. I should be running like an 8-minute pace. I can't do it. So it's a lot of frustration. Every time I come back from run, I talk to Luis, like, God, I can't believe I can't run. But
that's the natural discourse of life. But
yeah,
what about
and you accept it.
What about the mental side, where just like the body will not be as it was when it was youthful? What about the mind, or what have you done to keep your mind sharp? Because I've spoken to guys in their late 50s who are traders, and you can see their sharpness has gone.
Who are you? Where are we?
Unfortunately, I had a guest very similar to this that unfortunately won't be uploaded, but he was a big fund manager managing a huge amount of capital. I think he must have been in his early 60s, and you could see memory loss or short-term memory loss was already there, which is very sad to see. But it seems like you've kept yourself very sharp mentally.
Well, I was never very sharp to begin with. I just maintained that same level, I think.
Enough.
Well, I think staying healthy, obviously the more oxygen you get to your brain, the longer your brain's going to hold up. That's pretty basic science. So that helps. And not carrying this baggage of the past on your shoulders. So people get into that, leading a healthy lifestyle. You know, I've tried to lead a pretty good lifestyle, and it catches up with you. I mean, I have my friends that I see and say, yeah, I wish, but I can't tell them. They're not going to do anything about it.
I want to wrap up the episode asking for some fatherly advice. I always like to ask people that have had a full life of experience, and the things you shared with me off camera of the crazy stories in different countries, I'm not even going to get into, but the point here being you've lived life from multiple angles and you've probably experienced it all. My age and the things that I'm chasing are probably very similar to the audience as well. And I'm just about to turn 30 and I'm just crossed the 10-year mark in my trading career, but I felt hungrier than I ever have. And I'm in go mode, I'm in chase mode, I want to do it all. And probably at my age, you were similar. And now looking back, what are the things that you wish you didn't do or wish you would have done more of?
I wish I would have been a nicer person when I was younger. I wish I would have spent more time with my family when I was younger. I didn't do a very good job of that. I was too proud of myself, so I thought I was better than I was. I could have done better research then. I did a lot of research back then. We didn't have computers. It was hard to do real research, but I could have done a better job. I failed at a lot of things, and you just have to work through it, and you're going to have failures. The big thing my father always told me, it meant so much to me. I didn't understand it for quite a while. He said, Larry, you only get out of life what you put into it. And I finally, now I know what he means. If you really put a lot into trading, you'll get a lot out of trading. If you really put a lot into learning to do whatever it is, you're going to become a good architect, lawyer, doctor, plumber, welder, whatever it is. If you really put a lot into it, you're going to get a lot out of it. And that meant so much to me. And I tried to pass that on to my children as well. That's how to have a good life. And the other thing we talked about, a great lesson to me, it's a lot easier to ride the horse in the direction he's going than trying to get the horse to go where he's not. So you guys have really knocked it out of the park with Titans of Traders. This horse is going in a direction. So ride the horse there. Don't suddenly say, well, we want to do a cooking show. We're so successful with Titans of Traders, we're going to do Titans of Cooking. No, stay with what you're doing. And if the horse it's a good ride, stay on the horse.
There you go. Larry, a truly an honor. This was a peak moment for our podcasting career, something that I look forward to since we first started. So I really want to thank you for your time and the opportunity.
Well, my pleasure. I hope that it means something to somebody out there.
I'm sure
everybody good luck and good trading.
There we go. Larry, an honor. Thank you very much.
And what Powell told them and Jackson Hole said, listen, inflation is still way too high. is not peaking, is not gonna fall fast enough. And if you guys think that we're gonna stop raising rates or even cutting them, you're a bit delusional.
The U.S. economy is clearly slowing from the historically high growth rates of 2021.
I think the chair's objective in Jackson Hole was to deliver a very concise message that we know what our job is. Our job is to get inflation back down to 2%, and we're going to do what we need to do to get it back down to 2%.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
His remarks were remarkably brief for a Jackson Hole speech, and that was by design to deliver a very direct message, and I think his message was very effective.
Pain.
Pain. Pain. Some big pain ahead.
Pain for American families.
What he calls some pain means putting people out of work.
Jay Powell is not messing around. And that is when the market kind of reacts and says, oh my God, things are going to change.
Restoring price stability will likely require maintaining a restrictive policy stance for some time.
If the Fed puts us into a higher interest rate world, it will change everything. The financial system globally has been built around extremely low, ultra low interest rates for 10 years. All of these things that got built up over the last decade are going to have to be dismantled or changed.
We will keep at it until we're confident the job is done. Thank you.
We lived in a bubble, in a dream, and this dream and a bubble is bursting.
Rising interest rates in the U.S. and many other countries are intensifying fears of a recession.
Ever since that Fed meeting at Jackson Hole, we've been getting mixed signals about the economy. Is it bound for recession, or is it in a booming recovery?
An economy with such a strong labor market is not in a recession.
At the center of the debate are the actions of the Federal Reserve, which seems to have our economic fate in its hands.
The Fed is trying to stop inflation, but is the medicine worse than the disease?
Lately, it's been raising interest rates at the fastest pace in decades, trying to tamp down on inflation. But for most of the past decade, the Fed was keeping interest rates incredibly low, trying to stimulate the economy, creating what has been called an age of easy money.
Tonight, the economic alarms are blaring.
For the past 2 years, I've been investigating the Fed and the far-reaching consequences of its easy money policies.
I'm game if you are.
I'm definitely game. I've been speaking to current and former Fed officials.
Is that really the first time you're in a suit since COVID?
From the waist down.
Can I take my mask off?
Titans of finance.
You were thinking what?
I was thinking this is the craziest market I've seen in 40 years.
Those who follow the decision-making.
None of us think about this because it's boring, but it's everything. It touches everything.
And those who have been hit the hardest by it.
It's like choosing between your rent and your food.
They do not understand what everybody's going through.
The Fed's easy money experiment traces back to pivotal decisions made over a decade ago, in 2008.
You know what, right now, breaking news here, stocks all around the world are tanking because
when investors, speculators, and Wall Street bankers nearly brought down the global economy.
Get on the train, otherwise it's going to leave the station without you.
Today, with Wall Street shaken to its very foundation today.
We're in the midst of a serious financial crisis, and the federal government is responding with decisive action.
The Bush administration.
The president and Congress spent hundreds of billions of dollars to restart the economy, but at the center of the rescue effort was the Federal Reserve. Richard Fisher was the head of the Fed's bank in Dallas at the time.
What the Federal Reserve does is provide the blood supply for the body of our capitalist economy. And what happened in 2008 is all the veins in the capillaries and the arteries collapsed. So every financial function had failed. It had collapsed. and we had to restore them.
We're at the precipice of the apocalypse.
We're on the edge of the abyss.
We are in the most serious financial crisis in generations.
And there was nothing but panic yesterday. There's been panic all week.
The bottom to America's financial woes appear nowhere in sight.
The banks are still not lending to one another, and as long as that's not happening, the system remains stuck and imperiled.
In normal times, the Fed's job is to promote employment and keep inflation in check, primarily by raising and lowering short-term interest rates, making borrowing cheaper or more expensive. But amid the crisis, Fed officials decided to do something they hadn't done in half a century. They began dropping rates, eventually to almost zero.
Those massive rate cuts have not been stimulating the economy, so it's the other thing.
With Americans still suffering and the banking system on the verge of collapse, Fed officials there at the time told me they felt compelled to go even further.
And then the question was, what else can we do? And the committee came up with the idea of quantitative easing.
Quantitative easing. What in the world is that?
Quantitative easing. That's just a Greek term to a lot of people.
A lot of people want to know what they're going to say about what we call quantitative easing.
Quantitative easing, or QE, was championed by Ben Bernanke, then the Fed chairman.
The Federal Reserve is committed to using all available tools to stimulate economic activity and to improve financial market functioning.
QE was an experimental way for the Fed to inject money into the financial system and lower long-term interest rates.
It's almost like alchemy. You can create money out of thin air if you're at the central bank. So creating more money puts more money in the banking system, put more money out there for the economy to take it and put it to work and to grow and to restore itself.
The Federal Reserve has been putting the pedal to the metal. So we're doing everything we can to support the economy, and we hope that that's going to, get us going next year sometime.
Their hope was that the new money would help shore up the failing banks and get them lending again. It would become the heart of their easy money policies.
It was an emergency measure. I mean, the economy was imploding. I mean, no one would lend to anyone. There was no ability to borrow. The economy was going to be stopped dead.
Thomas Honig was the president of the Kansas City Fed and initially supported the quantitative easing plan.
These are trying times, and as you just heard, there is much to be done as we try and work through this financial crisis.
When you have a crisis, that's when you want your central bank to be willing to put cash in. And so to avoid a major depression where everything just stops, you provide the cash. So I agreed with, yes, we need to provide this money on the expectation that once we got through the crisis, we would go back to a more normal policy.
Again, you can tell me if I'm giving too long answers or what have you.
The task of managing most of the program went to Andrew Huszar, a former Fed official who was then working on Wall Street.
I realized very quickly what I was being asked. I was being asked if I would manage the largest financial markets intervention by a government in world history.
The Fed began creating hundreds of billions of dollars to buy things like mortgage-backed securities and government bonds from banks and financial institutions.
This was a $5 trillion market. This was the largest private bond market in the world. And the Fed had never once before bought a mortgage bond in its history. And basically, in the fall of 2008, it announced that it would buy basically 25% of the entire market within 15 months.
And that was your job to do that purchasing?
That was my job, to think about how to get the program done.
Many of these tools had not been tried before. They were definitely like break the glass kind of tools. Like, what are we going to do in order to restart the economy here?
Sarah Bloom Raskin joined the Board of Governors while QE was already underway.
As QE began, it showed great promise. We started to see that people's sense of economic well-being was ticking up somewhat. People were finding jobs. People were finding homes. The foreclosure rate had slowed. So there was a sense that something was working. Now, how it was working was a different question altogether.
Things are not as bad. We're getting better, and things will get better. There's no question about it.
View it as like an experimental drug that actually is doing some good things, but nobody quite knows how or why at the moment.
The financial sector had begun to stabilize, But there were early signs that not everything would go according to plan.
The banking industry fat cats still aren't lending money.
Well, the big banks aren't lending.
Despite the money the Fed was pouring into the banks, they still weren't back to lending.
The government's not doing anything to help small business, and the banks are sitting on their butts and they're still not lending money.
Instead, they were taking a lot of the money and investing it themselves.
The banking sector is broken. It is not lending to small business. Somebody's got to get the money there. The government is the actor in this case.
No, it's not. No, wait a second.
You were injecting money into the banks, more than $1 trillion worth at that point. And what were the banks doing with that money?
The Fed's idea was the banks would be taking that money and lending it effectively at lower interest rates. What the banks were doing instead was that they were just investing in the same bonds that the Fed was buying. They were taking that money and they were turning around and buying the same mortgage-backed securities and other bonds. Why? Because the Fed had made very clear that its goal was to drive up the price of financial assets. And so Wall Street turned around and thought, why would I go through the effort of making a mortgage when I can just press a button and buy, millions, if not billions, dollars of bonds and ride that trade as the price of those assets are very consciously being inflated by the Fed.
Hussar grew increasingly disappointed by the program and would eventually leave in 2011.
I hadn't seen the benefits accrue to the average American, and I wasn't seeing larger structural reform in favor of the average American. I began to question whether it was my role anymore to be at the Fed.
Were you seeing that the banks were gaming the Fed, that they were in some ways taking advantage of this program that was intended to help the real economy?
I think you could say they were gaming the Fed, or I think you could just say that they have a different mind and they're not part of the Fed and they have their own interests. It's sort of like the Aesop's fable of the scorpion of the frog. On some level, it's in their nature to do what's in their nature, and in their nature is to make the most money possible in the quickest way possible. And just because the Fed wanted to do something and wanted to help the average American, it doesn't necessarily mean that Wall Street has the same interest.
$20 billion worth of bonuses. It is shameful.
Are these executives greedy or stupid? Personally, I am stumped for an alternative word.
There will be time for them to make profits, and there will be time for them to get bonuses. Now's not that time.
It's socialism for the rich.
By the end of 2009, the banks were back to making money and paying themselves record bonuses while the real economy lagged.
Washington loaned them money at cut rate, so our thanks is they're going to stuff it in their pockets, even as many Americans are suffering from unemployment and reduced wages.
People absolutely ought to be outraged. These guys just don't get it.
The inflation rate was well below the Fed's target of 2%, signaling weak demand. Unemployment had shot up, and foreclosures were continuing across the country.
Banks got bailed out, we got sold out.
People had lost homes, household net worth had plummeted. It really wasn't an inclusive recovery. It was a recovery that benefited only portions of the economy.
I'm here to support all of the people who want their taxpayer dollars back, me included.
There was a sense that the banking sector, the financial sector, benefited primarily and not so much everybody else. And that had a political taste to it, which became the basis, I think, for a lot of anger and really set the stage for, sort of the next chapter in our country's political history.
We have you surrounded. Come out with the Constitution intact, you usurpers!
Demonstrators opposed to what they call out-of-control government spending begin a series of rallies this afternoon.
The resentment helped give rise to the Tea Party. Fueled by the belief that government spending and bailouts had been out of control, and ordinary people weren't seeing any benefits.
Hedge fund bankers, Bear Stearns, they didn't build this country. Workers like us did.
The only political constant in 2010 was volatility and anger.
Hell no, we won't go! No mama, no mama!
And there was a real loss of faith in the political and economic system. And that manifests as the Tea Party.
Tea Party Americans, you're winning! You're winning!
They were especially outraged by the $800 billion stimulus package that President Obama and Congress had passed in 2009 to get the economy going again.
Can you hear us now? Can you hear us now?
The entire principle of the Tea Party, the entire platform was to stop Washington, D.C. from intervening.
This is just the beginning.
It was an agenda of no.
We've come to take our government back.
As Republicans swept the 2010 midterm elections, aided by the Tea Party's growing influence,
we need to restore fiscal sanity to this nation.
The prospects for Congress and the White House working together to pass another stimulus bill were growing dim.
Let this serve as a warning to Congress. We don't work for you, you work for us.
Into the political vacuum stepped the Federal Reserve.
Was it palpable that the Fed was sort of the only game in town here?
Yes. The fact was we were carrying the load all by ourselves.
Resurgent Republicans racked up huge gains Tuesday.
A devastating night for the Democrats that fundamentally changes American politics.
People are frustrated. They're deeply frustrated with the pace of our economic recovery.
The Fed wasted no time. The day after the midterm elections, they took a dramatic step. Another round of QE, not just to stabilize the economy, but to boost it.
What happened on November 3rd, 2010, represents a step change in the Fed's role in our economy. When the Fed changes from a central bank that manages the currency to the primary engine of economic growth in America, whatever your philosophy is, small government, limited government, big government that hires people to go out and build roads to stimulate growth, whatever it is, it's supposed to be our democratic institutions that do that, not the central bank.
You're basically saying that because our democratic institutions are so paralyzed and there's so much political dysfunction that we as a society, we as a country have become overly reliant on the Fed to run things?
Totally. Economic affairs.
Yeah.
I think one of the most important things to think about is that our democratic institutions in America are becoming less and less capable and less effective. I think that point is almost undeniable. So what we're doing in this country is we're relying on our non-democratic institutions to take up the burden, like the central bank and economic affairs, which leads you to the surreal place where we are today, where this committee of 12 people is making these decisions that could very well plunge our economy into a deep, deep, deep recession and cause financial crisis.
In the early days of the easy money experiment, Fed Chair Bernanke promoted his plan, saying it would create a wealth effect, that boosting the stock market would make people feel wealthier and start spending again.
There's no doubt that there's quite a bit of opposition.
But he was met with some skepticism and concern that the decision risked causing runaway inflation. He went on television to push back on the critics.
They're looking at some of the risks and uncertainties associated with doing this policy action. What I think they're not doing is looking at the risk of not acting.
QE2 has become a punching bag for everyone from top-tier economists to Sarah Palin.
Inside the Fed itself, Thomas Honig was sounding alarms about the long-term consequences.
You are the one member of the Fed that has been critical of 0% interest rates. Why?
Over the course of 2010, he argued against Bernanke's plan at every meeting and cast the lone dissenting vote 8 times in a row.
It was difficult, but this was fundamental. And so I really did think that it was a wrong policy, and I didn't want to be associated with it. So I voted no.
Did you think it was a radical policy?
I most certainly did think it was a radical policy, and I think most people did. It was meant to be radical. And so my concern was we had come through a crisis, and we provided the liquidity necessary to come through it. And we were on the other side of that crisis. The economy was recovering, and yet we were engaging in a deliberate effort to have easy money.
What were you most concerned about if easy money continued?
I thought that it was unnecessary to do. I thought it brought new dangers. When you keep interest rates at zero and keep pumping money into the economy, you favor the debtor and you penalize the saver, which you are saving for nothing. I mean, you get nothing for that. And if you're a borrower, well, life is good. You borrow for nearly nothing. And so you actually encourage speculation. You encourage additional risk-taking. In fact, that's one of the reasons they did quantitative easing, was to encourage greater risk-taking.
The stock market rally on Wall Street today pushes the Dow to its highest level in nearly 9 months.
That figure includes activity fueled by recent government stimulus programs.
The Fed's quantitative easing set off what would become the longest bull run in the stock market's history.
Investors took the good news and, well, they basically ran with it.
By design, QE effectively lowered long-term interest rates, making safer investments like bonds less attractive and riskier investments like stocks more attractive.
The Fed goes out and buys certain kinds of assets, and it kind of puts a floor under the market, and it artificially pushes up prices. And when I say artificial, what I really mean is nothing changed at Apple or IBM or GE. It wasn't like somebody, invented the new thing post-2008. But a lot more investors got bullish in the stock market. So the stock prices of those companies go up. But what's really happening? Nothing's changed. Nothing new has been invented. It's a sugar high. It's like drinking a Coke instead of, having a meat and potatoes meal.
You've got oil up, you've got gold up, you've got copper up, you've got stocks up, stock futures are up, all because of central banks and the stimulus they've been putting into the economies.
On Wall Street, no one seemed to mind. The stock market rally continued.
The old saying is, don't fight the Fed. Don't fight the Fed.
Don't fight the Fed.
Rule number one as a young trader you're taught is don't fight the Fed.
I don't know what the hangover is going to look like down the road from all this extraordinary stimulus, but for now, the markets love it. Don't fight the Fed.
Don't fight the Fed. The one institution that has a printing press in the basement and there's no limits to how much it can use. That is what makes the Fed such an influential player in the marketplace.
Mohammed Al-Arian remembers it well. He was running the largest bond fund in the world at the time and helped advise the Fed on its QE experiment.
Keep an eye on the Treasury market.
He shared with them his concerns that the markets were becoming dangerously addicted to the Fed's easy money.
To taper or not to taper?
His prediction played out in 2013, when after multiple rounds of quantitative easing, totaling more than $2 trillion, Bernanke signaled the Fed might start to taper off.
If we see continued improvement and we have confidence that that is going to be sustained, then we could, in the next few meetings, we could take a step down in our pace of purchases.
I was on the trade floor. I remember Chairman Bernanke saying that he would taper. First, we had to figure out, what does taper mean? And the minute people realized what taper meant, which is that the Fed would step back from buying all these securities, and even though the Fed said it's going to be gradual, it's going to be measured, the markets had a massive tantrum.
The market's selling off after Federal Reserve Chairman Ben Bernanke said that the central bank could start tapering its economic...
It shows you how addicted the markets are. The markets went into a fit, became dysfunctional. It was known as the taper tantrum.
We all know it. When Ben Bernanke talks or the Federal Reserve speaks, the markets listen.
Markets are like little kids. They want candy, and the minute you try to take the candy away, they have a tantrum.
You have big Wall Street reaction, right? You have extreme volatility where Wall Street says, whoa, no, unacceptable, and values plunge. And of course, the Fed doesn't like that. Nobody likes that. That's a precursor to instability, right? But it put the Fed in a real bind.
Chairman Bernanke.
And Chairman Bernanke had to go in a conference in Boston and say, no, we're not tapering.
You can only conclude that highly accommodative monetary policy for the foreseeable future is what's needed in the U.S. economy.
Every single time the Fed would start talking about, okay, we're going to maybe taper back faster, or we're going to think about raising rates, boom, stocks would correct because stocks wanted that easy money dopamine hit.
Bernanke's successor, Janet Yellen, had better luck the following year. She was able to pause the quantitative easing part of the easy money policy without a tantrum, in part by suggesting she'd maintain the Fed's massive balance sheet of assets it had bought and to keep short-term interest rates low.
The FOMC reaffirmed its view
that the current 0 to 1/4% target range for the federal funds rate remains appropriate.
The Fed justified its actions in part because the fears about runaway inflation hadn't materialized. And in fact, it was running below its target of 2% because economic growth was still low. But Yellen's partial easy money pullback didn't dampen concerns and criticisms about the ill effects of the Fed's policies.
So you're doing a documentary on the Fed and monetary policy?
We are trying to.
Okay.
Are we insane?
No. I think it's a great idea.
Okay.
Joseph Stiglitz is one of the most well-known economists in America and a winner of the Nobel Prize.
The intention of the Fed was to stimulate aggregate demand.
He told me that while the Fed had done some good, he worried at the time that by stoking the stock market so aggressively, it was exacerbating economic inequality.
The main thing I was concerned about was that the way they were trying to revive the economy was a kind of trickle-down economics. The way quantitative easing works is that it's a lowering of the interest rates that leads stocks to go up. And so who owns the stocks? It's the people in the top, not just the top 10%, 1%, 1/10 of 1%. And so it increases enormously wealth inequality. We had increasing inequality really since the late 70s, and this was putting that on steroids.
What sort of response did you get from folks at the Fed to what you were saying at the time?
Our mandate is to do what we can to increase employment, to use the tools that we have, and that's what we're doing.
I heard a similar response when I raised these issues with the president of the Minneapolis Fed, Neil Kashkari, in March of 2021. He was the only current Fed official who agreed to speak to us.
The Fed has been on a mission, I've been on a mission, to put Americans back to work and help them get their wages up, especially for those lowest income Americans. And if it has had some effect on Wall Street, to me, the trade-off is well worth it if we can put Americans back to work so that they can put food on the table, they can take care of themselves. That is profoundly beneficial to society.
One of the things that we have seen in this country is a widening wealth gap. The question is, what role, if any, the Fed has played in widening that wealth gap?
Well, this is a great point, and I'm glad you raised it. Most people who make this argument ignore the fact that for many Americans, they don't own a house, they don't own stocks, they don't have a 401k. The most valuable asset they have is their job. So by putting people back to work and helping to boost their wages, we are actually making their most valuable asset more valuable.
Middle-class economics works.
President Obama today in Wisconsin fired up over jobs. Another 223,000 added in June.
In fact, by 2015, the employment numbers were improving dramatically. But critics I spoke to said the Fed's focus on jobs was missing the full picture.
I mean, Neil Kashkari told me that a job is a great asset. That when
his may be. I'm not so sure that's true for the folks working 3 jobs behind the counter at the supermarket. Sorry, Neil, I think that is an elitist assumption of what labor income is good for.
Karen Petru is an unlikely critic of the central bank.
We've got Pete here.
Go on down.
She spent her career inside the financial system,
Down.
advising banks and big investors.
There we go.
Interview with Currency 5 marker.
2015 to 2020 was actually considered a time of recovery. Unemployment was getting to record lows, and there was a kind of conventional wisdom that the economy was in a good place at that point in time. So you disagreed with that?
I did because most Americans disagreed with that. The majority of Americans said they were economically anxious. Significant percentages of people who were in the statistical middle class were skipping medical treatments because they didn't think they could afford them. 40% of the United States didn't have $400 in a rainy day fund, and they were at risk of imminent financial peril if a tire blew. That's not a good place.
What about this idea that there was record unemployment?
Record unemployment was judged the way conventionally the Fed chooses to judge it, not by taking into account the people sitting out working because they couldn't get enough wages with their jobs to make going to work pay. Employment was fine, so by at least some numbers, wages weren't. And people work to eat. They don't work because of some, noble ideal.
So just to understand, what was wrong with the models that the Fed was using in order to judge the success of their programs?
Paul Krugman, a well-known economist, has a great example. You've got 4 guys in a bar, each one of whom is making $60,000 a year. Jeff Bezos walks into the bar, and he's making $2 gazillion. Does that mean that the 4 guys in the bar are doing any better? No, it doesn't. It's distorting statistics. You have to look at how much each person has, not at what the averages are, to understand what's going on in the economy. And when 4 out of 5 guys in the bar are not doing well, the country isn't doing well.
The growing sense that the system was not working for the poor and middle class became a central theme of Donald Trump's populist campaign.
Sadly, the American dream is dead.
When you have a society with the middle struggling and the rich realizing like almost unimaginable gains, it starts to corrode the civic foundation.
We have to clean up the country. Our country is a mess.
People start to feel like this cliche you hear all the time, that the system is rigged.
Like he says, I think the system is rigged.
You know what?
He's just speaking what we're all thinking, but he's saying in the public domain, he's saying in the political domain.
You know, the fact that a huge portion of Americans were willing to vote for a president like Donald Trump, whose like entire campaign seemed to be burning down the system.
We are going to drain.
That doesn't just happen in a vacuum.
We are going to fix our inner cities and rebuild our highways, bridges, tunnels, airports, schools, hospitals.
It was a moment of potential for the Fed's easy money policies. Trump promised to take advantage of the low interest rates and create jobs by investing in new infrastructure.
We will create millions of new jobs and make millions of American dreams come true.
But once in office, the political paralysis in Washington only intensified.
Congress simply hasn't been willing to find the amount of money necessary to do it.
Making big economic investments all but impossible.
There just wasn't the political cohesion to push through these major programs. And you saw a lot of op-eds by a lot of economists and even Fed bankers themselves after the first or second or certainly third and fourth round of quantitative easing. They were saying, please give us some fiscal policy, meaning give us some government action to direct this money to the right places. We can't do all this alone. We can keep rates low. We're trying to keep rates low here, trying to keep confidence high, but we can't make you spend on a bridge or revamp a school.
Are you saying that there was sort of a squandered opportunity here?
100%. It was a missed opportunity. We didn't use the cheapest money in memory. I don't want to say in history, but certainly in the last, several decades. We didn't use that opportunity to spend on the things that would have been almost free in terms of debt. We really missed something that now will be more costly because now that interest rates are going up, I still think, for example, we should do more infrastructure spending, that we should revamp education, but it's going to be more costly to do it now.
It's the largest, I always say the most massive, but it's the largest tax cut in the history of our country, and reform, but tax cut.
The marquee legislative achievement to the Trump administration would instead be a tax cut that further boosted the markets and deepened economic inequality.
That's your bill.
The jury is still out on whether it contributed to the economic growth that had started to tick up during the Trump presidency. But to some inside the Fed, it seemed like an ideal time to pull back on the easy money experiment. One of them was Jerome Powell.
It is my pleasure and my honor to announce my nomination of Jerome Powell to be the next chairman of the Federal Reserve. Congratulations, Jay.
Thank you, Mr. President.
Trump appointed Powell in late 2017.
Jay Powell is a profoundly competent, smart guy who has spent his entire career at the nexus of big money and big government.
In the years since the global financial crisis ended, our economy has made substantial progress toward full recovery.
Self-acknowledged Republican, he's a conservative. He tends to embrace the deregulatory view of the economy, and he's also a Wall Street guy who came up through the business of corporate debt and deal-making.
The Fed is seen continuing to raise interest rates going forward, and I think they can...
The Fed had already begun raising rates and reversing QE. They'd call it quantitative tightening, or QT. Powell took office eager to accelerate the effort.
The really extraordinarily accommodative low interest rates that we needed when the economy was quite weak, we don't need those anymore. They're not appropriate anymore.
Once again, the market threw a tantrum.
The Dow closing down more than 500 points today.
A brutal week in the market. The Dow and the S&P now on track for their worst December since the Great Depression.
The global financial system short circuits.
The decline will accelerate if Jay Powell doesn't walk things back.
The president threw a tantrum too.
I think the Fed has gone crazy. It's a correction that I think is caused by the Federal Reserve.
If the Fed knew what it was doing, they would lower rates and they would stop quantitative tightening.
The president has been attacking the Fed chair on Twitter very often for raising interest rates.
With the Fed's decision to raise interest rates, he suggested it would hurt
And the tweet he said quantitative tightening was a killer, should have done the exact opposite.
Powell would change course.
The Federal Reserve cut a key short-term interest rate today after raising it as recently as December.
You see this complete reversal and what a lot of investors and economists saw as a capitulation to financial markets. Financial markets don't like this, so the Fed's going to reverse course. And that has defined Chair Powell ever since then.
A tricky balancing act for Chairman Powell. He'll now face criticism that the Fed has bowed to pressure from the White House, or Wall Street, or both, sacrificing the central bank's precious independence.
The Fed blinked, and the Fed reversed course when the market was down sort of 20% and went from tightening policy to easing policy. And it became very clear to the market that saving the stock market was now one of the Fed mandates. And I think that had really ominous ramifications for the future.
By 2019, the Fed's easy money experiment had been going on for a decade.
The Fed's job isn't to help the President of the United States, it's to do its...
What had started out as an emergency measure to save the economy had become the status quo.
Yes, quantitative easing is there, but it's a tool you don't want to overdo.
And it was deepening the concerns about how the Fed was fueling troubling trends. Taking advantage of the Fed's low rates, private equity firms had been buying up huge swaths of the economy with borrowed money.
110,000, 128,000.
The multi-billion-dollar private equity firms, this is a bargain hunt.
Concentrating wealth and ownership of everything from houses to hospitals.
Across Blackstone, we own a range of things. So SeaWorld, Busch Gardens, Bird's Eye Foods, Michael's Stores, Hilton, and Waldorf. What we like to do is come in, buy either real estate or companies. We see an opportunity to grow something faster, to invest capital, fix whatever that is broken, and then sell it.
The Fed's policies had also been fueling a frenzy in Silicon Valley.
WeWork has announced it's received a massive $4.4 billion investment from SoftBank Group,
leading to all sorts of excesses.
Venture capitalists pumped nearly $500 million into the food delivery startup industry.
Airbnb is now valued at $10 billion, more than big hotel chains including Hyatt and Wyndham.
And enabling certain tech companies to disrupt and dominate entire industries without ever turning a profit.
WeWork is saying its total opportunity is $3 trillion. I mean, that's 3.5% of the entire world's GDP.
But perhaps the most destabilizing consequence to the economy was how the Fed's low interest rates had been incentivizing public companies to take on more and more debt.
Valuations are generally elevated, especially corporate debt.
We have flagged the rise in corporate debt.
We have entirely too much corporate debt out there. And
I saw numerous studies and reports detailing the extent of the debt and how even marquee companies were becoming so leveraged their credit ratings plummeted. The Fed had hoped that companies would put all that borrowed money to good use and invest in their workforce and their infrastructure. But in reality, it played out differently.
buybacks.
Buying back stock.
Stock buybacks. Stock buybacks, robbing the American worker.
Companies were often borrowing money to buy back their own stock, making the remaining shares more valuable and the prices higher.
As a corporation, you realize all that matters is the stock price. So what do we have to do to increase the stock price? And more often that is buying back the stock. So it used to be the Fed would lower interest rates, businesses would then take on more debt, they would use that debt to hire more workers, build more machines and more factories. Now what happens is the Federal Reserve lowers interest rates, businesses use that to go out and borrow more money, but they use that money to buy back stock and invest in technology that will eliminate workers and reduce employee headcounts. They use that money to give the CEO and other corporate officers big bonuses, and then eventually issue more debt and buy back more stock. So it's this endless cycle of things that are designed to increase the stock price rather than improve the actual company.
Okay, GE just authorized a $50 billion stock buyback.
The numbers were astounding. More than $6 trillion in corporate buybacks during this easy money decade after the financial crisis.
$50 billion stock buyback. That makes a big deal, big difference to the stock price.
Buybacks were an embarrassment. And so it's just another example of things that used to be viewed as kind of, just going mainstream.
Sheila Bair, a former top banking regulator, was issuing public warnings at the time that the Fed was incentivizing bad behavior on Wall Street despite its best intentions.
I can't fault the company so much because this interest rate environment creates very strong economic incentives to do exactly what they're doing. It's hard to create a new product. It's hard to come up with a new idea for a service. It's hard to build a plant and hire people and run the organization. It's real easy to issue some debt and pay it out to your shareholders to goose your share price. That's real easy to do, but it doesn't create real wealth. It doesn't create real opportunity. It doesn't create jobs. It doesn't improve the labor market. But it's just another example of how these very low interest rates have really distorted economic activity and frankly been a drag on our economic growth, not a benefit.
Warren Buffett likes Apple's buybacks.
Well, why wouldn't he? He's a shareholder and you're buying back $100 billion in stock.
When you get an age of easy money like what we've seen, you get a financialized economy that's really more in service to itself. So most of what it's doing is buying and selling existing assets rather than helping real businesses and real people make real investments. But one of the things that's so diabolical, I would say, about easy money and our financialized economy in general is that we're all in it. We're all part of this Faustian bargain of pretending that there's something wonderful happening in the real economy when really it's just Wall Street going up. But we all kind of want the market to go up because we're in it with our pension funds and with our 401ks. So everybody's money is kind of helping to push this whole cycle along.
Even some of the largest beneficiaries of this trend told me it made them uncomfortable, like legendary investor Jeremy Grantham.
In my career in America, the percentage of GDP that goes to finance has gone from 3.5 to 8.5. In a way, we're like a giant bloodsucker, and we have more than doubled in size and sucking more than twice the blood out of the rest of the economy. And we do not generate any widgets. We do not generate any real increase in income. We are just a cost.
When you say we, you mean you and other members of the financial community have been this kind of bloodsucker on the economy? Is that what you're saying?
Yes, collectively, we fulfill a completely necessary service. But what we have done is created layers upon layers of more and more convoluted, expensive financial instruments And that's what makes all the profits for the financial industry. And it's taken a lot of ingenuity and salesmanship to make this happen, and a lot of lobbying in Congress, et cetera, et cetera. And we have imposed on the rest of the economy the idea that banking and finance are utterly important at all times. If you do anything wrong to us, the entire economy will collapse in ragged disarray.
Corporate buybacks, the elevation of corporate debt. Well, how is that viewed by you and others at the Fed?
Something we pay a lot of attention to, but when companies are buying back their stock, one of the things they're telling us is we don't have profitable places to invest, and it's easier for us just to buy back our stock. That's concerning in terms of the future of our economy, but that's not because of the Fed. So we pay attention to it. It really matters. But in my view, it's not something we control.
Kashkari and others have pointed out that it's the job of Congress and regulators to address some of these concerning trends. And when we sat down in 2021, he was quick to dispute the criticism that the Fed's policies had really just been boosting financial markets and helping Wall Street. We hear it all the time from Wall Street people that basically that prices are completely untethered from some fundamental reality. There is this idea on Wall Street that the Fed kind of has our back, and that because you may have well-intentioned policies that are trying to get everybody to work, there is this side effect, this unintended side effect of just kind of really helping the rich.
That argument ignores the benefit to the poor. And if you're going to ignore the benefit to the poor, then we're only helping the rich. But of course, that's an incomplete analysis. When you actually sit down and say, well, let's go through the trade-offs of the choices that the Fed has, whether it's interest rates or it's quantitative easing, it's not just about Wall Street. It's not just about asset prices. It's also about thinking about the men and women in America who are trying to find work and who want to have higher earnings and who deserve higher earnings. If we are benefiting them by helping them find work and helping them have higher wages, I will take that trade-off.
Beyond the debate over the effects on Main Street, there were increasing concerns about the risks on Wall Street. What would happen to all those companies that had gone deep into debt and their investors if there was a downturn? But some of the most dire warnings were about a largely unregulated sector of the financial world that had become a key player in all the borrowing going on.
Finance was getting bigger and bigger and riskier and riskier. And then there was something else going on that was only noticed later on. The risk had migrated to what we call the non-banks, so the financial system that are not banks, and it had morphed, it had changed. And in doing so, the ability to understand what was going on came down, because the non-banks are not supervised and regulated as well as the banks. The phrase that was used at the time was shadow banking, that there were banking activities happening, but they were happening in the shadows of the banks themselves. These are the asset management companies, these are the hedge funds. These are not well regulated, but suddenly become systemically important.
When it comes to shadow banks, what was your big concern?
The core of the problem of the shadow banking system is that it's extremely fragile.
Lev Menand, who'd been an economic advisor to the Fed and Treasury Department, was warning that even though Congress had imposed regulations on big banks after the financial crisis, shadow banks were largely untouched, and they were endangering the whole system.
Anybody who's an investor in a shadow bank, who has their money in a shadow bank instead of a real bank, is going to have an incentive to withdraw in the face of any uncertainty. So little economic shocks that cause asset prices to fall have the potential to trigger runs and panics. And so what we've done is, by allowing this shadow banking system to develop, is we've inserted a source of instability in our entire economic system that doesn't need to be there and that has the potential of throwing us all off course.
Let me start by saying that my colleagues and I...
That potential instability posed by the shadow banking system was on the Fed's radar.
How are you thinking about potential risk bubbling up in the broader shadow banking system?
You know, this is a project that the Financial Stability Oversight Council is working on now, and also the Financial Stability Board globally is looking carefully at leveraged lending, and you know, we think it's something that requires serious monitoring.
But by the end of 2019, little action had been taken by the Fed, financial regulators, or Congress to rein in the shadow banks and other growing risks. The system remained vulnerable to a shock. It would arrive in early 2020.
A preliminary investigation into a mysterious pneumonia outbreak in Wuhan, China has identified a previously unknown coronavirus.
When the pandemic hit, it was so unlike anything any of us have experienced in our lifetimes.
Already, 45 cases have been reported in China, including 2 deaths. The victims are thought to have contracted the virus in a meat and seafood market.
We'd been paying attention to what was happening in China for a few months.
There are new images out of Wuhan that purport to show the dire conditions in hospital.
I was calling my contacts, global businesses that have big operations in China, to understand what their employees and staffs were seeing. And we were all trying to learn as much as we can about pandemics and what it's likely going to mean.
Major sell-off across Europe this morning.
I think we all figured out very quickly the pandemic and the virus would drive the economy.
Investors are spooked by the growing number of infections outside China.
But how fast would it hit us? How widespread? What would the healthcare response be? It was maximum uncertainty. And you were seeing that uncertainty manifest in financial markets.
What you have here are concerns, fears, worries, and deep uncertainties about what's likely to happen next.
People were scared. Investors were scared. Individuals were scared. And they said, you know what? I just want cash.
Markets giving us the worst 2-day point drop ever in history.
I don't even want treasury bonds. I don't even want corporate bonds. I don't want stocks. I just want cash. And when everybody in the economy says, I want cash at the same time, that leads to potentially a collapse of financial markets.
On the bell!
Yeah, means the first circuit breaker
for whom the bell tolls
has been triggered.
I knew we were going to wall.
All the weaknesses of the system that had built up over the years of easy money were being exposed.
Market functioning was starting to cascade into failure.
The Dow plunging again today. The 11-year bull market has ended.
Stocks were just on a downward free fall. You had credit markets seizing up. People were selling anything that wasn't nailed down.
I can't do anything. I'm frozen.
Attention was focused on the highly leveraged shadow banks.
What we saw was a full-blown panic in the shadow banking system. It wasn't something that you have when you have a pandemic, you have a bank panic. It was, you have a bank panic because you had some exogenous shock in the economy and you have these underlying vulnerabilities in your monetary system that you haven't resolved.
The Fed responded to this new crisis with an old tool. Once again, quantitative easing.
The Fed will try to steady the ship after a week that echoed the financial crisis of 12 years ago.
It bought up hundreds of billions in debt from financial institutions.
We have seen the Fed inject money into the economy in the last couple of days.
By mid-March, they'd made more than $1 trillion available to the shadow banks, and they cut interest rates back down to near zero.
What that tells all of us is that the economic impact of the coronavirus is going to be crippling.
The Federal Reserve lent $500 billion to securities dealers, $500 billion to foreign central banks, bought $2 trillion of Treasury securities, another $1 trillion of mortgage-backed securities. It flooded the zone with new government cash to stabilize this system.
Incredible effort from the Federal Reserve taking major action to...
Everything that Ben Bernanke's Fed had done over the course of the financial crisis of 2008, Jay Powell did that in a weekend. The scary part is it wasn't enough. The crisis continued, and they had to intervene even further.
Good morning. We are here for you on this morning when the stock market has taken another dramatic plunge, at least.
The emergency rate cut failed to calm investors. In fact, it did the opposite. Futures immediately dropped the 5.
Despite the Fed's actions, the corporate debt market froze up, and companies were unable to pay their bills, putting the wider financial system at risk.
There's just this corporate debt picture out there, and we're just beginning to see how those dominoes are going to fall.
Then comes the realization that we have to lock down.
The list of closings and activities being suspended is growing from coast to coast.
In the White House, Eric Ueland was the Trump administration's point person dealing with Congress on the response.
Every day and into the evening, as we're going through and hearing more information and trying to explore the health side of this exploding virus crisis, there's also an economic impact that is just getting larger and larger and more significant. And so what's the impact on the community when suddenly you're telling it a significant amount of economic activity needs to slow or actually cease? That's pretty dramatic.
3.4 million people filed for unemployment last week.
You can't really compare this to the financial crisis or even 9/11. There's never been a time in history where the U.S. government told the economy to shut down.
Then we're talking about impacts on businesses, from small businessmen who are the real heartbeat of our economy, communities, and how to keep people employed. What's the impact on industries and significant economic sectors of the American economy? But the policy response that we need to design and hopefully execute here inside this crisis is a lot broader than anybody conceived up to that point.
The motion is adopted.
In a rare moment of bipartisanship, the Trump administration and Congress would end up passing the largest economic stimulus ever.
All right, thank you all.
The $2.2 trillion CARES Act, which, unlike after the crisis in 2008, was aimed not just at Wall Street, but directly at individuals and small businesses as well.
You encouraged your team to be bold, be brave, and go big, and we certainly delivered today, $6.2 trillion.
You ain't seen nothing yet from what the Fed is about to do.
Part of the money would go to the Fed, which announced a new range of loan programs worth trillions. And for the first time, it began buying up corporate debt. The easy money experiment went into overdrive.
A guy inside the Fed was telling me that what they were doing was not that sophisticated. They were just looking at any part of the market that looked like it was on fire and dumping money on it.
We often talk about the Federal Reserve using a bazooka to tackle markets and the economy. This is bazooka, cannons and tanks all at once.
So this was huge. This was the Fed stepping in on an unprecedented scale and saying to the market, we will do whatever it takes.
Many of the programs that we're undertaking rely on emergency lending powers that are available only in very unusual circumstances, such as those we find ourselves in today. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery.
I don't think most people are aware that we came this close to a bona fide financial crisis.
Yeah, I think a lot of it is missed for two reasons. One, there was a lot of other stuff going on in the news at the time. The other is the Federal Reserve did an amazingly good job at putting out the flames of this panic. And even though the panic in March 2020 was more severe along many metrics than anything we saw in 2008, the government's response was more powerful in certain respects. And we're lucky that the government was successful, or we could be living through a true depression.
Everything has been thrown at this market to try to keep it floating.
The Federal Reserve now getting into junk bonds.
It's a joke. The market is manipulated. You know, they're printing trillions of dollars to pump up the value of publicly traded stocks.
In trying to keep workers employed and companies afloat, the Fed had also used its power to rescue some of the riskiest parts of the financial system, like the junk bond market.
And is this just like a high-yield junk bond bailout? I mean, I don't get
we got to live with it now, Tom. We got to live with it.
To the critics, the Fed was rewarding the same players and practices that had helped make the system so fragile in the first place.
Over the years, we've been trained to believe that the Fed is on our side. What the Fed has trained us to believe is that if we make a bet in the market and we win, we're on our own. We get to keep the profits. If we lose, they will bend every effort and every dollar they can get their hands on, one way or another, to bail us out. This is asymmetry of the most splendid kind.
A-Speeds, go ahead and clap it off, please.
Billionaire bond investor Howard Marks called the Fed out at the time, saying it was undercutting the way the free market is supposed to work.
There are negative ramifications to this, one called moral hazard, which means conditioning people to believe that if there's a problem, the government will bail you out. And if people really believe that, then there's no downside to risky behavior. Because if there's a problem, it won't fall on you, you'll get bailed out. If you play it aggressively and succeed, you make money. If you play it aggressively and fail, you'll get bailed out.
We are truly getting to a place of moral hazard.
Do we want to live in a world, do central banks themselves want to live in a world where their interventions are so central to the market outlook and to market performance?
So has moral hazard gotten worse as a result of this bailout?
There's no barometer of moral hazard, so I can't give you a reading. All I can say is that for the last year or so, risk-taking has been rewarded, and that tends to bring on more risk-taking.
I don't think it's anything that investors should be applauding necessarily, because it's a nail in the coffin of capitalism.
This is going to be a test for whether or not capitalism is just a call sign when CEOs are looking for bailout.
Do you see moral hazard in what has just happened?
Oh, absolutely. I think now, the entire business community has had a taste of bailouts, and boy, it doesn't work really nicely. So I fear that now the Fed stepping in, not just to bail out Wall Street, but the entire, corporate America is starting to be embedded into people's thinking. People talk about the survival of capitalism, but this is the biggest threat to capitalism. In good times, when anybody can make money, you reap those profits. In bad times, the Fed just keeps stepping in. You have this never-ending ratchet up. The market's never correct.
It's like a no-lose casino.
It is a no-lose casino. That's exactly right.
This is the second time in 12 years that you and your institution have had to funnel into the financial system trillions of dollars. And there is this sense that the financial markets have an ironclad backstop from the Fed.
Well, I completely agree that it is unacceptable that 12 years after 2008, we had to do this again. I am proud that we did what we did. It was the right thing to do. It was necessary. But it is unacceptable as an American citizen that we have a financial system that is this risky and this vulnerable.
But what, if any, responsibility or accountability does the Fed have for the financial system having been so risky and so vulnerable to a shock?
Well, I think all financial regulators that have a seat at the table have responsibility for what was left incomplete after 2008 and where we go from here. We need to use this crisis to finish the work that we did not finish after 2008.
With all due respect, I wonder if you could be a little bit more explicit with me. What will the Fed own when it comes to the vulnerability of the system?
Well, I reject the thesis. I actually don't think it's been the Fed's monetary policy that has led to these vulnerabilities. I think it's been incomplete regulatory policy that has led to these vulnerabilities.
The coronavirus pandemic has left millions of Americans out of work.
The people have gone now without 4 or 5 or 6 or 7 paychecks and starting to catch up. They need food. It's the most basic thing.
In the months following the Fed's rescue, we saw a troubling disparity.
Have you got any income at the moment?
No. And we have kids too, so.
As businesses were shuttered and millions of Americans were living on the edge, the markets did indeed look like a no-lose casino, thanks to the Fed's safety net.
The economy may be facing major hardships, but the stock market is thriving.
The best quarter for the Dow in 33 years, it surged 17%.
We ended up in a world where bad news was good news.
The unemployment rate is now a staggering 14.7%.
Bad news for the economy was good news for markets. Why?
In the midst of all the economic turmoil, Wall Street actually closed out its best week in 45 years.
Because when people saw bad news, they said, the Fed will have to do more.
And today the markets say, bring on the next quarter.
And then over the next few months, we saw one record after another in stock markets.
Stocks surging even as America enters its darkest chapter yet of this pandemic.
Even after the initial emergency passed, the Fed was pumping $120 billion a month into the economy through quantitative easing on an indefinite basis. The fire hose was simply turned on and left on the curb. You know, the extraordinary measures of 2010 literally become the daily operating procedure of 2020.
The S&P 500 hitting another record high today after surging 55%.
The stock market didn't just regain all of its losses in a matter of a month, but started breaking new records.
I see quite a bit of green on the markets this morning. Dow, S&P, Nasdaq, all of them higher.
Over the next 2 years, tech stocks would soar.
Apple is now the first publicly listed U.S. company to be valued at $2 trillion.
Tesla shares are soaring.
This company has just gone through the roof this year. The stock price has more than quadrupled.
Right now, it's a seller's market, and homes are selling fast.
The price of real estate would shoot up across the country.
The housing market has never been hotter.
And corporate America would take on even more debt, which investors gobbled up.
Massive issuance of corporate debt.
More than $10.5 trillion.
For the richest Americans, it was an extraordinary time.
Mark Zuckerberg has increased his wealth during the pandemic by more than $37 billion.
Elon Musk has added over $10 billion to his wealth just this week.
Jeff Bezos reportedly earning over $50 billion this year.
Billionaires now hold 2/3 more in wealth than the bottom half of the U.S. population. Let that sink in for a moment. Now, as I mentioned,
just the billionaires in the United States, from March 2020 to February 2021, have grown their wealth by $1.3 trillion. $1.3 trillion.
It's the burst of euphoria that typically brings these things to an end.
But even some of those billionaires were worried the Fed was fueling a dangerous bubble.
The housing market, the stock market, and the bond market all overpriced at the same time. If the Fed knew what it was doing, it would not allow bubbles of this magnitude to take place.
Smash the like button. Invest consistently.
But the epic rise in the markets proved irresistible to millions of new small investors, too.
So when a stock does well because of internal or external factors, you secure the bag, honey.
An app that's changing the way we do money.
All these brokerage platforms saw the largest growth of new users they'd ever seen because people said, now's my opportunity. I'm gonna invest my money in the stock market. I may not understand what the Fed's doing or how it works or what exactly is going on.
The S&P 500 now on track for the best week going back since 2008 at one.
But I understand the Fed takes action, stock prices go up, these people get rich. And it became a very clear mandate for people. If I want to get in on this economic recovery we're having, I've got to buy stocks.
I'm gonna take my stimulus check and I'm gonna put it in the stock market.
So they're online, they're trading stocks, they're buying and selling and putting money into these stock accounts. They started creating their own community.
Welcome, Declan, Michael, Lee, so many people, Bob Smith.
We gotta get the Dow Jones up!
Fed Chair Powell became a kind of cult figure, master of the money printer.
Money printer, go big.
Invest in these 4 tickers, I'll put them right above.
And billions poured into so-called meme stocks.
Like this GameStop situation, we will never encounter a setup like this again.
And new risky asset classes like cryptocurrency took on a life of their own.
Bitcoin.
Bitcoin has been on a wild ride.
It really is the new currency.
There's just too much money. People just have so much money and there's not really places to put it. So what folks started doing is investing in these very speculative assets, things like Bitcoin, because they're just seeing ridiculous rates of return. It doesn't really matter what the underlying value of the thing is, just like it doesn't matter what the underlying value of a company is, right? As long as the stock price goes up, you want to buy because the stock is going to keep going up, and then you'll sell. It's the greater fool theory of investing.
Cryptocurrency.
Cryptocurrency.
Cryptocurrency. Cryptocurrency.
Blockchain technology.
This is actually a very comfortable chair.
Crypto was all the rage in Hollywood, where actor Ben McKenzie saw celebrities pushing it on an unsuspecting public. With reporter Jacob Silverman, he began raising alarms.
Crypto exchanges primarily were driving the advertising dollars here. So, it's not unreasonable to think that these folks got paid, not just multiple millions of dollars, but potentially tens of millions of dollars to sell this stuff.
Bitcoin is a new kind of money. It's cash
into crypto.
What's up?
I'm getting into crypto.
With FTX. You in?
History is filled with almosts.
When you're talking about an ad like the Matt Damon ad that went viral and not in a good way, what does he work one day? He walks around a studio and points at stuff that isn't there and talks about how brave you need to be to buy crypto. It's a pretty easy paycheck.
Fortune favors the brave.
I certainly understand how easy it is to get lured in to cryptocurrency, especially when you see, at least for one brief shining moment, all of your friends and neighbors or people you follow on social media getting rich. Of course you're going to try it.
How does the Fed figure into this? Was there just so much money sloshing around that it just needed to go somewhere, and crypto was one of those places where it just was like, all right, we'll throw it in there?
Yeah. You know, when money is cheap, people gamble. It's just undeniable. And fraud runs rampant.
You would hear even within crypto circles, people started talking about Ponzi schemes in a non-derisive way, saying, well, maybe we're doing kind of new types of economics. They're all forms of kind of irrational thinking and rationalization also that come together to help sort of conjure this illusion that there's value here until something pops it.
A number of serious investors like Jim Chanos began speaking out.
It just became this orgy of speculation by the first half of 2021. Anyone who wanted to raise money for anything could do so. You know, the amount of fraud we saw that being floated on top of legitimate companies was really concerning, particularly in places like the crypto space, which was sort of not being regulated. People were creating new coins or NFTs and selling them on to the public who was eager to get in on the latest fad. And that bothered me.
And you would draw a direct link between what the Fed was doing and the crypto craze?
Well, it was all part of speculation that was led to people doing really silly things with their money. At the end of bull markets, at the end of speculative markets, you know, all kinds of crazy schemes get floated to separate people from their money.
At least these are different questions, not the same question over and over again.
Was last time the same question over and over?
It was the same question for 90 minutes.
I don't know about that.
Yes, trust me, I have a tape of it.
Oh, yeah? When I sat down with Neil Kashkari again recently, I asked him how the madness in the markets looked to the Fed. It kind of was mania at the time. The Fed was continuing to flood the markets with liquidity, with money. Did you not see all of that mania as a sign of overheating? That an indicator in the markets was telling you something about, you know, what was happening in the economy?
Yeah, I mean, we see froth in financial markets not infrequently. There have been other times when we've seen booms in financial markets. If we are going to try to raise interest rates to control excitement in the stock market, the cost, who's going to bear the cost of that? The people who are out of work today. If we had said, let's go raise interest rates to try to keep crypto down, keep Bitcoin from going too high, and we're going to keep millions of Americans out of work as the way to do that, that strikes me as a bad trade.
I think interest rates and inflation are going to rise well above what the Fed has projected.
As the markets were heating up, so were concerns that the Fed's policies would fuel inflation.
Prices are rising at the fastest pace in more than a decade.
But it wasn't just what the Fed was doing.
I'm going to help the American people who are hurting now.
The new Biden administration was sending $1,400 checks to many Americans.
Stimulus money from the latest COVID relief bill is arriving in bank accounts all over the country,
extending unemployment benefits, tax credits, and other relief programs.
I think there's a real possibility that within the year, we're going to be dealing with the most serious, incipient inflation problem that we have faced in the last 40 years.
Critics like former Treasury Secretary Larry Summers were publicly expressing concern that all the stimulus money from the Fed and the government would boost economic demand at a time when supply problems from the pandemic were still an issue.
People like myself, like Larry Summers and others, saw that massive stimulus that was unprecedented, an order of magnitude greater than the one we had after the global financial crisis, will lead to excessive demand, overheating, and inflation. So we had an unprecedented fiscal stimulus, an unprecedented monetary stimulus. We had bailout checks sent to everybody, every household, every firm, every financial institution was too much and should have been more selective.
There really just was all this money being pushed out in the economy. At the same time, you've got the Federal Reserve. They're pushing out another $4 or $5 trillion into the economy, and so prices rose.
Core CPI inflation is set to rise sharply over the next 3 months.
This goes back to your Economics 101 textbook, right? When there's too much money chasing too few goods, prices go up, and that drives inflation higher.
It only took a few months for the warnings to come true.
It seems like everything across the board is becoming more expensive.
Gas prices going up, food prices going up.
But the Fed didn't flinch.
A surge in energy, housing, and food costs.
It didn't raise interest rates or pull back on quantitative easing.
The question now haunting economists is whether these price hikes are a pandemic blip or a sign of a long-term threat to the economy.
And they had a word for the highest inflation in more than a decade.
Transitory.
Transitory.
Transitory. Transitory. Now, I know you believe this is transitory, but everything's transitory. Life is transitory.
This inflation round is not transitory. This is a very hot inflation environment, and the longer the central banks wait, the greater the risk.
I reacted quite strongly to the assertion that inflation was going to be transitory. I remember warning at that time that we simply don't have enough evidence that it is going to be transitory. Transitory is a very reassuring term because I tell you, don't worry about it. It is temporary, it is reversible, therefore we don't need to change behavior. So yes, we have inflation, but don't worry.
What kind of evidence were you seeing that this may be stickier inflation than it is transitory?
One, what companies were telling us. And companies were saying, I am not so it's transitory. This is beyond the pandemic. I was talking to CEOs, and they were giving me a very clear message, the same message that was in one earning call after another earning call. They did not view the disruptions as being transitory.
Why transitory? Why that word? What did you think at the time?
Well, we saw a number of factors that we thought were conspiring to lead to high prices, and that many of those factors would fade away over time. So, for example, supply chains we saw were getting gummed up. But we also know that businesses were working very hard to ungum those up, to untangle those supply chains. So we thought that they'd probably make more progress there than we expected.
The Business Roundtable, for instance, was coming out and saying, polling their CEOs and saying, look, we're seeing inflation everywhere in what we're doing, okay? How does something like that land for you at that time?
I mean, I take it seriously. I don't dismiss it. Then I map it against the data that we're seeing.
Okay.
But I'll just say, if we did not have an outlier view on inflation or the economy overall, if you look at the consensus of forecasts among experts in America, on Wall Street, around the world, they all basically had the same forecast, which is inflation is going to be transitory. It's going to come back down. Yes, there were outliers. But if you look at the consensus, we were well within the consensus of the experts who study this.
Any regret about not taking the foot off the pedal, seeing what, for instance, the federal government was doing at that point in time?
Well, I think, again, knowing what I know now, absolutely.
I put the same questions to Brian Deese, one of the chief architects of the Biden administration's $1.9 trillion rescue plan.
Were the inflation concerns at the time part of your internal deliberation about doing the Rescue Act?
It was an issue that we were always aware of and focused on and weighing in the weighing and balancing that you have to make when you do policy making in the face of uncertainty.
You're saying that you knew that that could be a potential trade-off.
It was always a trade-off. And the logic behind our actions was to get ahead of the pandemic, help bridge for families and businesses, and also insure against the downside risks to our economy. And I think if we look back now and recognize that the inflation challenge that the U.S. economy faces is not unique. It is a global challenge. Inflation is higher in Europe and the U.K. today than it is in the United States.
Was there a concern at the White House that the Fed was running the economy too hot for too long?
That is a question that I will institutionally not answer.
Why?
Because one of the hallmarks of our system is the independence of monetary policy making. This has been something that you can't take for granted in our system, that prior presidents have not necessarily honored. But this president, this administration is quite committed to the proposition that the strength of our system, one of the strengths of the U.S. economy, is the trust that people have in the independence of our monetary authority. And therefore, we make deliberate choices to not make comments on questions like that.
We're going to begin tonight with the rough road to recovery for America's economy.
Through late 2021 and into 2022, stimulus from the Fed and the government would contribute to a rapid economic recovery.
As our economy has come roaring back, we've seen some price increases.
But inflation continued climbing at the fastest pace in decades, hitting the poor and middle class the hardest.
You know, these price increases will be real impact on families, and they're not going away anytime soon.
The people the Fed had hoped its easy money policies would help the most.
This is the epicenter of this rise in inflation.
The highest inflation rate of any major city in the country. Housing.
No city had it worse than Phoenix, which had the highest inflation rate in the nation. When I visited St. Mary's Food Bank, the cars were lined up first thing in the morning.
Every day, my key team, we get an email with the number of people that come through. Yesterday was 1,007 households. And it's not people, it's households coming through. They're feeding 4 or 5 people. And it's like, wow. And that's 5 days a week. They just don't have any other choice. We're hearing that their budget is being eaten up by all the impacts of inflation. And it's either that or they don't have food for their children.
I'm a single mom, so sometimes at the end of the month, I need the assistance.
Yeah.
Because life has gotten a lot more expensive, and being a single parent, I can feel it. Like, it's like choosing between your rent and your food.
It's like yesterday I spent $100 just to get cereal, milk, and bread, and eggs. And that was basically it, and some lunch meat. And that was $100, and that was our week's worth of food, and that's not gonna feed 6 kids.
When did you start seeing an increase in people coming?
It was the end of February this year, 2022. We saw a slight uptick. Didn't know if it was real, but it kept climbing. And it's climbed all through summer. We thought that was a plateau. And then at the end of summer, it's continued to climb. And here we are today with 1,000 households coming through. We've seen a 26% increase year over year in the number of people coming to us for help.
From 2021 to 22?
Yes. And of that, 18% of the people are first-time people coming to the food bank.
Is what you're seeing now actually worse than what you saw during the height of the pandemic?
It is worse now. And it's worse because the food was more available during the pandemic. We're seeing food availability going down. What was once predictable doesn't appear to be predictable anymore. And it's probably going to get worse before it's going to get better, unfortunately.
What brings you here?
Just trying to get a little extra food. Can't really, trying to stretch the dollar.
Yeah.
It's not hard to spend $200 at a grocery store and only have a week's worth of food for 2 people,
Have you been coming here a long time, or this is more recent?
It's more recent. Since probably the last 6 months, I've been coming here.
Are you working? Are you...
Yeah, I'm working, but it's just not enough.
We heard similar stories from credit counselors and their clients at a money management counseling center.
We're getting all these folks who are telling us for the first time they can't pay their bills, they can't make ends meet. And often when they say that, they say, I'm a good person. I've always paid my bills before.
With the inflation, they just have eaten away their savings. People have told me, I did the 3 to 6 months of savings for an emergency fund. That's gone. So you're saying that it's not just folks that you're seeing that have had chronic problems with credit or there's a lot of new people that are coming to you now.
A lot of new people.
These are folks who had been making it before and were solidly middle class now. And today are struggling to make ends meet, struggling to keep their utilities on, struggling to stay in their apartment or their home, and are really in danger of falling out of the middle class. Like it's a shrinking middle class problem.
How real are rent increases right now?
At a local shelter here in Phoenix, we've seen an uptick of new families and individuals coming in that just could no longer afford where they were living. Because even where they were living, their rents increased $500 to $1,000 in 1 month.
Sometimes clients have called me now and they're angry when they call. They need our help, but they're angry, and I understand it. They're ashamed and they're crying, and all of that, but I was there. I was one of them, you know.
Are your numbers up in terms of people that are seeking out help at the moment?
So it's not just that we're getting more calls, it's that the folks who are calling us are in greater distress. Because now instead of calling us because they're just behind on their credit cards, they're calling us because they're behind on their credit cards and they're behind on their utilities and they're struggling with their housing payment. They are facing greater economic challenges, I think, and more diverse economic challenges than what they faced just a few years ago.
It's a different world, but I have to tell you, I go to the store and I am just shocked. I'm keeping my nose above the waves right now, but I feel like that wave is a lot bigger than I thought, and it's behind me and it's coming.
In the fall of 2021, with inflation at 6.8%, well above the Fed's 2% target, Chairman Powell acknowledged it might not be transitory after all.
So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
It would be the start of a new phase in the easy money experiment.
The committee is determined to take the measures necessary to restore price stability. Thank you. I look forward to your questions.
Over several months, they'd raise interest rates.
Good afternoon. It's nice to see everyone in person for the first time in a couple of years.
In response to the rising inflation, the Fed would also pause quantitative easing and begin tightening.
At today's meeting, the committee raised the target range for the federal funds rate. We also decided to begin the process of reducing the size of our balance sheet.
But neither Powell nor any other Fed official has explained with any precision just how far the Fed will go.
The Federal Reserve raising a key interest rate 0.75%.
Its biggest hike in nearly 3 decades.
The Federal Reserve has raised its key interest rates again. And a move that seemed unfathomable to many just months ago has now happened twice in a row.
Other events, like the war in Ukraine,
Russia is picking off Ukraine's military facilities one after another.
lockdowns in China,
China has decided to put its southern tech hub Shenzhen under a citywide lockdown.
and companies raising prices
A little bit of inflation is always good in our business.
would all send inflation even higher and accelerate the Fed's moves.
Reserve Chairman Jerome Powell speaking at an annual economic summit in Jackson Hole, Wyoming.
Which brings us back to Jackson Hole, Wyoming, in August 2022.
Yep, we're on.
That annual meeting of central bankers.
Here we go. He's on the move.
Where Jerome Powell signaled that he'd keep the Fed on course,
He made a call simply last year that didn't age well.
raising rates to try to combat inflation.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
How do you explain, for instance, to someone who is seeing their gas bills go up, their food bills go up, and groceries, their rents go up, how is it that higher interest rates and what you're doing with this very blunt instrument, how do you say that that's going to help them with those issues in particular?
Well, one of the reasons prices are high is because there's too much demand in the economy. And by raising interest rates, for example, we are going to slow down demand for housing, people going out and buying up homes, which eventually should prevent home prices and rents from continuing to climb. That should benefit workers. But things like gas prices, that's not being driven by us. I mean, that's being driven by the war, Russia invading Ukraine, Saudi Arabia cutting back production, big geopolitical forces. So there's some pieces of this that we can directly affect. Some pieces of this are out of our control.
I mean, some people have said your kind of interest rates are almost like a hammer or a sledgehammer. It's not like a scalpel. Can these problems be solved with a scalpel, or you really do believe that you need to bring the hammer down to some extent?
Well, here's the thing. I would love to be able to bring it with a scalpel. And a year ago, I argued that I thought many of these factors were transitory, meaning you've got these one-time events, they're going to pass, and then inflation will come down. So let's not bring out the hammer. That was my view. That didn't happen. So now we have to bring the hammer, because if we don't bring the hammer, this thing can get out of control.
So to those who point to the Fed and say you ran it too hot for too long and that was an epic mistake, you say what?
I said, look around the world. Other central banks adjusted more quickly than we did, to their credit, And unfortunately, their economies are facing very similar inflation. And so yes, with the benefit of hindsight, I wish we had tightened sooner, but I'm not kidding myself to think it would have made a big difference in where we are in inflation today.
Stick around for just a second as we watch the clock here counting down to 2:30.
A month after Jackson Hole, I caught up with business reporter Chris Leonard as the Fed was announcing another rate hike, moving at the fastest pace in 40 years.
Good afternoon. Today, the FOMC raised its policy interest rate by 0.75 of a percentage point.
It can be a little bit hard to understand because you hear, okay, the Fed hiked rates today to 3.5%. Well, what does that mean? That my credit card rate is going to be a little bit higher, or I'll have to borrow more money for a house? He is talking about a fundamental restructuring of the financial system. The financial system globally has been built around extremely low, ultra low interest rates for 10 years.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal.
I think people don't appreciate the magnitude of what the Fed did over the last decade. And so this is going to be like a long-term thing playing out over time, probably over like a year or two of shifting to a higher rate environment and then the correction that that's going to cause. So he's talking about a huge adjustment that's not going to be an adjustment upward. Things aren't going to get easier. Things are going to get harder.
Tonight, the economic alarms are blaring.
The specter of this kind of economic upheaval has heightened concerns about a recession.
And the Fed has made it clear its #1 priority is fighting inflation, even if it means the jobless rate, unemployment, goes up.
Good evening! Are we gonna let this corporation stop workers from joining a union?
It's also raised fears of layoffs, which has aggravated the organized labor movement.
I'm here with 12.5 million union members.
Liz Schuler leads the largest labor organization in the country and has been urging the Fed to slow down.
Listen to your workers.
We met with Chairman Powell and 6 Board of Governors because I think the Fed doesn't often get to hear from actual working people and how they're seeing things in the economy.
What was your message for the Fed when they started to raise rates?
That raising the interest rates is bad for working people, that we think it puts the trajectory that we're on at risk in terms of coming out of this pandemic. We know that we're in a consumer-driven economy, right? And if working people are not able to make ends meet, they're not going to be buying goods, and it's going to grind the economy to a halt. We can't take aggressive moves that are going to throw people out of work and basically balance the economy on the backs of working people.
But I mean, the Fed is tasked with controlling inflation, and inflation is definitely bad for working people. So why advocate for the Fed to take its foot off the pedal?
Well, because the interest rate hikes they were implementing were happening quickly, and we thought it was happening too fast. And also, though, their tools aren't necessarily going to impact the things like gas prices and food prices, which is what most working people are worried about.
The Fed doesn't ever want to say this out loud, but their goal is quite literally to make businesses not want to hire people or to get businesses actually to lay people off. The Fed has estimated that the unemployment rate under their very rosy projections by the end of this year would rise to 4.5%. There is no real way for unemployment to get from 3.5% to 4.5% without millions of people losing their jobs.
I understand the best case scenario being that you bring down inflation without unemployment going up, and that somehow we avoid a recession. But if employment does stay strong and inflation stays high, then don't you have to basically hurt the jobs market? I mean, isn't that the bottom line here?
We are going to have to keep raising rates until we get inflation back down. That is absolutely true. And one of the sources of optimism, and it's mild optimism, is when there have been recessions that have been caused by the central bank raising interest rates. The good news is once inflation is in check and they reverse their policies, the bounce back can be very quick. So we're not trying to engineer recession, but if one were to happen, I feel pretty confident that we could have a very fast recovery.
So how remote is the possibility that there could be much higher unemployment in the next couple of years?
I mean, I wouldn't say it's remote. It's hard to put the odds on it.
Throughout 2022, the economy remained strong. Unemployment hovered near historic lows.
Showing unemployment at a half-century low.
Wages were on the rise,
We also saw some wage growth, about 5% annually.
causing the Fed to continue pumping the brakes to try to cool down inflation.
The Fed has been raising rates in hopes of slowing the economy. And with so many businesses still hiring, that means the economy isn't really slowing that quickly.
That riled Wall Street.
Facing the growing possibility of a recession, Wall Street spent another day in turmoil.
And you're probably feeling it in those 401ks. Stocks are...
For the stock market and bond market, it was the worst year since the great financial crisis in 2008.
The Nasdaq down for 4 straight quarters for the first time since the dot-com bust.
In 2022, we've had this very unusual situation whereby you've made double-digit losses on both risky assets, stocks, and risk-free assets, U.S. Treasuries. That's not supposed to happen. But there's been absolutely nowhere to hide. That is a big issue for retirement plans, pension systems. No matter how well you diversified your portfolio, there was no risk mitigation in it at all.
It was all losses.
It was all losses.
U.S. existing home sales plunged to a 12-year low in December.
You've seen a huge impact on the housing market.
The Federal Reserve's interest rate hiking cycle has pushed
Housing prices have started actually coming down for the first time in a very long time. Mortgage applications have decreased. The crypto market, you've seen a number of companies wiped out.
Crypto winter is here.
That is not unrelated to what's happened with the Fed.
Sam, hold on to me, Sam. Let's go.
Sam Bankman-Fried faces investigations from U.S. regulators and potentially the Department of Justice.
He invested $3 million into Luna, and now it's worth 1,000.
You create these asset bubbles. That is, bubbles in stock markets and bond markets and real estate markets and art markets, whatever people invest their money in with borrowed money. And then those bubbles burst, and then that causes a downturn. So
Stephen Pearlstein has been reporting on the financial markets and the economy for almost 40 years.
That look like that. Bubbles tend to be everything bubbles these days, because if the source of it is cheap money, then you can be pretty much sure that it's not just real estate, or it's not just stocks, or it's not just tech and telecom, or it's not just Bitcoin. These things are connected by rubber bands with each other in a sort of way, and what propels one propels all of them.
There's a famous line by investor Warren Buffett.
You know, you don't find out who's been swimming naked until the tide goes out, and
Almost everyone I spoke to repeated that line to describe what's been happening.
When interest rates start to rise and the tide pulls out, as Warren Buffett would say,
you don't know who's swimming naked
until the tide goes out.
You see who's swimming without a bathing suit when the tide is receding.
We'll find out who's wearing their swimsuits when the tide goes out.
What's amazing is that a lot of people, and I would say I'm included in this, think that there probably will be a bigger correction at some point.
But look, when you say you expect there to be a bigger correction, what does that actually mean? I mean, a lot of people are going to see this and get concerned about that, obviously.
Yeah. Let me try and be honest, but not scare people.
Yeah,
if that's possible. So the markets were down 20% last year. That seems like a lot. And if we were in a normal market cycle, I'd say, okay, we're done. You know, we're probably at the bottom. I don't know if I can safely say that we're at the bottom because of what we're looking back at, this age of easy money, not just even since the financial crisis, but before that, you know, for the decades that rates have been going down and down and down and debt has been going up and up and up. That's a long period of time where assets have arguably been artificially inflated. And so is it possible that you could see a continued correction at some point? It is possible. Now, I'm personally not going out and selling my entire stock portfolio. I don't want to scare people, but I do want to say that I think we are in a once-in-a-lifetime financial transition. And I think that everybody needs to sort of strap in for that. And if you need your money in the next couple of years, I would be more cautious than not.
In these early months of 2023 on Wall Street, some have been betting that the Fed will relent, stop raising interest rates as inflation cools down. Because the higher it pushes rates and the longer it does, the greater the risks.
And so the marketplace is saying the Fed is going to go too far and is going to be forced to reverse course. That is really unusual. But we've got to a situation now where the markets dismiss what the Fed is telling us. It's a moment where there are many more potential outcomes. Some are fine, a soft landing. Some are not, a hard landing. And the truth is, you cannot distinguish enough between them.
One of the most pessimistic voices is economist Nouriel Roubini, who became famous for his accurate prediction of the financial crisis in 2008.
We have had literally a few decades of ever-increasing bubbles that have been fed and supported by central banks. And not only we have had bubbles, but we have had bubbles that have been fed by excessive leverage, excessive private and public borrowing, and excessive risk-taking. The party is over. Inflation is high and rising. Central banks have to increase interest rates. That is bursting the asset bubble, is increasing the amount of the debt servicing of everybody that overborrowed like crazy. So we lived in a bubble, in a dream, and this dream and a bubble is bursting and is turning into an economic and a financial nightmare.
If Roubini's prediction of a debt crisis is correct, then Jim Milstein would be on the front lines of it. He's known on Wall Street as the guy who countries and companies turn to when they run into trouble and need their debts to be restructured.
Wouldn't a debt crisis actually be good for your business?
You know, I'm getting a little too old for this.
Meaning what? Too old for what?
This business. No, it'll be a boom for the restructuring business, but I just don't think it's avoidable at this point. I think we're just, the bill has come due, and it's going to have to be paid.
How worried are you about what's happening right now?
I've never been more worried in the 42 years that I've been a professional, either as a lawyer, banker, or government servant. The American corporate sector has never been more levered in American history, never had more debt. And American households are just about as levered as they were heading into the 2008 financial crisis, whether it's student loans or mortgage loans or car loans or personal loans or credit card loans. We've borrowed a lot of money as a people. And so the Fed is absolutely right to try and get it under control by raising interest rates and slowing economic activity. But the most highly levered players in our economy are going to come under real stress, whether that's households or businesses or governments, as interest costs rise.
Are you basically saying that we should be preparing right now that there would be, a bursting of this massive credit bubble?
It's happening right in front of us. It's happening right now.
Are you usually this gloomy, or am I just getting you on a bad day?
You got me on a bad day.
One of the concerns is that there's a kind of debt bomb out there, both in the American economy as well as the global economy. How concerned are you about a credit bubble popping?
We're looking at the data. We're not seeing evidence of such a popping. We're not seeing evidence of delinquencies taking off. It might happen in the future. It might, but I'm not seeing evidence of it. Households on average have very strong balance sheets. The big banks, which can be very risky for the economy, are well capitalized relative to where they were before 2008. So we're not seeing evidence of it yet. Can't rule it out.
So I guess the question, though, is how much disruption in the financial markets are you willing to tolerate now that they're adjusting to this new interest rate environment after more than a decade of zero rates?
We live in a market economy, And market participants need to find a way to adjust to a changing economic landscape. It's not the Fed's job to bail out Wall Street investors if their stock portfolios go down. Obviously, we need to keep systemic risk from spilling across the whole economy. And when those events happen, we are prepared to act. But in my view, the bar from us acting should be quite high.
I mean, the Fed has come to the rescue several times, and we've talked about this in the past, of the financial markets that had grown vulnerable and brittle. So are you saying, I'm asking what degree of disruption would you have to see in order for the Fed to intervene?
You know, we're a long, long way away from that. I guess I would say it that way. We are a long, long way for any kind of disruption that would warrant us stepping in that way.
Less than 5 months after that interview, the Fed would indeed have to step in.
In breaking news, the US Federal Reserve has bailed out the Silicon Valley Bank, which had collapsed over the weekend.
It enacted emergency measures to shore up the banking system after 2 banks collapsed.
This is the biggest bank collapse since the 2008 financial crisis.
There are important questions of how these banks got into the circumstance in the first place.
We're seeing a potential fragility in the system related to monetary policy. If we hadn't been driving our economy for 14 years with easy money and then trying to really quickly undo that, no, we wouldn't be having these problems now. Absolutely not.
What should the Fed do?
So for a long time, I've advocated that the Fed should be raising rates. But even I believe now they need to hit pause. They've gone too far, too fast. They need to hit pause and assess the impact on the financial system and the economy.
It's unclear what the Fed will do next, but just days before the bank failures, Jerome Powell appeared before Congress to answer tough questions about the economy.
We actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase?
The hearing was a showcase of partisan politics and government gridlock.
Raising interest rates won't stop Senate Democrats and President Biden from overtaxing, overspending,
And it was yet another reminder of how, in an era of political dysfunction, we've become so dependent on the Fed and on easy money to drive the American economy.
The economy needs to get back into balance, and that will be painful. And if we keep putting off the day of reckoning, we'll just make the day of reckoning a bigger day of reckoning.
How do you think we'll look back at this era of easy money?
Unfortunately, I think we may look back on it as something of a golden era because, cheap and free money without consequences is great. But in other ways, we will think about it as a lesson for the future, which is that it was a mistake.
I think that we're going to look back on this era as being totally exceptional historically and one where we didn't fulfill its potential. We lost sight of something critical. We lost sight of how we grow our economy in a sustainable and inclusive fashion. The world of easy money went way too far, way too far. Let's do the other stuff that's needed. The stuff that really promotes genuine, durable, inclusive growth, and not this stuff that creates artificial growth. We are capable of producing that. None of that is in the hands of the Fed. They don't invest in infrastructure. They can't reform the tax system. They can't help labor retraining. This is a political problem.
For more on this and other Frontline programs, visit our website at pbs.org/frontline. Rajan's Age of Easy Money is available on Amazon Prime Video.
A professional trader managing over $30 million in capital, yet using a strategy so simple he says a 5-year-old could do it.
If you do have any psychological flaws, the market will find it. I've seen it happen, whether it be impatience, fearfulness, over-aggressiveness. You're going to have a good day one day, you're going to have a bad day one day, you're going to be happy one day, you're going to be sad one day. If you're not psychologically well built to manage these situations, the market will take it from you.
Introducing Rajan Dal, a technical analysis lecturer and a professional money manager with nearly 2 decades of trading experience, using a very simple yet effective system built entirely on naked charts. In this episode, Rajan reveals how he generates trade ideas utilizing just 2 time frames, the risk protocols he uses to keep his drawdowns tiny, and how any trader can copy his exact checklist using only a single line on the chart.
Technical analysis teaches you how to be an analyst. Trading teaches you how to be a trader. They're 2 completely separate things. An analyst can't be a trader sometimes. A trader can't be an analyst sometimes. They're 2 different jobs.
What is the difference there?
If we can break it down to the basic form, it's like institutional traders are the ones that move the markets. We can't sit there with our 500 quid a position or whatever it is and think once that's in the market it's going to move the market. It's not. But when the big boys come in and it starts to break out of a range and it starts to wave, our job is to join that. Predict it, forecast it, whatever you want to call it. That's our job. And we are going to get that wrong just as much as we are going to get it right. The amount of technical analysis that you know and do is not going to help you. What's going to help you there is your discipline and risk management. That, for me, is what a trader's job is.
Speaking on taking technicals into a strategy, people usually learn to read price before they learn how to trade. What is that journey, or the correct journey to go from analyst to trader?
Now I have the luxury of hindsight.
Ladies and gents, welcome back to another episode. I'm joined by a nice veteran we have over here, 16 years of market experience. Rajan, thank you very much for joining us today.
I'm fearful to say it's now 19 years. I'm older, so yeah.
Well, the wiser you get. I want to kick off right away with the trinity that is money management, psychology, and technicals, and these are heavy components for anyone's journey in trading.
Yeah.
But how would you rank or prioritize, or what is your philosophy on the dynamics of the 3?
Yeah, so we call it the 33% rules. So it is 33% risk management, 33% psychology, and 33% strategy. So that's how we kind of manage it. I don't think there is one that's more important than the other. I think when a lot of new traders come to the market, they think, oh, it's the strategy that makes you money. I really don't think it is. So that's why we split it evenly between them.
I think it's the best way to do it. I've had both sides of the spectrum on the show, and I find sometimes people use psychology as a scapegoat. It's like, I don't have a clue on my technicals. I haven't put the time or effort to solidify it, but it must be my psychology. And it can become an easy way out, but there is truth within it. So if you can help me dance that delicate line of coping mechanism or blaming psychology versus no, this is where it needs to be addressed.
Yeah, I think the psychology creeps in areas that you don't really expect. So what I would say to any trader is if you do have any psychological flaws, the market will find it.
And amplify it, yes.
That's what I truly believe in. And obviously coaching traders for so long now, I've seen it happen, whether it be impatience, whether it be fearfulness, whether it be over-aggressiveness. However you are at one stage or another, you're going to have a good day one day, you're going to have a bad day one day, you're going to be happy one day, you're going to be sad one day, you're going to be depressed. These are all things, if you're not psychologically well built to manage these situations, the market will take it from you.
I believe that the markets can amplify the emotions you already have, or large numbers can amplify whatever. If you have a bit of greed, the market will bring it out of you, for example. And I found in my own experience that the way I traded in terms of a technical perspective, I tried to cater it in a way that would support my individual psychology. For example, I learned after a few years that I don't like seeing a big number in profit and then having a 50% retracement. That retracement portion, which might be just a couple of days, eats me alive, and I take irrational decisions. So long story short, but then I ended up being a more intraday trader because I like the instant feedback, and it catered to my personality more.
Yeah.
How much do you believe technicals can support your personality type, or should psychology be its own thing that is addressed?
So the market wouldn't care about you in that situation, right? It does what it does regardless of whether you're in it or not. So I would say that statistically, if you continuously trade like that, in that way, and it produces numbers, that one trade or that one issue shouldn't bother you, because it's not, anything can happen at any one given moment. It's the sample size that's important. So let's say you had that scenario where you have a 50% drawdown on a trade. Let's say, for example, 70% of them came down to your 50% drawdown level, but the 30% of them went to 5x, 6x after. You're doing okay. But you're not allowing yourself to know that because of the psychology. The psychology is what kills you to find that out. And that's the problem.
You mean if people take decisions too early based on psychology, 100%. You don't have a sufficient sample size to find the data of what's the truth, and it's an emotional decision.
Correct. And that's why day trading has like an allure for the instant feedback, like you said. But the issue is in day trading, you have less time to make those emotional decisions. This is why day trading is harder than swing trading for a new trader, because you're having to make the same kind of decisions in a fraction of the time. Like for a swing trader, you could have a day, maybe even a couple of days to decide whether you're taking profit, when you're going to move your stop, how you're going to trail it. But when you're day trading, you've got milliseconds, sometimes seconds, to make that same decision. And they're not going to be the same quality decisions. It takes a lot of training.
Yes. On this topic, I didn't mean to end up here, but kind of swing trading or higher time frame trading versus day trading, scalping. So of course there is you can call it decision fatigue, or just you got to be on the ball on a lower time frame trading type. At the same time, I just want to talk about, let's say, variance or degree of certainty linked to time, in the sense of if I just look at market open on euro dollar, the chances that it will be 10 pips higher and 10 pips lower, just that box, you could probably call it with like a 80% certainty it will be within that box. But then if you ask me where is it going to be in 1 year compared to 10 minutes, as time goes on, it can go 100 pips down or 1,000 pips down or 1,000 pips up. So duration, I guess, would reduce your confidence in where price could be. Would that come into influence when you're talking about day trading versus swing trading?
It does, but it still has the same degree of certainty. At the end of the day, it's still 50-50, right? If we said that 1,000, 1,000 or 10 and 10. So it does come into aspect, but it's still a coin flip if you're looking at it in that respect, because the variables that we have over a long-term period, there's a lot more variables over that period of time. Trump, elections, power,
war breaks out,
exactly, all that kind of stuff. But during an intraday trade, we still have variables, but obviously they're easier to cope with because they're a certain amount of time. So today's example, there was like some bombing in Qatar today, but nobody had that on the cards today. I don't think anybody would have thought about that. So
these things you can't forecast.
See what I'm saying? So it's still there, and the averaging of that number, of the probability of that number, is still the same because we've chose something that's equal.
Just on this topic of probability, so I came across this table, and you're probably familiar with it, and it was basically the probability of X number of losses in 100 trade sample size, and it was win rates against number of losses in a row. And for me, if someone was to just ask me blindly, what's the percentage chance you have 7 losses in a row or 6 losses in a row in 100 trade sample size, I'd be like, it's unlikely. I don't get 7 losses in a row. But in 100 trade sample size, 7 losses in a row, the probability was something like 60-70%.
It's
extremely high, to the point where it's like something you have to face at some point in your career. 7 losses in a row. Talk to me about this matrix of probabilities of losses in a row and how you can psychologically adapt or have money management systems in place.
So this is something that we involve and delve into deeply. This is the heart of D&D and how we trade, right? So I trade the same way every single day. Every single day, I take pictures of the trades. They look the same. Everything is the same about it every day. When we started the company, we monitored the first up to 400 trades. So 400 trading days. I only take 1 trade a day. In those, we had 8 losses in a row, 8 winners in a row, through the sequence of the documents where I keep the records of this, it happened 4 times over those 400 trades.
Okay.
That we lost 8 in a row. Yep. That was the worst losing streak and the most winning streak, consecutive winners and losers. In that period of time, though, it doesn't account for where you might have 3 winners, 1 loser, and then 8 winners or something. So then the compound effect of that is encountered in that. And this is where I think the consecutive losers and winners thing comes in. You have to be prepared, I think, to get between 7 and 14 trades in a row wrong, worst case scenario. So if you're trading 1% per trade, which is what a lot of the gurus tell you or whatever, are you prepared to have a 14% drawdown? And how will you psychologically react on a 14% drawdown? So we look at drawdown values on worst case scenario basis. And normally our traders use a 30 trade worst case scenario drawdown.
30, huh? Where did you get the number 7 to 14? What is that symbolic of?
Practice. It's actually real data. So it's simulated data, as in like data from real markets, but then also forward testing data and live trading data. That's how we know the answers.
And the reason you decided these numbers is because in a 1 year sample size, you will encounter it once or twice. Hence, be prepared for that.
Yeah, and then but it goes for you as well. Yeah, it's non-discriminate. So it's absolutely fine if it goes for you or against you. But 1% of your account balance is too high if that's what you're thinking. So if you're starting, let's say, with 100 grand, if we use that for easy maths, and you're trading $1,000 a trade, are you willing to lose $14,000 and still psychologically perform in the same way? Not many traders can do that. And that's the issue of why a lot of traders don't make it.
Let's take a moment to talk about a partner of the show, a leading prop firm that is Funded Next. And it's important for me to listen to our community to see who are you working with and how can we make your experience better. And the main feedback I heard is trusted payouts, quick payouts, ability to scale, and affordable prices. And Funded Next has ticked all of those boxes, not only being a top 3 prop firm in the industry, but also having on-demand payouts, and every 10% you gain on your account, you will double your capital for free. And because in this industry, trust and reliability is the most important factor, an important guarantee that they have is that if you do not receive your payout within 24 hours, they will gift you an additional $1,000 to your payout just for being late. So to unlock all of these benefits and work with a leading prop firm in the industry, Funded Next, check out the link in the description or use the code TOT. If you were to put a percentage of drawdown, that is something that is manageable to absorb and perform at the same level, just so I can help understand, we're assuming 7 losses in a row, what percentage risk should we go for? What kind of a drawdown you see people easily bounce back from, and then it gets harder and harder thereafter?
So what I normally do is on total account balance is a 20% drawdown divided by 30 trades. That's what I normally do. Yeah.
Okay, so just under a percentage.
Yeah, correct. Okay. So normally 0.5% to 0.75, and then also this can change to summer and winter markets. Summer markets I'll drop down to like 0.5, 0.3. Okay. Winter markets I'll do 0.5, 0.3. But when we're in peak conditions, sometimes I'll put my risk up higher to counterbalance that. So like throughout the summer, this summer, I was trading minuscule amounts of money for my account, just to keep myself sharp. And then when September kicks in, I'll up my risk.
Which asset class or where are you noticing the seasonality where it makes sense to modulate your risk based on time of the year?
Always equities, because like it's a historical thing. This year was actually very good. The volume was decent in August this year, but the previous 2 years it was very poor. So the strategies weren't working in the same way. And what we mean by that is, like, because I normally trade around the Open, the US Open, we wouldn't see as much volatility in terms of how far things would run around the Open in those months. And that just means you're not going to hit your targets, right, for your trades with the same stop losses.
Does that mean you try a different strategy for this period, or just drop down risk and be conservative?
Drop down risk and be conservative, and also book a holiday for the summer.
Okay.
That's it. So I go away for 2 weeks every summer.
Meaning, say, pick your battles and know when to be on.
Yeah. This summer, like I said, was a really good summer, and it is unusual for us to have it like this. But in the previous 2 years, our strategies didn't work as well in the summer as they did in the other times.
Talking about drawdown periods, there is also a conflicting approach you could have, where one party may say, let me maintain my risk throughout. Let's say call it 1% risk, even during 5 losses, 7 losses in a row. I want to maintain that risk because when I encounter my winning period again, I can recover at the same rate. Whereas others may drop their risk during a losing period for psychology reasons, but then you're longer in the hole, and that might amplify psychology because now you're, instead of 3 weeks, you're 6 weeks in the hole.
Yeah.
What is your view on that?
You're trading at that time something you don't know the answer to. So I follow the rules of the drawdowns. So like if you've given yourself a drawdown level of 20%, you trade the same way until you hit the 20%. That's my personal opinion of it. The other thing is that a lot of people don't consider the percentages of compounding of drawdowns. They only consider percentage of compounding of profits. And to me, that's not great. So like, for example, you start an account with 10 grand, you drop it down to 5 grand because you've lost. You now have to make 100% to get it back to normal. Who makes 100% in a year, right? This is what I find interesting about compounding. It works on the way down in the same way as it works on the way up. So if you're reducing your position size when you're losing, but increasing it when you're winning, that makes more sense automatically. Yeah. So if you have levels in which you reduce your position size on your way down, that would be my advice to anyone. So if you started with a 10 grand account, you say, okay, well, if it goes down to 9 grand, I might drop my position size a little bit. If it goes down there, yes, like you said, it takes you longer to catch up. But the whole point is to stay in the game until you know how to trade properly.
Talking on psychology, there's multiple ways to describe it. One could be sitting in the emotion until exposure therapy, until you're desensitized to that stimulus and you can make better decisions. Another one is putting in protocols in place. For example, after X amount of losses, I've got to walk away and then trying your best to adhere to it. Another one is when you just go through turmoil, you go on tilt. You know what the right decision is. And you're fully aware. You've got a trading plan, tick boxes, whatever you choose. But adherence to that, psychology becomes the problem to adhere to the plan. Specifically on that portion, how can you internalize beliefs that we all know about of what is good psychology, but doing it is the hard part? How can you exercise that muscle a little bit better of adherence to the plan?
I think this is the reason why psychology is important. So I trade a professional trader who works at a very prominent institutional organization. He's a professional trader, has been for 20 odd years. Now, at the moment, he's been struggling with this. So he's got some problems outside of trading, the trading world. He's busy, he's stressed, etc. He's come into the office. He's not trading very well. But then he thinks that because he's not trading well, he has to catch up. And this is somebody that's a professional trader that's been trading well for a very long period of time. And it gets somebody like that. So we're not perfect, right? But what I would always say to somebody is that we have to have a process and a plan for when we're not perfect, because it's not possible just to run at top performance level, all of the time. Look at it the same way as a sportsman. A sportsman's going to have an off day. So you need a process for that. And whether it be, to let's say, for example, if you've lost 5 trades in a row, simulate trades till you get back. Yeah. But this might not feel right for somebody who's new to trading, because the markets don't go anywhere, they never go. And if you're planning on trading for 10 years, that little period is going to be nothing to you. But for somebody who's new to trading, they might start winning and think, I should have been trading live then.
Yes.
But that's the psychological issue, right? So, yeah, going back to this, I would definitely say, depending on each person, especially the tilt thing, everyone's different. Some people are very dense to their emotions and they might not understand and look and not be able to look from an outsider's perspective. Some people are able to look intrinsically and work it out, and it really depends on the person when they're on tilt.
Mm-hmm. I want to pivot towards technicals here, and obviously you're part of I didn't know about this prior, but a prestigious institution for technical analysis, a society. Yeah. And I guess you train all walks of life from a professional background, university grads and so forth, and you're teaching them the art of technical analysis. I want to first start off with, these guys are usually academics and probably high intellectual and so forth, high IQ. And then you've also trained people that are in a regular community. What is the difference you notice in the ability to learn or grasp or conceptualize or over-intellectualize when it comes to trading and technical analysis?
Yeah, so there's no difference in terms of who can make it and who can't make it. That's one thing that I would say. Resources are an issue, right? So if you work for a bank or whatever, you have more resources. But in terms of intelligence, there's no difference between the two. That's the first thing I would say. One thing I would say is that I would choose an emotionally intelligent person, 75% of the time more than an academically intelligent person.
Interesting.
Personally. So like, for example, on the pit days back in the day, they would choose like market traders and stuff, because they have a gut feel. They know when something's being undervalued, underpriced, or overvalued and overpriced. And that was a good thing for them. But they weren't always, academically intelligent. Then we moved over to the quant trading time and all that kind of stuff. I lived through that phase. And I was saying to yourself, like I had, a very, very top level maths graduate. He had a master's, a PhD, master's learning for his PhD in actuarial sciences. And he just couldn't cope with the strategies not working in the same as the simulators as they would in real life. And yes, he had intellect and he developed very good trading systems, but he didn't have the emotional IQ to understand it. And that's where he needed to be trained. And then at the Society of Technical Analysis, we've had people there from, people that work at gas and power companies to big investment banks to central bankers down to crypto traders. It's anybody can come there to learn about technical analysis. But it was a really, really good experience to basically see, because I keep in touch with a lot of people anyway, with their learning and where they end up working and stuff, of who can stay in the market, who can continue on the path of trading. Because we had a brief discussion and I said that technical analysis, it teaches you how to be an analyst, right? Trading teaches you how to be a trader. They're two completely separate things. An analyst can't be a trader sometimes. A trader can't be an analyst sometimes. They're two different jobs.
You mentioned moments ago emotional intelligence. Number one, what do you mean by that? And number two, how can you specifically train that to get better at it?
It's tough. That's the tough part, because we're talking a lot about ego, pride, sometimes things like that.
Oh.
So when you're in your learning phase, adults, they're very different learners to children. So an adult will come into something automatically wanting to be good at it and get frustrated that they're not good at something. You can't expect to be a good trader. No one can when they walk through the door. Basically, even if you have a really good run at the beginning, what happens when you start losing? How do you react? That's going to be twice as bad if you start well. But if you start tough and then you go through the tough period and then you build yourself out of it, in my history of coaching traders, that ends up being better, because then they build resilience. Whereas if you do really well at the beginning and you all of a sudden lose all your money, you have to get grit at a later stage after being successful. So little things like that, they're always really, really tricky. Emotional intelligence for trading can come down to being impatient and finding out, watching yourself from the outside, is like, why did I get impatient there? When you're in profit situations and you're too quick to grab your profit, or being too greedy and trying to let it run, moving your stop losses on the downside because you have hope. All of these things are emotional intelligence. Why are you doing these things? How do you analyze yourself to stop? Not analyze the chart. How do you analyze yourself to stop?
I'm very interested in the word ego. I want to explore this a little bit more, because ego can be self-worth, self-preservation, confidence, and that can be tied to data. So you're like, I've built my ego in the market because I've seen, I've had profit for so long. But it can also tip into overzealous and thinking better than the plan, and taking intuition too far, for example. What does ego mean to you, and where is that sweet spot to have an ego?
Ego is a good thing if it drives you forward, and it pushes you to improve and learn and get better. That's when ego is a good thing. So it's important to care about yourself, and even to a certain degree, like how you look on the outside sometimes. I think that's an important thing, because you don't want to look like an idiot and you don't want to be an idiot, right? So that's the good part of ego. The bad part of ego is that, like, for example, if you're trying to learn something and you're like you're not honest with yourself that you're finding something hard, or or something else is everybody else's fault. Oh, I got stopped by a broker. My spread's been slipped. Everything's everybody else's fault and none of it's my fault. Sometimes that's ego as well, right? So they're things that are going to stop you from learning. They're going to stop you from looking at yourself and working out what your problems actually are and blaming everybody else for them.
That makes sense. You hinder your own progress. How about identity and how that comes into ego, let's say? What I'm referring to here more is, I think it's that book about habits.
Atomic Habits.
Atomic Habits, there we go. And he's talking about the smoker. And it's like, if you just, the self-dialogue you have is, I'm a smoker who's trying to quit. That's basically saying I'm still a smoker, versus when you reject cigarettes because I don't smoke. You've had an identity shift, and these guys are more likely to actually quit smoking. Have you noticed anything when somebody is kind of learning to trade on the side as a side hustle, their friends don't know about it, and it's just a very small thing. Therefore, there's not really a cost to give up. You just quickly tried it and you can quickly leave. But the moment you've said to your friends and family, I am not a trader, and maybe even gone full time, and you've got this identity of a trader and whatever that embodies, that it forces you to a level where you're more likely to see it through or more likely to succeed. Any dynamics there?
Yeah, so if we do a lesson on this now, why would somebody do that? Why would somebody not? Why would somebody, their self...
It's preservation of your image.
Got it, 100%. So self-preservation, that's ego. So they're already worried about how they're looking on the outside if they fail. You can't do this job if you're worried about failing.
Yes.
Yeah? We are going to lose 50% of the time, I would say, and at the beginning, if not more than 50% of the time. So if your ego is hurt by failure so badly, this is not the right job for you. You have to work that out, right? And you answered it correctly, because identification, so we do something where we say, well, I'm trying to be disciplined. You're not trying to be disciplined when you're a trader. You have to be disciplined when you're a trader. That's it. Yes. So it's like, I'm trying to do this, right? I do enter early sometimes. No, you can't. Like, you have to train yourself to, I am good at following my process. You write that in your diary. I manage my risk. They're confident statements, the fact that you can actually manage to do it. And honestly, it doesn't take a lot. I would say after writing that down in your trading journal about 20 times of doing it, it starts to become second nature. And when you change strategy, that's also a problem, because it's a confidence thing. You don't have confidence when you move into something else that is working yet. So you have to start that cycle again. So prior to the Trump tantrum in April, I had an opening gap strategy that used to work quite well. It stopped working because volatility was squeezed around the open when that happened. Okay. And I changed something to it after. And because it was slightly unfamiliar to me, I found my decision making to be a little bit more erratic at the beginning, and I had to coach myself into being, well, no, I'm waiting for this signal. I'm going to be patient. I'm a sniper, basically, and that's what I'd wait for. Now I don't even think about it anymore.
For the last 2 years, a proud sponsor of the show is a top-ranked leading prop firm, Alpha Capital. And for the years that I've been working with them, and the thousands and thousands of viewers, you guys, that have been working with them through the discount codes of Titans of Tomorrow, it's clear for me to see why they are a top-ranked prop firm in the industry. They have also reached a monumental milestone of $100 million in payouts. And with the multiple step plans and the multiple package types they have, there's going to be an option catered specifically for what you're looking for. So you can buy an evaluation account catered to your needs at the most competitive prices, and with our discount code TOT for Titans of Tomorrow, you're able to get the most unbeatable, unmatched prices in the industry with a leading trusted prop firm. And with that being said, let's get back to the episode.
Exploring psychology once more. Of course, there is things you can do outside of the markets, just in terms of discipline and the ability to follow the plan, motivation, all of these things. And this can branch off into journaling and all these other things. Yeah. Another thing is just exposure. And you don't have to do all of this meditation, journaling, and morning routines. But the moment you've taken 500 losses, that 501st loss is not going to feel as bad as the second loss. How much of psychological improvement comes from just immersion and exposure to things versus, you got to build habits and routines around it?
Yeah, so I think I've heard a lot of people say that, trading psychology is fake. It's nothing. It's not real, right? I don't really believe that, because if we looked at it in the sense of a golfer putting, for example, or a tennis player serving, a lot of that is the same psychology as trading. So yes, you need to. That's the fear of failure that we're talking about there. That example of 500 trades. If you fear it, yeah, and you're not basically accepting the chaos and randomness of the market in that sense, your decision making is going to be different if you have fear. So you can't do anything well with fear. So going through that process is good in a way, because you start to get numb to the fear, and it will help you. But if you enter a trade expecting to lose, I believe that you're probably going to lose. So that's also a negative thing as well.
I like the comparison to sports, and where you can imagine like a World Cup final penalty versus a penalty in training ground. It's the fear of the outcome, despite the process being the same. You've got to kick a ball into a net, but that can amplify internal thoughts, I guess.
So you look at all of the best ones in the world. So let's take Cristiano Ronaldo. He does the same run up, the same sidestep, the same everything, and that's why he does it. So he's had psychological coaching for this, and it's these routines that take all of the external factors away as much as you can. You can never take the external factors away, but as much as you can. The people, if you watch who do sports to do the same thing, they've had psychological coaching 100%.
Yeah, I saw a clip on this just yesterday. Djokovic, I guess he has a ritual to bounce the ball prior to his serve. And I don't know why it's probably a mental cue or a trigger to get into the zone. But I guess it was taking him a moment to get into the zone at one point. So he did 50 bounces. And he was not going to go until he was ready, until he had that whatever feeling. And you also see it with Nadal. He'll always, before a serve, he'll just do these, it looks like twitches. He does the specific wipe in a specific order of the sweats. But I guess it's to frame you into the zone.
I'll tell you, there's an interesting one. If you watch film stars when they're being interviewed on camera on chat shows, they do this thing with their hand, and they'll tap their thigh. Same thing. They've been coached. Their media training.
So what is going on here, or how can I apply that into my life?
So I'll give you the example for trading. So I will do the same, what I call a warm-up routine, because I was a sportsman. Same warm-up routine leading into the trading session. So 15 minutes before I open the chat room, which is 1:45, make a coffee, listen to the same song, do my trading meditation, go through the markets in the same way as I do in the chat room, go through the news in the same way as I do in the chat room, then I'm ready. So every day is the same, and that's the ritual to get through to.
And how does that benefit you when you do it?
It reminds me to perform at the same standard every day. Now, this is what we were talking about, is like some days you're going to have a bad day, some day you're going to have a good day, in the sense that you might have had an argument with your wife, your dog, your cat, whatever. You might have had a bad night's sleep the day before, but the consistency is important. So you're never going to be the same every day, but if you consistently try and perform 7 out of 10, 7 out of 10, 7 out of 10, you'll do well, right? And that's the point of the ritual and the warm-up.
And I guess, is it serving as a mental cue to leave outside troubles at the door? Because now I'm in this frame to get into the trading mindset.
Yeah, correct. And I don't know if you follow football, but like Bukayo Saka, who plays for Arsenal, he's the one that missed the penalty in the final, right? He stood up to take the penalty again.
Yeah. In the news, he took a beating.
So the next round, the next tournament was the Euros, and he took a penalty and he scored, right? And you saw like the whole nation, like all of his mates, and that was like a big thing, because like in trading we have to do that. Like sometimes, yes, we're going to screw up sometimes, but you have to have courage, to get up and do it again to the same level. There's so many comparisons, and I think like with the rise of like kind of automation and AI and stuff, there's still a psychological element to this, because it's people that make those functions that trade the markets. So like I've designed systems, like automated systems and stuff. Like I trade manually, but I've designed systems. It's still somebody's brain that's making those things. So the market is still moving with that psychology.
Of course.
And it might change at some stage. We don't know if it is or it isn't, but we'll trade the same way until it does.
How can somebody be better at free from outcome, or the feeling of, because if you're to boil down trading psychology, it's because it's fear of an undesirable outcome, and that can be, I'm not making enough money, or just revenge, I lost too much money, and so forth. And the more detached you can be to that, the more able you are to trade in a stoic sense. How can you improve in that area?
So this is against all human nature, right? So if we can break it down to the basic form of human nature, it's like if you have a blindfold on and you've closed all your senses and you're stepping onto your next step, it's uncertain if you have all of that, right? That's the same thing. So we have to challenge ourselves in that same way it's the people that don't care. So like if somebody's walking on a tightrope, or if somebody's like a free climber or something, there's a reason why they're able to do that. They've trained. So like my mate Stephen Goldstein, he uses this analogy, whereas a tightrope walker, if it's like 30 centimeters from the ground versus a tightrope walker when it's 30 feet up in the air, you're still doing the same skill. Why is it different? That's the training that the traders need. So we have to train to deal with the uncertainty and randomness, right? And the key that I use, and there's a lot of tools that I use, but visualization is a very strong one. So before you ever start trading, if you imagine yourself of how you would react emotionally and psychologically in a losing situation and how you would react emotionally and psychologically in a winning situation prior to it happening, your body then takes away some of that uncertainty. You can never remove some of the uncertainty in the markets. You can never remove that. But you can remove it in yourself by thinking and visualizing about how you want to act in all of the possible outcomes.
And you do this on a trade-by-trade basis?
Yeah, it tricks your brain. That's part of the meditation prior to trading. And it has to be done in the right way. Like, so there's not, you have to learn it, but it works.
Yeah, very interesting. Moving into, you mentioned you have algorithmic trading, or you've coded algorithms versus manual trading, yet you choose to continue to be a manual trader. Is the reason for that because there's always going to be a degree of subjectivity or experience, intuition? Or what is the reason to choose to continue to be manual?
So I like trading. This is the first reason. Is like it challenges me every day. So I don't want to remove that from my life. The other parts of it is that it's still the same. So like normally when you employ algorithms to do your trading for you, you might have like 5 running at once or 7 running at once, turn off the bad ones, allocate higher to the good ones and keep switching them around. Still really the same decisions at the end of the day. The performance is still made on judgment that you're having to make depending on which algorithm that you're using at that particular time. So, and also algorithms, they stop working after a while and you have to design new ones and things like that. So it ends up being the same job, but obviously the manpower is very different with an algorithm. It's cheaper. That's the only plus point, honestly, that I would say. It's cheaper.
I guess on a fund level.
Yeah.
Okay. This brings swiftly nicely into the point of managing other people's capital beyond your own. Yeah. And obviously that can, well, I imagine it amplifies everything from a psychology perspective, because now there's more on the line. As you ventured into that side for the last few years, what have you had to learn, or what challenges have you faced in managing others' money?
Yeah, so I am by nature not a reckless person. So when it comes to like when we got funded by the fund that sent us money in Cayman, right? One, it was like I don't want to ruin this opportunity. So that was a big thing for me. It's like we have staff, we're a company, we've got traders. Like if one of us does something out of the ordinary that's not great, it affects other people, they lose jobs, etc., etc. So that was one part. Another part is that some people find it easier to lose money that's not theirs, so the responsibility factor, that's also another factor that kicks in. And then just really performance, like how can you continually perform in the same way that you would with your own money that you would with somebody else. So it was an interesting story. So it was like 3 years ago, and we met and completely innocuous. I got a message on LinkedIn saying, "Oh look, I'm at the trader show. Meet you." Blah blah blah. Looked at the company, didn't think too much of it. Had a coffee with Adam, and we spoke about him trying to fund other companies. It hadn't gone very well. He said, "Oh look, because of that, I'm going to start really low with you guys." So he started us with like 25K, and he was like, "If you put your money where your mouth is and it works, we'll expand this up." So did that for about 6 weeks, did all right, roughly making about $300 a week for over that time. Then did it with 50K. In the 50K, we would then started to make between $600 and $900 a week. And it was like, right, this is actually working. And that's kind of where our company was born, because there were 3 of us doing it. So it was myself, James, and Oshin. So D&D, so my surname's Dahl, James North, Oshin Dance. So that's where D&D came from. And basically we built the capital all the way up to like $1.2 million. That's how it started working. And then it was like, well, can we train other traders to join in with us? So as we've been coaching traders, we start to see like, we have a good track record of coaching traders anyway. So I would say like, the broker statement is like 80-90% of traders lose who come into the market. We work on a variance factor of like, if we get 100 traders in and we can train 50 of them to a good standard, I'm happy with that.
Oh, you shifted the bell curve quite a bit
basically
to be able to do that. Yes.
That's the thing. So that's what we try and aim for. Our aim is like 50% of the traders we try and train, we want to make sure they're good. And what we consider a successful trader over our annual period would be if they have 3 consecutive months of profit. Yep. So that's also quite hard in somebody in their first year or in their first couple of years. So we give ourselves quite a high barometer of what we can do. And then there's the shift over from trading a simulator to then trading live money. And then if you're trading live money to try and trade big live money, there's lots of psychological challenges that come across this. So all of this is incorporated into that fact of trading somebody else's money. Can you do this at the same time? If somebody gives you capital, like how is that person going to react to that capital? I've got like 18-year-olds on my books, 21-year-olds on my books. Wow. And then like they're trading with their own capital at first, and then we give them money. And they're like, well, how are you going to handle this now? That has to be trained.
What was the reason you even chose to take that path as opposed to just continue to trade your own money or utilize the FTMO type prop firms? Why take this route of external funding?
Because we want to be like the next big prop firm, right? That's our goal. So like if mentioning names like SMB Capital, Millennium, like those guys, Tower Trading, like there's some really, really good examples. Marex in the UK as well, where they just started with like 5 or 6 traders, built this thing up, and then really, if I got 12 traders that I could trust with risk management, trust with probability factoring and psychological management and all this kind of stuff, that's a result. Then I can trade with them, or whatever, I can trust them with the money. We can go out and develop this company, and that's the actual aim.
I'm curious to explore when you're no longer trading on an individual level, not just capital, but I mean also how, in your own sense, I trade my money. So it's my strategy, my thoughts, and it's individual. But the moment it's a team effort with others' capital, you can have conflicting ideas, and you can also be a team about it. And then you're looking for too much perfection. It can be an echo chamber where you all become yes men to each other's thoughts and end up on the wrong side. How do you balance trading as a floor where you can also share resources, but you can also share problems?
That is very true. So like there has been times where like all the traders are in the same live trading room every day, and we see that only like 3 of the stocks are setting up because they're the only 3 that are looking good, and where all of us are in the same 3 stocks. So it does happen. Like, but what ends up happening from month to month is that the 2 traders can trade the same way and have completely different results. So that's what ends up happening. Like I've not had a problem where 2 traders monthly P&L has looked very similar. I haven't had that yet. So until that becomes a problem, I think it's fine.
And on a, I guess, a manager level, would you try and take down risk if you see the team is overexposed on a single position or single idea, or you let the probabilities play out?
So we're really good with risk management. So every account that we have has a daily circuit breaker, and it also has an account circuit breaker. So let's say, for example, I've got 10 traders, and I say to them, well, you've all got $1,000 risk a day. Okay, if they hit $1,000 risk, the trading account shuts off. Yeah.
Okay, nice.
If on their accounts they've got $20,000 risk, if they hit $20,000 risk, their account turns off. Right. So that's what organizes this. If they ever go down that front, they have to stop trading. And every company has traders that fall off and traders that do well. So the traders that end up doing well, it's like an index fund. Like an index, like the FTSE 100, is only ever going to get stronger because the losers drop out and new ones come in that bring it up. And it's the same.
I want to talk about, I guess most of the traders are men, and men are generally competitive.
They're not actually in our company, but we've got loads of female traders. Yeah.
How interesting. I struggle to find female guests on the show is because it's just a very male-orientated
industry. Take them from us.
Very interesting. Yeah. Okay. How did that come about? Because that's not the demographics in the industry wide. How did you end up with more women?
So,
is it back to the emotional intelligence, maybe?
No, I'm pretty sympathetic to this part, right? So, like, women in our industry and like the female traders that we have, so like we'll push them, to train and trade well. So like Mayan is our swing trading guru, our coach really, because she's very, very good at swing trading. She's probably got the highest win rate in our company in general, right? She's an S personality, so that for us that just means that she's more on the caring, sensitive, patient part. That's her character. So when it comes to presenting, when she's online presenting. Like at the beginning, like she's quite calm and quite quiet, but you get to know her, she's not. So that's why I think sometimes that balance comes out. I think you said that the male competitiveness, people are attracted to that when it comes to trading, but actually there's important parts of trading that her feminine characteristics are very important for.
I see it because women, they have a lot of traits over men where they might be more organized, they'll think things through more often, probably more risk averse. So there is benefits. Where I was going with that comment was, if I take a loss or if I go through a losing period, it's almost a secret. I don't tell anyone and I deal with it myself, and maybe because of shame or whatever, it becomes a private affair. But in that scenario, not only the investors would know, I guess you as a manager of the team would know, but also that your peers in the team would also know, and that can be quite a daunting prospect. Or how do traders, in your experience, navigate with losing on a stage, let's say?
That's culture. So that's what you're describing is the culture within a company. Because we're so open with our wins and losses every day, like the vulnerability and shame, we accept it. We have to accept that. So if you ever, the best person that I can explain for this about is somebody called Brené Brown. Have you ever heard of her? She's an author. So she's a psychiatrist, psychologist, and her speciality is embarrassment and shame. So so I've done a lot of research on this subject because I've always wanted a company where it doesn't matter if you lose. So if you lose in our company, but you've done the process correctly, no problem. Nobody cares. Okay. But if you lose and you haven't performed well, that's when we care, right? So we're able to lose as long as we lose the right way. So in my trading journal, every single trade I have a picture of it, yeah? And I can go back and look for it and say every single day, would I take that trade if it turned up tomorrow? If the answer is yes, I've done it right. If the answer is no, because maybe the trend's not right on the daily or it's a bit choppy or something like that, that's something to learn from. But we would want that to run right through our company with everybody that we coach and everybody that we train.
It's a fascinating topic because in general in life, when you take a loss, it means you did something wrong, and therefore it leaves room for improvement.
Yeah,
but in trading, it's you got to accept that it's a norm and it's an inevitability.
So what people don't understand is luck. How much does luck factor in success? So when I worked at a gambling company, a sports betting company, and somebody came in, right, and I'm definitely not mentioning any names or anything like that, but they were a very, very intelligent human being, top in this country, okay, lose money every week. And my colleagues would come over to me and we would have a chat about it because we have to responsibility to stop them from gambling, right? And they'll say, well, this person's so clever, why do they keep losing money? And I said to them, do you think having money and being intelligent have a direct correlation? No way. How many people are rich in this world that are stupid?
Yeah.
Loads.
Yeah, so
there's no correlation between the two. Yeah.
In fact, the people that are not as smart, they are more likely delusional, which can take you to an activation threshold to take action. Whereas the guy who is thinking too much is just paralyzed and doesn't take action. There's a lot that goes into it. Very interesting. I wanted to circle back to the technicals portion because you mentioned there's a difference between being an analyst and reading price, I guess, versus trading. What is the difference there?
So, in terms of the traders that I currently have, I can give you direct stories. So I've got traders that will zoom into a chart, analyze every price tick, look at every indicator. And, they're so intrinsically involved into this that understanding the probabilities, the variances, the psychological factors is not even within their realm because they're staring at a chart so intently and they're involved in this chart that they forget all of the things that are surrounding it. And that's where the balance comes in. Yeah. So if your money management is correct, right? If me and you sat here every day and we flipped a coin on the DAX going up or down every single day, we'll be right 50% of the time. Okay. Law will tell us that, the law of large averages. But then if we start messing with the asymmetric risk to rewards, and I've done this with interns, trading interns, and then you then flick a coin, 2 to 1, you only need to win 33% of your trades, right? To be profitable or to break even at 33%. To be profitable is anything above that. So what comes in then is analysis. That's what's hopefully going to give you that little edge to take you to 40, 50% or whatever. So this has to be trained. And anybody that's directly so involved in looking at the charts tick by tick and why isn't this working and how isn't this working, it's hard for them because whether they may be analytical human beings, but it's hitting them emotionally. And they might not know that because they're academics. They're feeling it in a different way to somebody who's emotionally intelligent.
That's interesting. Speaking on just taking technicals into a strategy, what is that journey like where you can draw lines on a screen and get an idea of what's tendencies, probabilities, support levels, and all this other stuff? But how does anyone that is learned, because people usually learn to read price before they learn how to trade, what is that journey or the correct journey to go from analyst to trader?
So now I have the luxury of hindsight. I was one of those guys. So when I studied it with the STA and studied technical analysis, I took every single indicator on 4 time frames. So I did a 5-minute time frame, a 1-hour time frame, a daily time frame, and a weekly time frame. And every single indicator that was available to me at the time, I tested them 100 times on each time frame to work out which was the most reliable indicator.
Okay.
And that was what I did. It gave me data, which was interesting. But again, when I went and tried to apply this, I wasn't ready psychologically to feel the results of this. I wasn't. So when RSI, we'll use this one as an example, actually RSI for me is a positive or negative indicator rather than an oversold or an overbought indicator for me.
Okay.
If something's above 50, even if it's in extreme territory, the market's positive, right? If you trade the retracements of this market, you're more likely to win than you are selling it when it's oversold or overbought, sorry. So things like that, you're taught something there, right? But it might not necessarily be right and you need it for experience, but you need to test it. You need to test it. So I would look at it in the sense that like you develop a strategy, let's say like that. Every time RSI is overbought, wait for the pullback, try and buy it again. Yeah. So let's say that's just a basic strategy. And on swing trading, I can guarantee you that will work. I can actually guarantee it. Then you start off with a simulator, work out how many consecutive winners and losers you get, practice it over 100 trades, then employ it live, then jot down your emotions while you're doing it. And that's the way I would do it now. One strategy at a time. Don't trade multiple strategies. Yeah, so you've got some focus. Journal everything. So develop the strategy, back test it, forward test it, simulate it. That's only forward testing. Then trade it small, then do it live properly. That would be the way.
A common bridge that I see a lot of people face and struggle to get over is I'm great at backtesting, I'm great at simulators, I'm great at understanding price, but when it comes to live markets, I just can't seem to replicate what I can do on the weekend, every weekend backtesting. What is that hurdle that people struggle to get over?
Because you don't feel the same emotions on the backtesting chart than you do on the live market. That's it. That's literally all it is. The reason why I can say that now is because I'm so detached from the profit that I win or lose every single day that I don't care. It's like backtesting for me now. But at the time when I turn a new strategy live, it's not like that because my ego is invested on whether it's right or wrong. And it's that. So if my ego is invested in me looking or feeling like I need to look smart for this working, I'm going to struggle with the emotions of it at that particular time. And that's for me what it is. For somebody else, it might be the money. So they could be like, oh, I've spent 10 grand on this course. I need to make sure that I'm going to make that 10 grand right. This has to work. Otherwise, I'm going to look like an idiot. That is what makes live markets tougher than simulated markets.
Interesting. I want to get into the technicals we've spoken about on a traditional sense, which is through this society, and then what you're doing in technicals in your own trading. How much does that differ from like academic technical analysis versus practically functioning technical analysis?
Yeah, so I don't describe myself anymore as a technical analyst. I used to. So we were talking about identity. I used to say, oh yeah, I'm a technical analyst. I don't describe myself anymore as a technical analyst.
Why is that?
Because it's got... I don't need it anymore, and it's got so little to do with my trading.
You mean technicals?
Yeah. So it's how I develop the system, but after I've developed the system, I don't need it anymore because it's my brain and my discipline that's more important than the technicals when I'm trading it. So it flips after I've designed the systems. So going back to what we were saying about how this can fit in and how it actually works is that once the system's designed and you know that it works, it's then parked aside. What your job then is to prove, does the system work or not in real time? That's your job, and that's only done by performance and by discipline and by risk management. They're the only ways that it's done.
I want to say you're known for having simplified, if I'm to pick a word, of simplified technicals, simplified charts, naked charts and so forth. Where does this philosophy derive from?
So I did so much work on the charts with all the indicators and with all of the, the overlays and all this kind of stuff, that eventually I didn't need them on there to know if something's hit a fib retracement, if something's hit overbought RSI.
Is that more because you would visually see it and you don't need the indicator, or is...
Yeah, I would know. You pull up a chart now, like gold. Do we need somebody to tell us that RSI is overbought on gold? We don't need any.
Yes.
So like you slowly start to know this, right? When
Is that intuition, or what is that?
It's analytical. So then going back to naked charts, right? Simplifying it in the sense that if something's trending, your job is to get into that trend. That's it. So if we go from retail traders to institutional traders, right? Institutional traders are the ones that move the markets. Yeah. We can't sit there with our $1,000 a position, 500 quid a position, or whatever it is, and think that once that's in the market, it's going to move the market. It's not. If we're having an inside day on the DAX, for example, or S&P or E-mini S&P, whatever amount of money that we put in for it to stay within that range is not going to make a difference. But when the big boys come in and it starts to break out of a range and it starts to wave, our job is to join that second guess it, predict it, forecast it, whatever you want to call it. That's our job. And we are going to get that wrong just as much as we are going to get it right. That's our job. Yeah. So the amount of technical analysis that you know and do is not going to help you. What's going to help you there is your discipline and risk management. So, we've had a really good run in the markets at the moment, S&P 500, Nasdaq. Yeah, really, Google is killing it right now, right? If we know Google's the best stock in the world at the moment, right, our job is to take every pullback, even if we think it's overextended. We don't know how far this thing's going to go. Bitcoin traders, we don't know how far this thing's going to go. But every pullback, you decide how much risk you can manage to put it in there and give it a shot, and it could go. That's our job. That, for me, is what a trader's job is.
I've spoken to a variety of guests on the show, and a unanimous common denominator between all of them is the emphasis they put on data and actually knowing the inner workings and the insights of your edge and your performance. That's why I'm proud to bring a partner of the show, TradeZeller, the #1 journaling, backtesting, and all-in-one insights experience created by traders for traders. What TradeZeller really gives you is deep insights about your trading that would ordinarily not be visible, whether it's through understanding your trade types and playbooks, or even insights powered by artificial intelligence through Zeller AI. Whether you trade Forex, futures, cryptos, the stock market, it all seamlessly connects to TradeZeller, so there is no additional work. You've seen me reference it dozens of times and all of the benefits I've had in my trading from the insights I found from my TradeZeller. So join myself and thousands of other viewers of the show. You'll get the best discount using the link in the description or code TOT for Titans of Tomorrow. Do you prefer trading markets that you can call trending like that, that have an inherent appreciation like a S&P, versus Forex, which kind of go sideways?
Yeah, so they say don't get emotionally married to a stock or whatever, but Apple has been one of my favorite stocks of all time. Because regardless of what I did, every pullback I bought on the daily time frame that retraced, let's say it's 1 standard deviation and a half to 2 standard deviations for it to go back in that direction. Every one I took for a long time won. So I made a crap load of money on Apple just trading it on a daily chart and not doing it. Same thing with the S&P 500. The year before COVID, so 2019, I had 8 positions in the S&P 500 that were just running. And I was swing trading back then. I wasn't day trading. And I was getting bored because I didn't have any work to do and it was just running. So that was where my analysis career came from. I see. Because I was trading and I was doing nothing. So I would write articles for companies and stuff like that. So that's our job. So you in different, every day I would say what's the best trending market. Every single day I'll look for what's the best trending market.
And trend can mean a lot of things. How are you identifying trend? Is it current momentum?
So for us, trend's the easiest thing to identify. Is the market making higher highs, higher lows?
Okay, just structure. Okay.
Straight, yeah. Are the lows getting the wave lows getting higher? Are the wave highs getting higher? Then we look at look, is it above the 21 period moving average on the daily, if you want to simplify it? And then also, depending on how much you squash the chart or not, is it looking like a 45-degree angle? Like, it's literally that simple for me on a few different time frames. So if something's trending, it's trending well. Now, then you have to accept that when your trends finish or they turn or they're starting to consolidate, that you're going to lose money. So gold is a massive example, because we've got a couple of traders who like trading commodities, and gold has been on this amazing run. But prior to this last couple of weeks, we were in that wedge formation, and it was tight
for a couple of months. Yeah,
and there were 3 false signals going to the upside in that formation. Because, every time it came down, it looked like it was going to try and go again, and failed. So one of our traders, I was saying to him, look, I'm avoiding gold at the moment until it breaks out of this wedge pattern. He takes every trend line break that goes in the direction of the trend. So he had 3 losing positions before he won this big winning position. But he won this big position. And this is the difference, I think, between retails and professionals. Because in those 3 losing trades, he would have lost his risk money, which is fine. But when he wins the trade that beats those 3 losing, he has to stay in it to make sure he makes the amount of money and compound.
For the maths to work out,
correct.
Yes.
And that's the difference, because a retail trader may think that, okay, I just need to make back that money I lost on those 3 losing trades and cut it.
At that point, why bother in the first place?
Exactly. And that's the emotional, that's all. This is why I say psychology is important, because that's a psychological decision. Greed, fear, fight, flight, freeze. That's what it is there.
Going back to how we started the conversation with the Trinity, we've spent about 30% of the conversation on technicals, 30% on psychology. I want to touch on the last portion, which I will argue maybe is the most misunderstood or neglected, because money management can just be like, okay, I'm going to do 1% risk, and then I'll do a 1 to 2, 1 to 3 restored partial, and leave it at that. Why is it weighed at 30% of trading as opposed to just an oversimplification?
So it would be the same for poker. It would be the same for sports betting. It'd be the same for anything, right? If you're not staying in this game long enough to see yourself win, there's no point, right? So that's the thing about the money management side. And we spoke about the consecutive losers and winners, and that's very important as well. So understanding the statistics of your money management is, you can't have any of the other 2 without this. And the other 2 don't work without the other ones either. So this trifecta is the reason why you have to be balanced on all 3. And the way I would say this is, if you had a random distribution of data, could be anything. So sometimes we'll show people charts of them not knowing what it is. And your money management has to stack up in those environments. In like day-to-day environments, when you have random data that you don't know what's going to happen with, your money management has to save you. And that's why I like those random tests like coin flipping, dice rolling, or whatever. Because if your money management's not right, you're not going to take the winners when it goes your way.
Money management, are we dividing it between risk and profit-taking systems, or is there more to it?
No, that's the together.
Okay. And which one would you say is more crucial? Because you can argue that the risk side is in your control, and the outcome, how far the outcome goes, is kind of out of your control. And you can only do something based on data, I guess, because you don't know the outcome of an individual trade. Which one do you give more importance to, or how do you manage either?
Yeah, so I'm risk averse by nature, I am. So this is a difficult question, because I wish I was like some other traders that I know, that when it goes their way, they just really, really push it. But I'm data driven. So every single day, I take the same type of trade with a 2 to 1 risk to reward. But what I'll do is, if I'm trading well, I'll compound on profit rather than compound on trades.
What does that mean? As in re-entries?
No. So if I have a good month or a good couple of months, what I'll do is I'll increase my position size then.
Because of the profit buffer?
Correct. Okay. Rather than, I've got a good trade, I'm going to add 20% more into the trade. Math still works out the same after a while. So it's not any different. But if you've got a good feeling about a trade and you're in a position of profit, the math dictates that you should put more money in it. Actually, in real life, but psychologically, I'm not great at that, so I don't do it. I know that about myself. But I have traders like James, who can re-enter one position 6 times until it maybe falls 15-20%, and it'll cut them all, right? So I think it's different strokes for different folks for this particular example. But on the risk side, nothing ever changes. We do the same thing. Me, if I lose a trade, close computer, done. right? James, if he loses 3 trades, close the computers. He's done.
So you have a 1 strike policy per day?
Me, yes.
Okay.
But other traders don't. They have 3. You know, it depends who the personality is, but the money will always be the same. So if we've got like $2,000 risk a day, you can chop that up into 3 trades if you want. I'm taking it all on 1 trade.
Okay.
All right. But listen to this. This is a really good example, because if you chop it up into 3 trades, what's the likelihood that you're going to win the 3 trades, and what's the likelihood that I'm going to win the 1?
Win all 3.
Correct.
Far less likely, yeah.
Because if I'm 50-50, I've got a 50-50 chance of winning 1 trade.
I see
You've got a 50-50 chance across all 3 trades. And people don't think like that, right? But this is mathematical, this is statistical analysis, which is why I said I'm not a technical analyst. I'm more of a statistical analysis.
What about just, are you a day trader?
Yeah.
So I guess you can bring in deviations of like average daily volatility and how far, historically speaking, for the last month, this asset class has moved.
Yeah.
And therefore, should I pin my profit around that ATR, or should it just be on fixed R multiples?
Yeah.
How do you decide when to, do you partial out, or is it just 1 to 2 fixed?
No, mine's 1 to 2 fixed. So this is a great question, and this is, to be honest, what people need to be thinking about. So if you've got in the first hour of a session the average move of Google, for example, and all of a sudden one day it's having a really, really good day and it's moved 1.5 times, should you take a long? Right? This is the issue. The answer is going to dictate is no, but there also is another answer that says that you never know what's going to happen. So we like this. It is a conundrum every single day for us, genuinely, in our trading room. So you know,
I'd say exceptions don't define the rule. Like, it might be an anomaly day, but can you bank on it being that anomaly day?
That's the thing. Statistically, the answer is no, because like, why have you developed an average? So Tesla will move like. I have not done the statistics at the moment, but on average it's $10 a day. Between $8 and $10 a day, Tesla will move every single day. If it's moving well and we get another signal and it's already at $10, right? Logic dictates you shouldn't. But at the end of the day, if you're a 50-50 trader and the setup's the setup and it's turned up, you should take it. That's my argument. It's like, if your setup's there and you've been tracking it and it follows everything and the pattern's persisted and it's there, just take it. It's only 1 trade on 1 day. You know what I mean?
And when the reason I'm trying to understand deviations versus fixed R multiples is because it's the size of your stop loss will obviously dictate the size of your profit level. How much difference do you have between your stop loss sizes, where it could be like in pips at least, like one day is 10 pips, one day is 30 pips, or is it always in a tight range?
So this depends on the behavior of the asset we're trading, right? So you know, on something that moves a lot, you are going to need a bigger stop loss. If something that trades often within a tight range, and I feel bad for saying this, but a lot of people trade the asset classes that are the most traded in the world. I don't think that's a good idea. So if, for example, you're trading ES Mini or something like that, it's more contained because more people trade it. So something like Tesla will move percentages, right? Something like the ES Mini has a more consistent average daily trading range, and it's less likely to have those explosive, amazing breakout days. But Tesla is going to have amazing breakout days all of the time because it's uncontrollable.
Yes.
So why are you trading something that limits your potential to an average range?
Just to throw it back, why then have a fixed partial on something that could break out? Sorry, a fixed profit level instead of a scale out when something can go, leave a runner kind of thing.
So this is what maths is, because, like, for example, if you're trading like me at 2 to 1, and you're 50% likely to win the trade at the beginning, right? A 2 to 1, your trade is 66% likely to lose in just basic maths, because your stop loss is twice as small as your target. Your target has to go twice as far than your stop loss. So you're 66 more likely to hit your stop loss than you are to hit your target.
That's assuming no break even.
Yeah.
Okay.
Let's just say that, right? So bear that in mind. Let's say you've got to 4 to 1. Yeah. Mathematically, how likely is a trade that has no analysis likely to get to 4 to 1? If your 2 to 1 is only 33%, you have to half it, right?
Yes.
This is the thing about trading. So what you got to do when you get there is think, okay, well, it's gone this far already. Yeah. If I move to break even and I add another trade, I'm in a better position. That's what you should be doing rather than taking partials, because if you take partials at 2 to 1, your trade now has to travel twice the distance of your 2 to 1 to even earn the same amount of money.
Oh, very interesting. Very interesting.
So it doesn't work mathematically. That's not a good thing to do ever, right? So if we're now trading, and let's say we've done a 50-50 trade, I've risked $1,000 to make $1,000. At $1,000, if I move my stop loss to break even and risk another $1,000, I'm at the same risk level as I was at the beginning, but now I can make twice as more money.
I see your point.
That makes more sense.
What is your belief on break even and when is right to do it, or if it's right to do it?
Break even is a good factor in certain scenarios. Emotionally, it's a good factor, not mathematically. Emotionally,
Not mathematically.
no, I don't think so, because emotionally it's a good factor. Like, let's say you're trading and you're at 1.75 to 1, you're nearly at your 2 to 1, and if you're day trading, markets can just reverse on a headline and they can come and take you out, right? That happens a lot. But you then got another trade to take because you've saved your risk money.
I see. Yes.
So emotionally, that's a good job. But actually, if you look at your statistics of your trading journal or how you've developed a strategy, you have to factor in a break even if you're going to move it into break even. And I would say more often than not, the strategies that I've tested and looked at with my traders in my time, more often the break even, the shift of odds at break even makes your strategy worse.
Is that because you're likely to be wicked out?
Yeah, because when are you going to move to break even? At 1 to 1, 1.5 to 1? What's your...
Okay.
There's a variable.
Yes.
You have to calculate it.
I guess if I'm to, because I do break even, and at times I'll break even very aggressively. And the benefit it's brought me, I feel, is on high conviction plays, there's no issue.
Correct.
But on those, let's say, lower conviction plays, let's call it a B plus setup, I have a reassuring thought that, well, worst case scenario, I can break even quick.
And take another trade, yeah. So it's emotional. It's not.
Yes,
it's not mathematical.
Okay.
So I don't mind it. That's what I mean. Like, I do it. Like because the markets I trade are so fast. If I'm at 1.75 to 1, I'll move to break even because I think, look, it's been hard enough to get to this level. I don't want to. I'd rather take another trade than sit in this one sometimes, and I'll do it. But I have to emotionally accept that.
Is there any mathematical benefit in doing a trailing stop as opposed to break even?
Yeah, there is. So at your trailing stops, you then shift the odds, but then you've got to work out it's not a new trade, right? So let's say, for example, we start at 2 to 1, yeah, and we think, oh, actually, I think this has got more legs in it. I move my stop to break even. Then it goes to 4 to 1, and I move my stop to break even. Now we need to start thinking about what you were talking about earlier with the ATRs and the average candle size movements. That's what we now have to start thinking about. So when is realistic time? Now, because we don't know the future and we don't know the outcome of anything, this thing could just run off forever. But what's the likelihood of it running off forever? This is why I don't mind pushing your stop losses past break even and having trailing stops, because you're accepting that randomness and chaos. You're accepting that, but also you're limiting your point to think, okay, well, now if you get to that trailing stop to 2 to 1, your worst case scenario is, okay, it's at 2 to 1 now. Best case scenario is it can go for forever. Who knows? You're accepting that.
Yes. Yeah. Aside from just average daily range, to kind of forecast where price could go beyond your fixed 1 to 2, what about just technicals in terms of you got in at higher low and the target is obviously the new higher high in a bullish trend. You're sitting just shy of it and you're at your 1 to 2. What about using technicals to say, you know what, let me hold on further because there's a high probability we'll create a new high?
Yeah, so I adapted Elliott Wave, right? I think Elliott Wave had a place a long time ago, right? I think in the 70s or whatever, I believe Elliott Wave was good. I don't think it's good anymore. If you try and give me a weekly chart of the S&P 500 and try and count waves, it's never going to work for you. So what we try and do is like, look, every time it breaks into a new high, what's the average length of an extension on the S&P 500 or whatever you're looking at.
Okay.
And that's the way we work it out. So again, it's statistically measured, but we can say, look, it's fair to assume the last 3 extensions of the highs on the S&P 500 maybe moved, let's say 0.6% or something like that, right? So then you can then say, well, I'm going to try and hold this for maybe 0.4 or something like that. That's acceptable for me. I'm okay with it. But like PLTR, there are exceptions to the rules, right? But on average, you will know how far an extension moves on a breakout. And I do believe the fibs, so the 127, 1618, the golden extension and things like that, I think they work quite well, actually. And I believe that they're intrinsically in human nature. They fit in human nature. Fib extensions, I think, work.
What is your thoughts on up-and-coming traders now? And obviously capital becomes a big bottleneck. Or you can learn how to just do 1-2% a month and let the capital do the heavy lifting, as opposed to chasing unrealistic gains. Obviously that brings us towards the answer in this day and age, which is prop firms, which was, when you first started, not even a reality, which is why you've ended up in a different path, I guess. What is your views on the new version of prop firms?
I really struggle with it. So I'm at the Prop Trading Expo in London, and like there's good and bad parts to prop firms. So the prop firm model is confusing to me because, like, if you're coming in, it's not real money, yeah. Something that you're trading isn't real money, but you're getting charged a spread and you're getting charged a commission on something that's not real. That's the first thing. That's immoral to me, anyway. But they're trying to simulate market conditions, so that's why they do it. They can get away with it, but it shouldn't be there. If you're trading simulated funds, you shouldn't be charged a spread and you shouldn't be charged a commission. That's the first thing I would say. Second part about it is that these challenge phases, challenge 1, challenge 2, whatever. Statistically, again, it's not going to work like for the average trader.
It's designed to be a hindrance. Yeah.
And again, with traditional money management principles that everybody's taught, it's not going to work. So we've run mathematical simulations based on 1,000 trade scenarios with funded accounts, and like you're only going to pass an account 30% of the time with a 50% win ratio with a 2-to-1 risk to reward, actually, because of the challenge phases. And then if you're lucky enough to get through to a live phase, you've got another phase still to make money on. So I like the fact that it's giving people an opportunity, and I've received payouts from them, right? And my traders have, and it does work. But one, you're not trading a real market. You're collecting fees from losing traders, right? That's how you get paid. The second part about it is that the odds are stacked against you, but odds are stacked against you in trading anyway, right? So you have to balance that as well. But it's quite hard. I think like they've tried to, a lot of them have pitched us to open our own funded account, right, rather than a prop fund. And like statistics from what I've seen is that like 1% of traders are going to pass challenge 1. Then out of the 100%, only 1% are going to pass challenge 2. And then after that, only 1% of them make the money. So it's very, very tough odds for anyone that's going to do it. But if you are going to do it, and I'm not trying to take anybody away from it, is work out the probabilities on passing the individual challenges. And that's when this is what this podcast is about, is helping traders. That's how I would help a trader. I would simulate to yourself before you even start pay what the path of passing an account looks like before you even start.
I finally have a special offer to share with all of you from the US or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader8 and NinjaTrader that are compliant with CME regulations. With the largest end-of-day balance drawdown in the industry, a 90% profit split and same-day payout. And with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry to make this a home run offer if you are a futures trader.
Do you think the stats you're mentioning, which are completely true, are maybe warped reality because it's so accessible and it's $50, $100 for the lower accounts, that the barrier to entry is so low that it's now inviting participants into the market that ordinarily wouldn't if it was just a broker situation, or you needed larger deposits before leverage was as it is now. And therefore that if you bring in novice participants, obviously they're going to fail. But maybe, I'm just throwing an idea, but maybe the success percentile is equivalent if you're comparing a broker to a prop firm. Would you compare it's equivalent, or it's still harder in that sense?
I think it's still harder because they have trailing drawdowns.
Yeah, and some of them, yes.
That's why it's harder. Yeah. So, but then it's not your money at that point, so who cares, right? So there's the psychological advantage. But that's the reason why it's harder. When it comes to trading real accounts, again, whether they're synthetic accounts or real going into the market, real markets, there's so many different types of accounts, like options trading, like normal cash equities, or trading futures or CFDs or spread bets. They're all to have the advantages and disadvantages. So that's why I only used to swing trade prior, because let's say, for example, I'm aiming for 200 points. A 2-point spread is only 1%. But if I'm day trading and I'm aiming for 20 points, a 2-point spread is 10%, right? So that's why I wouldn't day trade. So there are advantages and disadvantages to this. So swing trading, you can take a spread betting account. I don't think there's an issue. But the fees, you just got to watch out for the fees, things like that.
As we spend a lot of time on psychology, I want to explore psychology with prop firms because number one, it's not your money, so that can bring up emotions or a feeling. Number two is the easy resets button. Like if you're 10% in drawdown, you just buy another one as opposed to have to climb your way out. But then also it can very easily become gamified and you just play the risk reward of fees versus payouts and so forth, which is then all is not real life. Have you noticed anything in traders that maybe they end up with bad habits or any observations there?
Yeah. Some people, like, again, it goes to individuals, their own psychology. Some people are more tied to whether they can do it. It's a challenge. It turns into a personal challenge, right? And that's good. I think that's an interesting thing because you're trying to prove to yourself that you developed a strategy that's worked. I would try and detach it and prove that the strategy works. So if something's not working, I wouldn't blame it on you. I would say, look, I've developed this strategy. This strategy works numerically. Like, let's see if this strategy works and detach yourself to that. I think you've got a better chance of that. So in terms of bad habits, yeah, because it's cheap and it's easy. But I will say this, and this is a little bit controversial. If you're going to spend money on crap anyway, right, and you're going out and you're buying things or whatever, like trading, what are you doing it for? Is it for entertainment or is it to make money? If you're a professional, it's there, you're going to make a living out of it. You need to make money. If you're buying these accounts because you're entertaining yourself, two different things.
That's very true. And it's interesting because it ties back to what we were saying earlier about ego and so forth. When you have the leaderboards, when you have certificates, record payout holders, whatever, this is all ego. It's all like, okay, I have an identity to my parents. I'm a trader now. I'm a funded trader. Here's a certificate, so they can feel proud or whatever it is. It's an interesting Wild West we've entered in recent years here.
It is, but then the evolution of this, like, it's really hard to work out, like, you know, where it's come from and how it's worked. So what we do with our traders is it's a first risk model. So somebody comes in with, like, let's say $2,000 risk capital, let's say. We will 10 times their money, so they're trading with 20,000, for buying power and stuff like that. But they can only lose their $2,000. This is how our traders generally start. But if they make $2,000, we say to them, take your 2,000 out, and now you're fully funded by us. And if you can work on that capital, you earn more and more money. So for every $1,000 somebody makes, we give them another $10,000. That's how our system works. So we've tried to shift that in the sense that you come in, you put your money where your mouth is, we put our money where our mouth is in teaching you, right? Then if you get past that risk tolerance, you've taken your money out. This is not you anymore, right? It's your answer to us, and your profit split changes. So at the beginning, if they've got risk capital in, it's 75% to the trader, 25% to us. But as soon as we fully fund a trader, it's 50-50. We're now in it together. And that's how we developed this model. We thought about this model because we wanted, like, it to be even for the traders and for us, but also when they first come in, they have put up their risk capital, so they deserve to earn more money at that stage. Whereas with a funded account, like that trailing drawdown when you get into profit, and I always say this, and I'll say it on every interview: if a trader's made me $1 million and they draw it down to 500 grand, they still made me 500 grand. Why am I going to get rid of them? You know, like that's the interesting part. So if you're a good funded trader, you could probably trade anywhere. Like, it's so hard there that I think you've done a really, really good job, and you could get a job somewhere trading properly, I would say.
That's true. With the rules you have with certain props, it's harder than real life. So when you come to a real life scenario, it should be a lot easier.
And take your money out and open a real account, isn't it? And maybe trade them side by side. I had a funny trader, and he might listen to this, so he will probably laugh at it. But what he would do is he would trade his funded account, but he'd trade the opposite position on the live account. So, like, but he'll adjust the quantities of it. So basically, if he'd because their funded accounts are worth so much money, like, because of where he got to like 250K. If he lost the money for the account,
he was hedged.
and he could pay for another challenge.
Oh, nice. Okay.
And it was basically, and if he made the money on the big account, he was making way more than the money than he would
have lost. Yeah.
So little mathematical queries like that, like it's you have to think outside the box a little bit, but they can end up working. Obviously, spreads is a bit of an issue and things like that, but it can end up working.
Interesting. On this topic of, let's call it diversification, as this example of this chap.
Yeah.
This year I took probably as a concept that's very well understood. It was new to me, where I liquidated probably 90% of my trading accounts and just put it into a few stocks around the tariff time, into a few stocks, into gold, into the indexes, and my overall risk in terms of per trade is the same. But obviously, I only have 10% of my account size left, but I still have liquid access to it if I ever need to. But now this dead capital of, I wasn't using the margin, I wasn't using the full 100% of the account. This dead capital has now become generating me, at this point, probably 15-20%. And this has brought me a lot of peace in the market. I don't have to chase the market. It's just, I feel like a different person, and it's helped me a lot. And it just feels more diversified, it feels more sensible, and now I'm not forced to beat the market because the market is with me in this sense, and maybe overall lifts everything that I'm doing. Is this something that you've explored yourself, or something that you do?
Yeah, so we take swing positions, or like position trading positions, as well as day trading. So like PLTR, Palantir, like that's been on such a great run, right?
Crazy, yeah.
So when we get the same signals as I use for day trading, I will use for those position trades, but I'll use it on a weekly time frame, a very long time frame.
Okay.
So then I will, like, if something gives us a trigger, put a small amount of money in at the beginning, honestly, like 300, 500 quid position. But only if it goes well, I'll compound on that position off the money that it's earning from it. So this grows over time, and it works quite well. I think you can start, like I said, with something small. And like you said as well, a lot of the accounts that are on offer now, and this is why I don't think all of the technological innovation is bad, because a lot of the accounts that are offered are there's a minimum balance protection or no loss protection on these accounts, right? So you just need the margin in there to buy these trades or whatever you need to do. So if you would open an account and let's say, Tesla gives us a new long signal on a weekly chart or something like that, you can't go into negative balance. So it's literally a one-sided trade, apart from the risk that you've put in, and it's a pretty decent philosophy, and it's pretty similar to what you did, but you did it on a bigger scale. So yeah, I do that, and don't have traders remorse. Like I missed gold this time, don't worry about it. There's always things that come. You know what I mean? I think that's a big thing.
As you approach 2 decades in the market, and therefore you've seen the social media Wild West, the prop firm Wild West, and I guess the evolution of the market. Is there any key piece of insight that you'd like to share with someone that's at their 1 to 3 year mark in their career?
Yeah, I wouldn't. So social media is a positive and a negative thing, but like it's a minefield in terms of education. So there are some really good things that you can get off social media, but then you have to trawl for it to find it, and it's so hard. So having a good an educational resource is key, I think. So finding yourself a reputable resource is probably the most important thing. In that 1 to 3 years, you're going to do well, you're going to do badly. But like the likes of Warren Buffett, Jim Simons, these guys are the best traders in the world ever. They didn't really make it until year 10, year 12. So I didn't really make consistent profits in the markets till year 4. And then year 5, year 6, they were consistently profitable. But then when we hit shifts of change in markets, like if you're expecting to make money month on month on month on month, it's not going to work for you. You have to have enough capital to survive those months. And then lastly, if you are planning to trade full time, I would always say to somebody, have like a minimum of 6 months of expenses paid for. So you're not relying on your trading capital to pay for your living, because you can get a job in 6 months or whatever, or maybe a year, whatever you're comfortable with, because you don't need that pressure on your trading. Trading under pressure is too difficult. It's not possible. I'm not sure. I have seen some traders who have really needed money make it. I have seen some, but it's a very, very low percentage.
Rajan, thank you very much for your time. A wonderful episode and a very unique conversation, which I really enjoyed. So thank you very much for coming on.
Cheers.
There we go. Perfect. Boom.
Thank you.